Good morning, everybody. If you could take your seats, please. And if I could have your attention, that'd be great. My name is Maurice Button. I'm the CEO of City Financial, and I'd like to welcome you to today's conference on FCA investigations and enforcement. It must be the 8th or 9th in the series that we've held on this extremely, always topical subject. I'd like to also say hello to our virtual guests, as today's event is being live streamed. And I'd like to thank our sponsors and supporters who've helped bring today's conference together. A few housekeeping points, if I may, before we kick off. There's further information about the programme, about the speakers on the event app, which I hope you've downloaded. There's a delegate questionnaire on all the desks. Please do fill that in. It helps us improve our events. And I'd like to just flag up a couple of upcoming conferences we have, which are topical and related to today. The first is on AI regulation, being held in London on the 11th of November. And the second, whilst it may sound very similar, on AI policy, which is looking at the government's attempts to deliver the UK's AI capability, and much of that is to do also with regulation and with legal frameworks, particularly around things like data centres. So I should also point out the fire exits are the way you came in. Now, today's summit is topical because it follows the FCA's release of its revised enforcement guide in the summer. The new guide aims to provide clarity about when the FCA will publicise investigations. There'll be much discussion about that today. Some of the other topics that we're going to cover include enforcement issues around crypto assets, AI in investigations, a very interesting topic, non-financial misconduct and whistleblowers. Clearly that's been much covered in the media recently. Cross-border investigations and consumer duty enforcement with a special look at the BNPL sector. Now, it's my great pleasure to introduce our chair for the day, for the morning, I think. Maybe I'm going to get you to do double duty, David. David's a partner David Hamilton is a partner in Howard Kennedy's Business Crime and Regulatory team. He has significant experience advising on bribery, fraud, money laundering, and market manipulation matters, with a particular specialism in financial services, enforcement, and compliance. David, over to you.
Thank you, Maurice. Morning, everybody. May I also add my warmest welcome to the conference today. It's a pleasure to be chairing this morning's sessions and to see also such a strong turnout from across the legal, compliance and risk communities, and a very warm welcome also to those who are joining remotely. Whether you're from in-house teams, private practice or regulatory bodies, your attendance today reflects the importance and topicality of the diverse issues that we'll be exploring. I do hope that today's conference provides not only valuable insights, but also a forum for meaningful discourse, fresh perspectives and practical takeaways that you can apply to your own work. Over the past 2.5 years, the FCA's enforcement strategy has undergone a marked transformation under the joint leadership of Therese Chambers and Steve Smart. Their complementary backgrounds, Therese is an experienced FCA lawyer, and Steve, coming from a predominantly criminal background in the National Crime Agency and other governmental departments, have brought together regulatory and criminal expertise in a way that has reshaped how the authority tackles misconduct. The changes have been both strategic and operational. At a strategic level, we've moved into the era of impactful deterrence, where enforcement is framed more explicitly, I would say, as a tool not merely to punish misconduct, but to send clear and timely signals to the market and to consumers. The FCA wants its actions to resonate and to deter future breaches by demonstrating that regulatory requirements and consequences are real, visible, and proportionate to the harm that is caused. Operationally, the FCA has committed to faster, more focused investigations. The average duration of cases has dropped significantly from around 42 months to a target of 16 months or less. This reflects a deliberate move to streamline the caseload and prioritise cases that pose the greatest risk of harm and offer the strongest deterrent effect. Following recent speeches and other output by the FCA, the regulator's aim is not just speed for its own sake, but to ensure that enforcement outcomes are timely and timely enough to influence behaviour and reinforce market standards while the issues are still fresh. This more assertive enforcement posture is particularly evident in areas like financial crime, fraud, market abuse and operational resilience, where the FCA is increasingly deploying its criminal powers, especially in cases involving investment fraud and money laundering. One sector where this shift is especially pronounced is crypto. Our second session this morning will be exploring the future regulation of crypto in the UK and associated financial crime risks. The FCA enforcement focus here is unmistakable, I would say, from the Finfluencer crackdown and cross-border regulatory cooperation to active policing of breaches under the money laundering regulations, including illegal crypto ATMs and crypto exchanges. Personal responsibility has also been a key theme, with a series of high-profile enforcement investigations and actions against very senior leaders within the sector. The results of some of those cases doubtless emboldening the FCA in its approach to enforcing integrity, competence and other requirements under SMCR. Chris Nynan and Christine Young of Herbert Smith Freehills Kramer will be speaking on these trends and the impact of proposed changes to the SMCR later on this morning. Technology is also playing a significant role. The FCA is investing in digital tools to enhance its market abuse and market surveillance capabilities, including the use of blockchain analytics, enhanced transaction monitoring, as well as store reports. And in that context, I'm looking forward to hearing the panel that Priya Giuliani of HKA will be moderating regarding the role of AI in evidence gathering, as well as Martin Hopper's Fireside Chat with Christopher Rich on the latest developments in market abuse and other wholesale market risks. All of this reflects a broader shift towards what Therese has previously described as a kind of regulatory Kaizen or change for the better, continuous improvement, self-criticism, and a willingness to challenge the status quo in pursuit of better outcomes. We have a packed schedule today that's designed to provoke thought, share insights, and no doubt offer some challenge where appropriate, and provide practical guidance on these key developments. But before we begin those discussions, we're very fortunate to start with a keynote address by Therese Chambers. As I mentioned a moment ago, Therese is the Joint Executive Director of Enforcement and Market Oversight at the Financial Conduct Authority, and alongside Steve Smart, she's led the FCA's enforcement division through this period of significant change. She's long been a respected voice in financial regulation, and her leadership has helped define the FCA's approach to deterrence and accountability. This morning, Therese will be sharing her reflections on the FCA's current and future approach to enforcement under the revised enforcement guide and what firms and advisors should expect going forward. And being a good sport, Therese will also take some questions at the end, should there be any. So with that, it's my great pleasure to introduce our keynote speaker for today, Therese Chambers.
Thank you, David, for those kind words. And good morning, everybody. It's great to be here with you. And in fact, I can remember just over 2 years ago being here in this room, possibly with some of you. You may also remember being here 2 years ago. So this feels like the long-awaited sequel to my former appearance. And actually, with the release of Wicked for Good next month, it is the season of sequels. So it's only right that mine happens now. And much as you'd expect in a sequel, the plot may change, but the through line remains. And that through line is the importance of doing the right thing. Last time I was here, I spoke about how doing the right thing wasn't just a slogan, but a standard. how it should underpin every decision, response, and relationship in the financial services sector, whether somebody is watching or not, especially actually when they're not, because those are the actions that shine a light on who we really are. In some cases, the right thing can be subjective, but when it comes to the financial services sector, it's often cut and dried. For firms, doing the right thing means holding yourselves to high standards, recognizing when something has gone wrong, taking responsibility for it, and taking the necessary steps to fix things. That includes paying redress to those you've harmed, cooperating with the FCA to ensure it won't happen again, and being open and honest with us, rather than trying to muddy the waters and keep us from doing our job. Simply put, doing the right thing is about keeping your side of the street clean. But we need to keep ours clean too, and you can rest assured that we're doing exactly that. Whilst we are taking a new approach to our enforcement cases, the through lines remain the same. We're holding firms and ourselves to high standards and rewarding those who do the same. We are conducting fewer investigations faster. When I was here in 2023, we had 220 open enforcement operations. As of the 1st of October, we have 124. But fewer investigations does not mean fewer outcomes. In fact, we're delivering more. We typically average between 20 and 25 enforcement outcomes per year. In 2024, the number of enforcement outcomes was 41. And in this year, 2025, we expect to deliver over 30 enforcement outcomes. And there's more to come. We're prosecuting more people for criminal offences than we have ever done. And while some older cases do need to be worked through, I can confidently say that investigations launched after April 2023 are being closed on much tighter timelines. As David already noted, 7 recent investigations achieved a public outcome in 16 months or less, compared to our prior average of 42 months. And far fewer investigations are ending with no further action. Historically, fewer than a third of our enforcement operations ended with an FCA enforcement outcome. Today, the majority do. And we're also prioritising redress for consumers who've suffered harm wherever we can. In the last financial year, we secured over £442 million for investors and consumers through redress schemes, settlements, and civil proceedings. Let me give you an example of what this looks like in practice. In December 2024, we charged John Dance, WealthTech's principal partner, with 9 criminal offences, including multiple counts of fraud and money laundering. And in April this year, we launched an investigation into Barclays for opening a client money account for WealthTech without doing 2 simple things. First, checking that the firm was permitted by the FCA to hold client money. It wasn't. And then understanding how WealthTech would use that account. Clients deposited £34 million into that account, which should never have been opened in the first place. We believe John Dance helped himself to a chunk of that to fund his extravagant lifestyle. And Barclays' lax controls allowed that to happen. I have said publicly on previous occasions that if you provide banking for fraudsters, we will scrutinise your controls with care. Taking enforcement action against Barclays was the right thing to do. But Barclays did the right thing too. They chose to cooperate with us extensively, which helped us conclude our investigation within 3 months. That kind of speed is good for the wider system, but it was good for Barclays too. They avoided the cost and strain of a much longer investigation. And given the timing, we pragmatically agreed to combine publication of this outcome with another anti-money laundering case involving Barclays, which helped them manage the risks around having 2 enforcement outcomes published in quick succession. Barclays also agreed to voluntarily pay £6.3 million to WealthTech's clients, helping to reduce the shortfall they are currently facing. And as a result of all of that, we significantly reduced the financial penalty that we imposed on Barclays. They ended up with a penalty of £3 million, but it could easily have been more than twice that. Sometimes doing the right thing can help you avoid a financial penalty altogether. Our investigation into H2O found that the firm failed to carry out due diligence on investments, they had few policies in place to manage potential conflicts of interest, and they provided the FCA with false or misleading statements and documentation. These are serious breaches, which would typically result in a substantial fine. But H2O worked with us and agreed to make €250 million available to anyone whose investments were tracked and to apply to cancel its authorization. So we chose to forego a fine. When firms do the right thing, we take notice and they can benefit. We took enforcement action against 3 firms last year in relation to their treatment of borrowers in financial difficulty. All 3 firms operated voluntary redress schemes worth around £354 million, and we reduced the amount of our financial penalties for all 3. HSBC, for example, invested £94 million in identifying and remedying issues with their treatment of customers, and they paid redress of £185 million to over 1.5 million customers. We reduced their penalty by more than half. If you do the right thing, cooperate with us, take responsibility, and put things right for consumers, we will do the right thing too by reducing the penalty that we impose. But actually, firms don't need to wait until we open an enforcement investigation to do the right thing. We use our supervisory powers in a way that offers firms a chance to do the right thing well before any investigation is opened. And if you take responsibility and resolve an issue early, you can avoid skilled person reports, formal requirements, and enforcement referrals. You've likely seen coverage of our recent motor insurance compensation scheme, which is a direct result of our supervisory work. In 2022, we warned insurers not to undervalue cars when settling claims. And in 2023, we published a voluntary requirement requiring Direct Line Group to review 5 years of claims outcomes and pay redress as needed. And after an initial review last year, we found that some motor insurers had shortchanged customers on claims. An estimated 270,000 drivers are expected to receive £200 million in compensation. And of that, £129 million has already been paid to nearly 150,000 customers. Moreover, insurers re-evaluated their claims processes and rewrote them in line with our consumer duty. There was no need for enforcement in those cases because those firms were doing the right thing by the consumers they wronged. But if you don't put things right, we will act. Starling, for example, had multiple chances to do just that. First, in 2021, when they agreed to restrict the opening of accounts for high-risk customers, but didn't. And again, in 2023, when their automated screening system fell short and exposed issues within their financial sanctions framework. So after a 14-month investigation, we imposed a £28 million fine. I have said that the FCA will be pragmatic in its approach, but I have also promised to pursue investigations when it's the right thing to do. And when we dig in, we stay dug in until the bitter end. A case recently reached its conclusion after more than a decade. In 2008, Barclays entered into 2 advisory agreements with Qatari entities that involved payment to those entities in return for their participation in capital raisings. But Barclays only disclosed one of the agreements to shareholders, and they didn't disclose the payments under the capital raisings or the connection to the Qatari entity's participation in them. That decision was reckless, lacked integrity, and went against Barclays' obligations to treat the market and their shareholders seriously. We first issued a warning notice in 2013. There were multiple stays and delays to that process. Ultimately, the case was paused until 2022, when we published our decision. Barclays chose to refer the case to the upper tribunal before ultimately withdrawing that referral in 2024. That case took years, but that case was important, and the conclusion was a welcome one. In the end, we fined Barclays £40 million. That dedication doesn't just stop with banks. We stay dug in when it comes to insider dealing too. We have to. These are some of our toughest, hardest fought investigations. Building a case is painstaking. It involves piecing together trading, communications, and banking data. We're always up against criminals who get creative with the reasons for their trading. Moving a case through the system can take years, and a trial can take months. But we commit to each one to keep our markets clean. This year alone, we have convicted 4 individuals for insider dealing, including the Corfusi siblings, Redinel and Erta. As a research analyst at Janus Henderson, Mr. Corfusi had access to sensitive information and saw an opportunity. In less than 2 years, they traded 13 stocks and made a profit of £960,000. We saw an opportunity too. We noticed suspicious trading patterns, and we analysed large sets of data to uncover the crime. And in March 2021, the Corfusis were arrested in a search operation in partnership with the Met Police. After an 18-week trial at Southwark Crown Court, in which they both pleaded not guilty, they were sentenced to a combined 11 years in prison. Now, another pair of siblings, Matthew and Nicholas West, did plead guilty to 6 instances of insider dealing. At just under $43,000 in total, their profits were significantly less than the Corfusis, but their crimes were no less serious, because as professional investors, they knew that what they were doing was wrong. And we refuse to let financial criminals like the Wests undermine our market's integrity. While both brothers ultimately received a suspended sentence, their decision to plead guilty reflects the quality of our investigation and the strength of the case we had against them. Because as I say, we stay dug in, and this includes making sure that crime doesn't pay. Mohammed Zina, another insider trader, used inside information to his benefit. He was convicted of 9 offences in February 2023 and sentenced to 22 months imprisonment. But our action didn't end there. We refuse to allow these criminals to keep any part of their illicit profits, which is why in January of this year, we took further action against him and confiscated over £500,000, all of his assets. I've said it before, and I'll say it again. If you flout our rules, try to avoid getting caught, or engage in criminal activity, you will pay the price. And as the world changes, so does the type of financial crime we're up against. We have long said that consumers who buy crypto should be prepared to lose their money, because crypto is uncharted territory, high risk, largely unregulated, with some players who don't care about doing the right thing. Earlier this year, we secured the UK's first criminal conviction for unregistered crypto activity. Mr. Osunkoya, who owned and operated a network of nearly 30 crypto ATMs. Mr. Osunkoya knew that what he was doing was wrong. He tried to avoid the glare of our spotlight by operating some of those ATMs under a false name and company. In the end, he was sentenced to 4 years in prison. But that's not all we're doing in the crypto asset realm. As part of an operation led by the FCA and the Met Police, 4 South West London premises were searched, and we found and seized 7 crypto ATMs. If you ever see a crypto ATM, please tell me they're all illegal. 2 people were arrested in July on suspicion of money laundering and running an illegal crypto exchange. That investigation's ongoing. And that same month, we announced that 2 people were sentenced to a combined 12 years in prison for cold calling victims and selling fake crypto investments. They defrauded at least 65 investors and stole over £1.5 million of their hard-earned money. And in July 2024, we announced that the FCA and the Met Police had arrested 2 people suspected of running an illegal crypto asset exchange. Our investigation is ongoing, but we believe that over £1 billion of unregistered crypto assets have been bought and sold through this business. And of course, we fined CB Payments, part of the Coinbase group, over £3.5 million for repeatedly breaching a requirement preventing the firm from offering crypto asset trading services to high-risk customers. At the end of the day, firms have 2 choices: to work with the FCA or against us. Whatever you choose, just know we will be there regardless. I want to make it clear that we always act fairly, even if firms behave poorly. But there are prizes for firms that choose to behave well. As for the firms and individuals that choose not to play nicely, whether with us or with their customers, we will come after them. We will hold them to account, and we won't ease up. The bottom line is this: if you choose to do the right thing from the jump, you'll have nothing to worry about. For example, you wouldn't need to worry about a cooperation credit to reduce a penalty because we wouldn't take enforcement action in the first place. I've spoken a lot about our public outcomes today, many of which have made headlines. But there is a lot of private disruption work going on behind closed doors, and we're more active than you might think. We frequently get in touch with firms and individuals to let them know we're on their case. We ask them to explain, and where concerns remain, to do the right thing. You don't want to receive one of those calls or letters, but if you do, the same expectation applies. Be open with us, take responsibility, and do the right thing. Now, the vast majority of firms choose to follow that through line, to do the right thing, and work with us rather than against us. Those are the ones that reap the benefits. Of course, it's right that firms challenge us and escalate our enforcement decisions, but we will back our findings when it is the right thing to do. The question I'd like to leave you with is this: what's the risk equation of not doing the right thing? As I mentioned last month at AFME, compliance comes with costs, but good compliance can save money, and not doing the right thing can be far more expensive. Over the past year, we found that doing the right thing is much more than mere rhetoric. It leads to better outcomes for consumers, healthier markets, and clearer, stronger enforcement. But it also shows that this kind of standard demands work, integrity, and constant attention. So with this in mind, let us carry the through line of doing the right thing forward together as firms, individuals, and regulators, so that when failures happen, they are addressed swiftly. When harm occurs, it is remedied fully, and misconduct is prevented as early as possible. Thank you.
Thanks so much, Therese. Are there any questions from the floor that you'd like to put to Therese? Yes, please. There's a microphone that will be coming to you just now.
Sumitra Subramanian, Evershed, Sutherland. Therese, we're still waiting for the FCA's finalised guidance on non-financial misconduct, which I think is expected by the end of the year, assuming the FCA decides to proceed. In the meantime, what's your main message to firms and individuals on tackling this type of misconduct?
So culture really matters, right? We all know this. And part of a healthy business culture is where people who work in the business have the confidence that if they speak up and call out bad behavior, whether that's financial or non-financial bad behavior, that they will be listened to, they will be heard, and their concerns will be investigated. I think that's always been part of the FCA message, and I would expect that to endure.
Morning, Therese. Reginald from the FNZ. A quick question for you in terms of your approach. You mentioned that you were, I guess, pursuing less enforcement actions. So my question would be, is there a danger that you would miss viable, I guess, incidences by pursuing less cases? And I guess, how are you mitigating that?
Yeah, so I think we're now at a stage where we are able to deploy all of our regulatory tools with confidence and supported by really strong data analytics, which means that we are identifying potential issues much earlier, and we are acting in response to those issues in a variety of ways. An enforcement investigation is not the only way to deal with potential harm or a potential issue. And what we are doing currently is, in essence, reserving our enforcement powers for those most serious cases where other parts of our regulatory toolkit haven't been able to achieve the desired goal. So it's still very much there, but a lot of other activity also goes on, which means that we don't need an investigation in every instance of potential harm.
You can probably fit in one more quick question if there is one.
What's open to you, those serial offenders, so the ones that... Sorry, Tom Townsend, Grant Thornton. What's open to you to raise for those firms that are serial offenders that have large matters regularly that come across your desk? What have you got left in the toolkit?
Yeah, well, listen, even when people are frequent flyers with the FCA, nobody likes being on the wrong end of an enforcement outcome. Nobody likes having a fine that is larger than similar fines for similar conduct that their competitors have received. So those cases are still hard fought, even where those firms have had multiple experiences of coming through the enforcement process. So my experience is that those firms still view that as very unwelcome, and that there still is a deterrent impact.
Thanks so much, Therese. If you can just give Therese a hand.
Thank you.
If I could invite my fellow panellists for the first session up to the desk. Thank you. That's fine. Fleur's joining remotely. So.
Fleur's on the...
Oh, right.
Well, I'm delighted to be joined by Sarah Clark, KC, the far right, as sergeants in Chambers, Nicholas Gray of Deutsche Bank, and Fleur Isink of Barclays. Now, you have to suspend your disbelief, but Fleur is actually joining remotely, so hopefully we've got Fleur online. Do we? There we are.
She is.
Morning.
Morning.
So together we'll be exploring the practical impact of the FCA's evolving approach to enforcement and what it means for firms. I think Therese's keynote address was quite instructive on some of the key developments over the last couple of years. And a special shout out to Fleur for joining remotely. She's actually on holiday, so I think this is really above and beyond. So thank you so much for that. So Before I invite our panellists to introduce themselves, a quick reminder this session is being held under the Chatham House rule, which should be set up on the screen at some point. So I'd ask everyone, therefore, to, and those who are joining online as well, to refrain from sharing any information, including direct quotes that could identify speakers, participants, or their organisations, please, whether that's directly or indirectly. And there we go. So with that bit of housekeeping done, I'll now invite our panellists to briefly introduce themselves. Sarah, can I start with you, please?
Morning, I'm Sarah Clark. I'm a silk at Sergeants in Chambers. I specialise in financial services enforcement litigation and also civil litigation and some crime that arises out of all of that. My main area, I suppose, is market abuse, insider dealing, market manipulation, investment fraud, but I also do fairly full range of enforcement litigation, including financial crime, insider dealing, misleading the market, and fraud type offending that generally arises out of anti-money laundering or unauthorised investment business.
Thank you. Nick.
Good morning, everyone. I'm Nick Gray. I am the head of the UK and Ireland Litigation and Regulatory Enforcement team at Deutsche Bank. So we cover all of the bank's litigation and regulatory enforcement matters for that region, and also some instances in EMEA as well. I've been at Deutsche Bank for 6 years. Before that, I was at Lloyds Banking Group for 6 years in their regulatory enforcement team, and then before that at Herbert Smith, as it was then, for 12 years.
Thanks very much. Fleur.
Thank you. I'm Fleur Isaac. I am legal counsel in Barclays litigation, investigations and enforcement team, mainly focusing on conduct investigations. I fear that we are one of Therese's frequent flyers. So I've been at Barclays for 8 years. Prior to that, I was in the FCA's enforcement division, working on mainly markets-related misconducts.
Great, thank you very much. Before we begin our discussion, I think it's worth briefly setting the scene. As has already been mentioned this morning, in June of this year, the FCA published its revised enforcement guide. It was an important document in shaping how investigations are conducted and how enforcement decisions are made. The changes mark, I would say, a shift in approach, not just in tone, but in structure and strategic emphasis. The guide has been radically streamlined, with over 250 pages removed, reflecting, I think, a desire on the FCA's part to make enforcement more focused, transparent and accessible. But this is more than just a tidy up. The revisions, I think, signal a regulator that is increasingly selective and strategic in how it deploys its enforcement resources. While many have welcomed the clarity and focus, others have raised questions about the loss of procedural detail, particularly around investigation stages, cooperation, expectations, and enforcement referral criteria, and the potential for greater interpretive discretion in how enforcement powers are applied. It's also important, though, to remember that the changes to the enforcement guide do not exist in a vacuum, but are rather part of a broader shift in strategy and culture at the FCA, part of which I think Therese has touched on in her keynote address. So maybe, Sarah, if I could start with yourself. With that all said, I think let's take that step back. From your perspective, how significant is this strategic and cultural shift at the FCA, and what does it mean for firms and individuals who are experiencing regulatory scrutiny?
From my perspective and based on what I've seen, I think that leaner, fitter and more strategic are all three apt descriptions. And I think that one can see examples of that in, firstly, the way in which a number of investigations that have been around for a long time have been closed. Less investigations have been opened, but what that means is that ones that have been opened are being progressed more quickly, and I think that that's something that one's seen across the board. They are more strategic in terms of the investigations that are opened, which they tie in more acutely to enforcement stated priorities and FCA stated priorities. And I think that I can echo what Therese has already said, because I've seen it from my own experience. There is an expansion in use of criminal prosecutions. The way I see that is that the expansion is more into the fraud areas, so perhaps an expanded use of fraud offences such as anti-money laundering and wider fraud offences to cover different types of fraudulent conduct rather than simply just unauthorised business, which had been rather the focus of fraud offences before. My perception is the FCA are becoming pretty comfortable in prosecuting misleading the market cases, and there have been a couple at least of fairly significant examples of that. The one area in criminal prosecutions where I'm not necessarily 100% convinced is insider dealing. It is right that they have had at least one very significant outcome, i.e. the Janice Henderson case, but they have also done maybe 2 or 3 cases which, whilst having industry professionals as defendants, are not necessarily particularly difficult cases in terms of the type of conduct. It tended to be some fairly obvious insider dealing in advance of announcements and not particularly significant profits, more akin to the kind of cases that were being done when these cases first started happening in 2008. That's not to say that that won't change, and perhaps the reduced number of insider dealing prosecutions is just reflective of the more selective use of investigations, and it's a situation that perhaps will right itself over time. Non-financial misconduct is a huge area. There's no doubt that that's a growth area, and it's here to stay. I know that there are other sessions that will be covering that in more detail, so I won't waste time on it. I do also echo that use of things like redress schemes as an alternative to just imposing massive fines on firms does seem to be a new and increasingly used trend, and one that I think probably everybody welcomes, including in particular victims. And the other thing that I've seen is that I do think that there is a real push to achieve outcomes in a much quicker time. And the way that I've seen that manifest itself is a real willingness, perhaps in contrast to the previous iterations of the FCA, a real and genuine willingness to have a dialogue, even at early stages, regarding the ways in which matters can be compromised without needing to go through years of litigation. So that's my summary.
Great, thanks very much, Sarah. And Nick, from your perspective, and thinking maybe kind of the industry more specifically, how do you see firms adapting, or how will they adapt to this broader regulatory posture?
I suppose from an in-house legal perspective, I guess the first thing is actually understanding what the shifts are, what the priorities are. There have been a lot of helpful indications from the FCA, so I think it's about staying close to consultations, engaging with those policy statements, announcements, final notices, but also I think the supervisory relationship is vital. It's a fundamental part of a firm's regulatory compliance to have a really good, healthy supervisory relationship, and to use that for understanding those changes, what they mean, what the FCA expects, and deepening understanding, and in particular using them for real life, real-time, practical examples. So I think it's about firstly understanding, and then in terms of how you adapt and put those into operation. I mean, I'm on the enforcement side rather than the compliance and implementation side, but I mean, plainly, these sorts of shifts, focus on non-financial misconduct, for example, are the sorts of things that will involve a wide range of functions across any firm, not just legal and compliance, but obviously senior management is very important, training is very important, investigations teams, whistleblowing teams. They're all engaged and they all have to work together to make sure that this is properly embedded.
Mm-hmm. And Fleur, how do you see the current political climate and the government's growth agenda, I think in particular, influencing the FCA's enforcement priorities? Because we talk about the changes to the enforcement guide not existing in a vacuum, but neither does the FCA itself exist in a vacuum, and it's really part of that political landscape. So have you got any thoughts on that?
Yeah, absolutely. I mean, we've seen that the Treasury in particular has been very keen to promote the UK's competitiveness as an economic force, particularly in financial services. And what we've seen is in the last few years, the FCA, as you said, David and Sarah, expanding its remit into areas it hasn't covered previously, non-financial misconduct being the obvious one. And Nick is quite right, that will require substantial input of efforts within particularly big firms to align HR processes, performance and remuneration, as well as compliance. So that is a substantial piece of work that is now, within a firm's obligation under these new rules. And also the consumer duty that the FCA has brought in, which has reset firms' relationships with its customers. So all that is work that firms need to be getting on with and ensuring that they're ready for. But at the same time, we've seen the government, and particularly with the FCA's secondary objective to promote growth in the economy, I think there is a real tension there. I think will be quite interesting to see how the FCA grapples with that. I think another kind of key example is the motor finance redress schemes. In the House of Lords last week, the FCA did come under some criticism for the way that it's approached that redress scheme and certainly the financial burden that it's imposed on firms that entered into these agreements. And I think there is certainly not a straightforward case to be made that the loans themselves were detrimental to consumers. So I do think the FCA has got in quite an interesting kind of pivot point here. And needs to think carefully about how it proceeds. So certainly an expanding remit, but not clear at the moment how that will facilitate its secondary objective.
Yeah, I mean, I have heard in conferences gone by about, I think particularly FCA enforcement has that particular tension of how do you enforce yourself towards growth. But I wonder whether there is an argument around making our market safer and making the UK a safer place to do business, I think is one of the phrases that's thrown around quite a bit. And enforcement being part of that and weeding out at least people who either the FCA would not want operating within the financial services sector at all, or at least identifying and cleaning up behaviours within more established institutions.
I think that's absolutely right, and I think we can all agree that Therese's focus on culture is welcome in that regard. But also what you had to say about swiftness of outcome and the FCA's openness to enter into early discussions with firms about perhaps in some cases, we heard her talk about the WealthTech case, resolving these cases much quicker. That is also welcome for firms who don't want to be bogged down with years of input into enforcement investigations. It hasn't always been the case, I think, that the FCA is willing to sit down and discuss scope. But if we're seeing a move in that direction, I do think that's welcome.
Great, thank you. The second theme that we wanted to explore was that of the speed, impact and deterrence. Sarah, the FCA has emphasised speed, impact and deterrence in its approach to enforcement, rationalising its portfolio, discontinuing legacy cases, which we already touched on. You've represented both regulators and regulated firms over the last few years. Has this rhetoric actually translated into real change in how investigations are conducted and resolved?
Yes, I really do think it has. If I look back to the Louise Whitestone case where I represented her in a long-running enforcement case that I'm sure you're all aware of, the JBI, Julius Barr UCOS case. That case had been under investigation for something like 6 years before action went to the RDC, and then obviously by the time it ended up in the tribunal, there'd been probably another 2 years of litigation on top of that. And that case had been beset by, and I'm not saying anything that wasn't in the public domain, it's all in the judgment, but that case had been beset by changes of enforcement personnel, changes of case teams being taken off the case and put on other more important cases or more time-consuming cases. And so it didn't have any continuity, it didn't have any imperative in terms of time, and it was really one of those cases, I suspect, that had been allowed to run into the sand. That then translated to a number of real problems that the FCA encountered in terms of the way it had conducted the investigation, and then what that led to in terms of problems with disclosure, problems with witnesses, and the like. And it was not, I would say, the FCA's finest hour, and I think if they're being honest, they'd probably agree with that. Would that happen again? The way I see things at the moment, I'm not sure it would, actually. I think that there genuinely is a much more strategic focus on focusing on cases that the FCA genuinely thinks are important and therefore are prepared to staff appropriately and bring to outcomes within a reasonable time. I think that the fact that a lot of cases have been closed because presumably they were in the bracket of cases that have been around for far too long and that a view had to be taken is a good thing. I think it is a good thing that the cases that they've got left will be properly staffed by people who've got appropriate resources to do a proper investigation. And I do think that all of that will translate into better outcomes, not just for the FCA, but in fact for firms and individuals as well. The other thing that I've already touched on is I do think there is a real genuine willingness to engage at a much earlier stage with a view to resolving matters, both for firms and individuals. And I think that, I myself, I'm not going to name names, but there are cases I have been involved in where in the old days I would have advised the clients that this was going to be a case where we had a decent argument, but that the FCA were very unlikely to wear it and that we would inevitably end up in the RDC, and thereafter we could expect probably 2 years of litigation in the tribunal. Nowadays, my advice would be, I think, different. And my advice would be, let's go and talk to them. And it may well be that we can resolve the matter in a much easier way for everybody. And indeed, we've managed to do that on a number of significant cases.
Fleur, from your perspective in managing that shift, from a kind of firm perspective, maybe in relation to recent enforcement outcomes, some of which might have been resolved quite speedily, how does that shape the approach within the industry to engagement and also internal prioritisation of issues?
Well, I think it ought to shape it substantially, to be honest. It seems like a very, as Sarah's just said, a very real shift. Sometimes one feels that the FCA says things and they aren't necessarily borne out. But I think this is a genuine entreaty to firms to engage earlier and to be more forthcoming about what the issues have been that have given rise to the opening of the enforcement investigation. There can be a temptation, I think, when a firm is under investigation by enforcement to sit tight, to let the information requirements come in, to process those, to send the responses back without really engaging on any kind of substantial level with the FCA's investigation team. And this direction coming from the top, from Therese, that actually investigation teams at the FCA should be more open and sort of sitting down with firms in the course of enforcement investigations, as I said, is welcome. I think that benefits both sides. These are very difficult investigations, very costly investigations for firms to manage. And if that process can be expedited and made more streamlined, I think that is very, very welcome.
Nick, what's your take on that?
I mean, I won't refer to any specific examples, but I would agree. Speedier enforcement outcomes, I think, are welcome for everybody concerned. Obviously, as long as the outcome is still fair, the process is fair, and they reach the right outcome at the end. I think that makes sense from the market perspective, counterparties, clients, and obviously for the FCA itself to improve the deterrence value of its enforcement findings. But for the firm under investigation, I mean, an enforcement investigation is a big deal, and senior management will be highly engaged with it. And one of the challenges for in-house counsel is how do you brief them and escalate things to them in a way that gives them what they want, which is typically some guidance about what is the outcome going to be, what will the timeline be for that, what's involved. And so I think anything that shortens that period, it may make it a more intense process, I think would be welcome for all in-house counsel and external counsel as well.
Sorry, I would just add to what I've said, that obviously it will depend on the nature of the investigation, what's being looked at, and what the firm accepts or doesn't accept about the basis for the investigation having been opened. Mm-hmm. So if you take a case like WealthTech, it was quite evident that there had been an issue with the account opening processes. But you could equally think of other examples of investigations where the firm actually feels that it needs to defend itself against the investigation, and it wouldn't necessarily be in the firm's interest to sit down and have the sort of conversation that took place in WealthTech in a different case. But I think that with the FCA's indication that it will be opening its enforcement investigations on a more thoughtful basis, that actually the bar has been lifted for circumstances suggesting, and the indication that they anticipate opening 10 to 12 investigations into regulated firms on an annual basis going forward, that you'd hope that actually that the investigations they do choose to open will be more selective, and actually there will be more basis to them than might have been the case historically.
Yeah, I mean, I think it's important that also that the FCA's desire to achieve swifter resolutions doesn't of itself undermine the point that you've just made there, Fleur, about being more maybe targeted, selective, and substantial, if I can put it that way, in their approach to enforcement. I think the previous approach of maybe opening investigation, asking questions later, clearly had its own inbuilt risk, certainly for firms, and the sheer number of NFA resolutions would illustrate that. But I think obviously keen certainly from a defence perspective, that the decisions should be swift. I don't think any firm or individual would criticise the FCA for wanting to press on with its investigation. But clearly the decision that's been taken at the end, just to echo what Nick said, has to be the right decision. It has to be the right decision. It has to be based on substantial evidence, and that evidence is being properly tested internally as well. I suppose just a corollary of that more curated enforcement portfolio, Sarah, is the increased reliance on supervisory tools with issues that don't quite make the cut. We've already had a quite perceptive question from the audience today to Teresa, and well, what happens to those cases that don't quite meet the threshold for enforcement? We've seen a dramatic increase in the use of supervisory tools, VREX, OIREX, Section 166s. These can, but are not always, particularly in the case of skilled person reports, can be swift and often more so than formal enforcement, and can actually have a very devastating effect on firms. Do you think that trend is going to continue, and can supervisory tools actually pick up the slack?
Yeah, I do think it will. I think the fact that the new enforcement guide has made clear that these sorts of things, particularly VREX and OIREX and Section 166 reviews, should sit more within the supervision part of the handbook, I think makes a lot of sense. But I don't think one should be under any illusions that the practical effect, certainly of a VREC or an OIREC, is akin to an enforcement outcome. My experience of firms that have been either A, threatened with these, or B, have been either forced to or required to enter into them, is that they can be, in effect, the end of the firm. And what that then means is that by the time there is any enforcement action, if there is any, there isn't really a firm left. And so I do think they are very effective tools in the right case, and devastating potentially in their impact. Section 166 reports, I mean, firms traditionally have always hated these for probably good reasons, but they are, I think, effective if the person that's doing the 166 review genuinely is an expert and is able to provide meaningful input, but most importantly, is genuinely able to understand the nature of the business that they are writing the report on, which I think hasn't always been the case in the past. Redress schemes seem to me to be regarded, for good reason, as a universally good thing. It's surely better that the millions of pounds that might otherwise be paid over in fines or whatever go towards compensating consumers or victims. And if firms are willing to enter into discussions that lead to a redress scheme, then that's got to be something that is worth doing. And whether that's done via supervision or whether it's done via a redress scheme such as the one that's now coming out of the motor finance litigation, or whether it's a redress scheme that's imposed as part of an enforcement either settlement, I don't think it really matters. I think the point is that a redress scheme has a very meaningful impact on perhaps the people who matter. And that in turn, I think, leads to increased good PR for the FCA. And a better understanding perhaps amongst, in particular, retail consumers that the FCA can make an actual difference, a tangible difference to them.
Thank you. I think just for the interest of time, I'll just move on to the next theme that we were going to cover. So the revised enforcement guide, as I mentioned before, has stripped out a significant chunk, some of it, as Sarah has mentioned, gone over to the supervisory part of the handbook, but nevertheless, I think some of the procedural detail has been lost. Some practitioners have noticed that the loss of granularity, as I say, particularly around enforcement referral criteria, investigation stages and cooperation expectations, risks introducing a measure of ambiguity, albeit the FCA says that it improves clarity and accessibility as part of an overall streamlining of the FCA handbook, which is now not so much War and Peace, but War and Peace Part 2, Part 3, Part 4. So, Nick, if I can come to you first, maybe from an in-house perspective, what are the challenges for firms generally in navigating this kind of shift?
I think the challenge is where there is a risk of, well, there's a number of challenges, but one of the challenges is where there is a risk of an enforcement investigation, or indeed there is already an FCA enforcement investigation, and the need to do an internal investigation, and how you dovetail those two together. And I think probably comes back to one of the themes of Theresa's talk this morning about the importance of transparency and cooperation. And so when doing an internal investigation, I think it's critical that you engage with the FCA, you discuss the scope to make sure it fits what they want from the investigation as well as what the firm needs from the investigation. Obviously, at the initial stage, it's really critical to get it right in terms of the scope, in terms of how you're going to conduct the investigation. Is it going to be done by legal counsel? Is it going to be done by non-legal counsel? Will you want to assert privilege or not? And and also engaging with the FCA on their scope. I think it was welcome that the FCA in its new enforcement guide has said scoping meetings, whilst they might not happen all the time, would happen if firms want them, and I think they are very useful, and so I think that's a welcome confirmation that they remain an important part of that that process. But as I say, I think it's about dialogue and cooperation with the FCA.
Fleur, do you have anything to add to Nick's perspective?
Well, I think Nick is quite right. I mean, I think the FCA sometimes struggles to get the balance right in terms of either too little guidance or reams and reams of guidance, which in itself can become kind of unwieldy and unhelpful. I think that the FCA's kind of pulling back from perhaps a very, very process-driven approach by removing stages in the investigation process, such as a preliminary investigation report. I do think things like that are quite helpful. They can make the FCA more agile, I think, and enable swifter resolution. So I do think in some ways that the reduction of material in the enforcement guide is quite helpful.
Mm. And Sarah, Nick's already touched upon the rather vexed question of privilege in the context of internal investigations. Excuse me. The FCA has clarified that firms are obviously not expected to waive privilege to be seen as cooperative and are still ostensibly they respect the fundamental right to assert privilege. But from your experience, how does this affect the dynamics of internal investigations and the way that firms approach disclosure and engagement with the regulator?
Well, the previous iteration of EGG said that waiver was regarded as a badge of cooperation, so waiver of privilege. And I have to say, I never really understood that, because the FCA isn't able to compel legally privileged information, and I think that most people would agree, as a matter of common law, no one is able to require disclosure of legally privileged information, and therefore it always slightly surprised me that the FCA were prepared to say that to do something that couldn't be done under the common law or indeed under FSMA was something that it regarded as being something akin to a badge of cooperation. And it seemed to me there was a tension there, and I think it's good that they've taken that out. And now what they've arrived at a position that's probably more realistic. I think that firms will always want to have the protection of disclosing an internal investigation report to the FCA under a limited waiver. And that protects them at that time. Obviously, what it doesn't do is protect them from all time in terms of disclosure subsequently, should there be enforcement proceedings, because the enforcement guide says that now that they're not making any promises whether they're going to accept in due course that legal privilege actually exists. And I think that's realistic, frankly, because if the firm has disclosed a report to the FCA, and then there is enforcement action later on in which the contents of that report are relevant and therefore disclosable to, for example, other people who are involved in the case, like individuals, for example, then the FCA have disclosure obligations. And they will then have to take a very critical look as to whether the report that they've received really is legally privileged. And for the most part, it may well not be. There may be privilege to the extent that there's advice in it, but to the extent that there's just a record of findings, then I'm not convinced that that is privileged. So the advice can be redacted and the rest can be disclosed. And that's a course that I would expect the FCA to adopt as a matter of fairness if you're coming to litigation, for example, in a tribunal. And, for example, that's what the approach that was ultimately adopted in the Whitestone case with the internal investigation report that had been done by JBI and Bank Julius Baer. So I think that where we've got to now is more realistic in terms of the way in which reports will find their way to the FCA in the first place, but I don't think change necessarily the position further down the line if things get more litigious.
Great. Well, you won't be surprised to learn that I had a ton of other things that I had prepared for the panel to go through, but we've now kind of come up to the end of our time for this session. So I might have a couple of minutes to take some questions from the floor, if there are any. Even better. Oh no, I have one.
Who's going to do that? Me.
I think she was
That's for
looking,
me.
I think
That's
she was
for
looking
me.
at
She was looking at me, wasn't she, when she said it? Well, I think yes, because different leaders will have different priorities, and they will have different backgrounds and experiences, and will understandably want to bring their own stamp to bear on the way in which enforcement does its job. And I think we've seen that with every single director that we've had, certainly over my career in financial services, and I suspect all of yours as well. So I don't think we should be surprised by it. It's not unusual. But I do think that there does appear to be a much more, potentially a more strategic focus now.
Well, personally, I think because Therese has been there for a good long time within the FCA and has obviously operated under various leaders. I think she has the benefit, therefore, to pick the best bits, probably, of the previous leaders, and can see what has worked and what hasn't. So I think she's been uniquely positioned to have that vantage point. I don't know whether Nick or Fleur would agree with that.
I definitely do agree with that. So I didn't hear the question actually, but I take it to do with leadership and influence over strategy. I mean, I think it's quite clear, and Therese, having been there for such a long time, as you say, David, that she's made a definite decision to take this course, and it does signify a really quite radical departure, I would say, from the previous leadership of enforcement, which was oversaw a huge increase in the number of investigations, and those investigations taking a lot longer to process and even to be closed. And I do detect a definite shift from Therese.
No, I mean, I agree with all that. I think also it's about, I think, Therese and Steve making their mark on the enforcement guide and the enforcement process, and getting rid of private warnings, which had largely fallen away anyway. I think is part of that, a much clearer delineation between the supervisory, more private relationship and then the public accountability and deterrence. And I think it's welcome that they're trying to make that clearer.
Great. Well, thanks very much for your question. And can I also thank our panelists for a great discussion this morning. Thank you. So we now move on to a panel discussion on the future regulation of crypto firms and how financial institutions can ensure they're not facilitating financial crime, whether through sanctions evasions or other illicit activities. Moderating the panel is Spyro Antonopoulos, Vice President of Solidus Labs Services and Investigations Team. Spyro, can I invite you and your fellow panelists to the stage?
Well, thank you for the introduction, and it's a pleasure to be here with my panelists. I will start really briefly by stating that we will speak for about 35 minutes and then leave a little bit of time for questions. My name is Spyro Antonopoulos. I'm the head of investigations at Solidus Labs, which is a software provider of trade surveillance, transaction monitoring services. We work with lots of public sector entities on digital assets, crypto-specific enforcement matters, in addition to the software services that we provide for our clients. And before we get into it, I would like for my panelists to introduce themselves, starting with you, Emma.
Hi there, I'm Emma Joyce. I head up EMEA for the Global Blockchain Business Council. We are the world's largest digital assets and blockchain business association, working with institutions, firms, regulators, and governments. Lovely to be here today.
Morning all. So firstly, thank you for having me today. My name's Nicole Sandler. I'm the Head of Corporate and Regulatory Affairs at the Centre for Finance, Innovation and Technology, and that was a body that was created off the back of the Khalifa Review to help further innovation between the public and the private sector. I'm also the Chief Ecosystem Officer at UBIC, which is a clearing and settlement system for stablecoins.
Hi everyone, I'm Sophie Bowler. I'm the Chief Risk and Compliance Officer for Zodia Custody. Zodia Custody is a digital asset institutional custodian set up and owned by Standard Chartered and a number of other banks. And in my role, I'm responsible for the implementation of the global risk management and compliance control frameworks, as well as the regulatory strategy. Thanks for having us today.
Thank you all. So just to start with a couple of premises, respecting the fact that maybe not everybody here deals with digital assets on a daily basis. You know, one, I think we're all at the point of acknowledging that digital assets won't be regulated away into oblivion. I think there was a report this morning in the FT that BlackRock is issuing an ETP with Bitcoin as the underlying that's going to be listed on the London Stock Exchange. There's half a dozen or more than a dozen ETFs listed in the US and a number of publicly traded companies that kind of have crypto as their core. So on the one hand, digital assets and digital asset firms are here to stay. But then on the other hand, and the kind of point of our panel, AML and CFT controls are still developing for the unique properties of crypto assets. Solidus Labs estimates that of the 10 trillion or so of crypto transactions in the last calendar year, something like 0.4 to 0.5% was tied to illicit finance, with about a third of that relating to sanctioned entities or sanctioned countries. That's reflected in the research of other blockchain analytics firms. And so that number, by the way, will be revised up for 2025 as a result of the large $1.4 billion Bybit hack, which the exploit had nothing to do with crypto itself, but the funds that were stolen and laundered by North Korean hackers were crypto. So with that introduction, I wanted to turn it to our panelists, maybe starting with Nicole, to maybe help us give us a taxonomy of digital assets, understanding that digital assets are not equal, and then maybe talk about the particular AML risk associated with each of these different types of crypto assets.
So I always like a little bit of audience participation on panels. Apologies. So how many of you work with digital assets, and in particular crypto assets? Let's start with digital assets. Oh. Okay, well then that means you're not dealing with crypto assets. So I'm quite visual, and I think one of the biggest challenges, there's a few, is actually what is it we're talking about? Because I was at Barclays for 12 years before I joined CFIT and UBIX, and I headed up digital policy. So I spent a lot of time talking with policymakers about taxonomies, talking internally about what a taxonomy is for the digital asset landscape, because I'd go into meetings and people would use digital assets and cryptocurrencies and real-world assets and tokenization all in one breath, and I'd sit there and I'd be like, I don't actually understand what it is you're talking about. And that's a problem, because if you don't know what it is you're talking about and you don't know how something is defined, it's incredibly difficult to actually regulate it. So I'm quite visual. So let's have a little rectangle, and that rectangle is digital assets. You've got a circle over here, which is for crypto assets. And within that circle, you've got small circles, so one for virtually unbacked crypto assets. And I imagine that actually on the panel, there'll be different terms that are used, and that's going to highlight the challenge that we have. And those are like your Bitcoins. Then you've got your utility tokens, so you've got your ethers. Then you've got what my colleague likes to refer to as your meme tokens, and then your DAO tokens. And I'm simplifying this. That's your decentralized autonomous organization tokens, your governance tokens. Where, for me, it gets particularly interesting based on my role is there is another circle that slightly overlaps with this crypto asset circle, which is new forms of digital money. We can thank the Bank of England for that terminology. Now, within that circle, you've got another circle over here for tokenized deposits. Think of that as commercial bank money, which is, wrapped digitally. So underneath that, you've got central bank digital currencies. I'm yet to see any policymakers, this is where they all agree, that will refer to a CBDC as a crypto asset. They separate that very far over. So think of that as digital cash-like. Where it is interesting is another circle for stablecoins. Stablecoins cross over both crypto assets and into new forms of digital money. I was chatting with my mum about this panel, and she was like, what is it? She still asked me what I do, which is interesting given I've done a similar type of role for 12 years. But she said to me, what is a stable coin? So I'm guessing it's quite stable. And I was like, well, Mum, actually, it doesn't have to be stable, and it doesn't have to be a coin. And she was like, that doesn't really make much sense to me. I decided not to explain tokenized deposits or smart contracts, because that was then going to be really tricky. But what it means is it could be backed by another crypto, which could make it quite volatile, or where it's particularly interesting for myself is where it's backed by fiat currency, and that would be a regulated stablecoin. And then right at the bottom, you've got your real-world assets, so your tokenized equities, your tokenized commodities, for example, your digital bonds. So I'm really fun. On the weekend, I was chatting to a friend about tokenized uranium because she works on the tokenized uranium project. But that is a very broad overview of what it is we're talking about. And on today's panel, we'll probably be talking about this circle, crypto assets, alongside the stablecoin circle as well, which is where I particularly focus. I hope that was helpful. Can I ask one more question?
Yes.
So, just because I like the audience participation, just out of curiosity, I'm going to give you a list of things. Why do you think that crypto assets and digital assets, including stablecoins, haven't moved forward, particularly in the UK? Do you think it's because of regulation? Hands up. Wow, interesting. The technology not being scalable? Legacy thinking within institutions? Well, there we go. Because I was beginning to think like there must be something. It's actually a mix of all three, and we'll be able to discuss that on today's panel. Thank you.
So I guess given the responses to the first question, maybe a quick primer. When we talk about blockchain, we're talking about a ledger that's shared by entities. The blockchain of Bitcoin and the blockchain of Ethereum is a ledger that's kind of shared by the world computer. It's public, it's decentralized, the transactions are visible to all. And one of the kind of common tropes, at least for those of us that work in compliance in digital assets, is that in some ways this decentralized ledger, these decentralized ledgers should be a boon towards financial crime supervision and enforcement because they're public and because the transactions are forever traceable and on this public ledger and visible. And so I want to ask my panelists, starting with Sophie, how does this kind of trope play out in reality? How easy is it to supervise and to run a compliance program for crypto assets given the kind of permanent and immutable nature of these transactions on-chain?
Yeah, so for someone that's worked in traditional finance and now in digital assets, for me as a compliance officer, the fact that transactions are etched on a public ledger enables you to have a much more informed decision-making process with respect to the financial crime risk exposure, because you've got many, many more data points about the clients that you're dealing with, the counterparties that they're interacting, where the assets have ultimately come from and the different wallets that those have gone through in order to form that view. So, for example, in traditional finance, if you want to understand the transactions that your client's interacting with, you may have to get documentary evidence, you'll have to get information from the client, but you can actually see all of this on the blockchain with respect to digital assets. So it really helps inform that decision-making process. And if I give an example as to how we apply these controls in practice, so for example, in Zodia, if we were onboarding a client, first and foremost, as part of the KYC process, before you've even made a decision as to whether you want to engage with this client, you will utilize blockchain analytics in order to pre-screen the wallets that the client owns, as well as the wallets of the counterparties that the client wants to interact with. So you can pre-screen these and get a view of between 20 and 30 different financial crime data points that potentially you could be exposed to. And of course, you wouldn't necessarily be able to get this view in traditional finance. So I think having that upfront view is really, really incredibly helpful. And then as well, at the time of transaction, the blockchain analytics will run, and again, can give you the up-to-date view of what's the exposure, for example, that these counterparties that your clients may want to be interacting with. And then on a retrospective basis as well, because blockchain analytics firms are always building out their data sets. So it may be that a year ago, a transaction that happened a year ago, they then identified that that transaction was interacting with, I guess, a wallet that was exposed to .NET markets. And then you can bring those data points in to form your view of the client and the transaction history. So really, 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 really beneficial. However, of course, I will always talk about the challenges as well. There's always some challenges. So I think a few key ones that call out to me: unhosted wallets. So this is ultimately a wallet that is not hosted by a crypto exchange, such as, a Coinbase. This is a wallet that ultimately of course, has not gone through the KYC process, but it is incredibly normal. Many institutions have unhosted wallets, but you need to apply additional verification methods to work out, is it actually the client that's behind that wallet? Who is behind that wallet? I think exchanges as well on the blockchain, often when you're tracing funds through crypto exchanges, you can lose the trail, because crypto exchanges use lots of different sort of wallets where they pool client funds into. So often the assets that may go into those wallets may not be the same ones, so that obscures it. And then I think finally there's a few different, various different entities on the blockchain. For example, KYC, exchanges that don't apply KYC, or you will have mixing services, which can be utilized by illicit actors to sort of mix up their funds. So things like that make it a bit more difficult. But I think overall, for me, there's many, many more benefits from a financial crime risk management perspective as opposed to traditional finance.
Thank you.
Can I just add something? So I think it's really interesting you brought up the unhosted wallets. So for those in the room, that is a particular area of focus for policymakers at the moment, how they would deal with unhosted wallets, whether we should actually be having hosted wallets, for instance, within financial service firms as a new way potentially for them, a new, I don't say new business model, not a new business model, but a new product that they could be offering. And I think one of the biggest changes, and I would really appreciate Emma's view as well on this, is the shift between what policymakers have thought when it came to private permissioned blockchains, which is what we've seen a lot of in financial services in terms of pilots, et cetera, over the last couple of years, and the shift now to actually looking at public permissionless. And I would have said a year ago that change wasn't very prominent, but now you'll go to lots of different meetings, lots of events where that is a topic of conversation very, very frequently.
Yeah, absolutely. I mean, we're seeing that more and more. That is definitely where the conversation is going, and it'll be interesting to see how that develops. I'd agree with almost everything that was said, and I think when we're thinking about sort of the trope that compliance should love crypto because it's all transparent, part of that is true. There's a part truth in there, but really that is a myth, because public ledgers offer huge transparency. Every single transaction is time-stamped, it's permanent. In theory, it's a compliance dream, but actually transparency isn't the same as clarity. And so you really have to understand, without attribution, you're just sort of staring at a sea of data. So blockchains give us light, but it takes good judgment to see clearly. And I think we'll discuss this more with further questions, but it's a mixture, isn't it, between the technology and the people.
Absolutely. And maybe to linger just on the kind of practical aspects of it, and open this to all my panelists, maybe starting with Emma. What are kind of the practical challenges of knitting compliance across kind of these on-chain flows and maybe fiat rails for things like source of funds analysis? Is it truly kind of two independent sides of the brain and independent techniques, or what sort of works in practice, given that the world doesn't live entirely on chain, but it's interacting with this traditional finance system and payment rails?
I'm not sure I'm a good one to answer that, actually. I think that might be better for someone that's more deeper in it than me. It's a little bit difficult to look at it from a, I don't know. Who wants to go first?
Sophie, you want to try?
Yeah, I mean, I can have a go. Obviously, Zodia is pure digital assets, so we don't deal with fiat rails. But I'm minded to think. So obviously, you look at fiat and you look at transaction monitoring and identification of suspicious activity in traditional finance. You will have your post-transaction monitoring tools, which is identifying the patterns of behavior that may be indicative in money laundering typologies. Of course, you also have that in crypto as well, but supplemented by blockchain analytics. And I think one of the challenges that firms have and what firms are trying to do now is make sure that those insights are integrated together, so that you would have your insights from the fiat rails and the crypto rails, and try and pull that together as to an overarching client view. I think that's what firms are trying to do, but they're still sort of working through that.
Do you think today's kind of traditional transaction monitoring typologies are sufficient, or have you incorporated new kind of risk typologies, other than kind of the attribution side, which this address is attributed to a sanctioned entity, different behavioral typologies that you're looking at?
Yeah, so I mean, we've implemented post-transaction monitoring for our crypto transactions, and some of the traditional typologies do get us quite far, but I think with crypto there are some additional ones that you need that are a bit more sort of relevant to crypto. So it is very much supplemented with the baseline traditional typologies and then some additional ones for crypto. So we implemented that some time ago and are constantly refining it. So yeah, absolutely.
Great. We'll actually get back to data and different data points in a second. I wanted to kind of focus on stablecoins now. So stablecoins, often called kind of the one application of blockchain and crypto where there's finally kind of universality in utility. I think Allium and Visa has a dashboard where they estimated that in the last 30 days there was something like 240 billion in stablecoin transactions. The overall market cap of stablecoins that have been issued by entities like Circle and Tether is around 160 billion right now. So stablecoins are here to stay, but stablecoins are also, they suffer from this issue of being, the benefit of being permissionless and on decentralized rails, but also the risks there. But we've started to see regulatory bodies try to wrap their arms around this, from the Genius Act in the US to the Hong Kong Monetary Authority and, of course, MiCA. So I'll turn to you again, Emma, and then Nicole and Sophie, of course, to talk about the new regimes and where you think we are right now, where you think we will be, where you think the FCA will land, and then kind of broadly speaking, what are the gaps right now introduced by the fact that we're still not in a fully harmonized world from a regulatory perspective?
Well, I mean, I think let's start with harmonization. I mean, harmonization doesn't mean, it's not about identical laws, it's more about compatibility. And I think that's what we're seeing, maybe moving towards. Firms can navigate different thresholds, but what kills efficiency really is an inconsistency in sort of definitions and data structures. So when, we, at GBBC, we cover, 100, over 100 different jurisdictions and talk to different regulators and central banks in those places. And so, we talk a lot about harmonization, and it's not something I think we're, getting close to or really is ever going to happen. But, you know, it's talking about that compatibility. And so we see, I think we're seeing that, we're certainly seeing that more. There's, you know, what we need, I think, is sort of mutual recognition of AML frameworks and shared data standards. And so I think, you know, that sort of cooperation would be very, very important. You know, ultimately, stablecoins are where, you know, digital and traditional finance truly converge. And so, you know, they obviously combine the efficiency of crypto with institutional responsibilities of banking. And, you know, you've got MiCA, HKMA, the UK's forthcoming regime, all attempting to sort of graft AML and sanctions rules into this hybrid model. And so that requires reserve transparency, redemption rights, and ongoing monitoring. But, you know, there's friction points, of course. And so, you know, jurisdictional leakage, you know, an EU-compliant stablecoin can instantly circulate through an unregulated offshore exchange. You know, data asymmetry, on-chain movements are global, but regulatory visibility stops at the border. So I think closing these gaps requires, you know, standardized reporting formats, interoperable travel rule implementation, and real use attestations of, you know, so both reserves and counterparties. And I think we're certainly getting closer. You know, 5 years ago, all we were talking about was regulatory clarity, and we've got that clarity to some degree. It's now about, you know, bringing those regimes, you know, to make them operational together.
So I guess one of the questions I often get asked is, why do we care about stablecoins now? Like I said, I've worked in this space for over a decade. And actually, when I was at Barclays, we had a patent for a stablecoin back in about 2017, 2018. It's public knowledge that we had a patent, but Barclays didn't move forward. So when I started looking at stablecoins, both at CFIT and at UBIX, my father said to me, it's like, you know, why do you want to go and look at this space? Like, why now? Because when I was discussing roles I might want to do, stablecoins didn't really come up in the discussion. And I said, well, because the world has now changed, because respectfully, Donald Trump got into power, and Donald Trump turned around and said, I don't want to have a central bank digital currency in the US. I want to have stablecoins, and I'm going to, he didn't use this wording, flood the world with US dollar stablecoins. And the reason that he wants to do that is because he wants dollarization to go up, because if a US dollar stablecoin is coming into your jurisdiction and at the moment you can't convert it into a local currency, great for the US dollar, not so great for other currencies. Also diversifies government debt, and it helps just of economic strategy, essentially. So there's been a real push for why stablecoins have become more prominent. But on the flip side, I feel quite sorry for the Europeans, because actually they've been looking at stablecoins for much longer than the US, particularly from a regulatory perspective. I decided not to ask you another question, but I often ask, like, which jurisdiction do you think is most advanced in regulation for stablecoins? And often the US will be the hand that goes up first. But actually, they've been much slower than the EU had been. So back in 2018, 2019, 2020, I was on an expert group, I'm going to say the name once because it takes up the whole panel, called the European Commission's Regulatory Obstacles to Financial Innovation Expert Group, ROFIEG. I know it's I don't know what they were thinking. But during that time, I don't know if any of you will recall, Facebook Meta announced that they wanted to launch a global stablecoin. This didn't go down so well with policymakers across the globe because they were very worried about a non-regulated institution launching a private currency that could become global. So I hear a lot of complaints about MiCA over the years, and one of the complaints is that it's not very friendly to global stablecoins. And I say, well, you have to go back and think about why a regulation is created. So the Genius Act is created to make it easier to have stablecoins, fiat-regulated stablecoins, because as I said earlier, there's different types of stablecoins, payment fiat-regulated stablecoins. Makes it easier for them to operate. MiCA, on the other hand, was like, we want to make it not difficult to operate. We want to make sure that we're protecting the consumers and that we're keeping localization within the EU as well. We don't want to have a dollar stablecoin. So the complaint I hear is we're not so keen on MiCA. Also, it's very difficult for smaller firms because it's got lots of compliance requirements. But I go back and say, well, why was it created? It was created to prevent prevent things like the Libra proposition, which is what it does. The challenge you have for the UK is which regulation are we going to go closer to? Are we going to go for more of a Genius Act regulation? And within both of these regulations, you'll have things that will look at the reserve, so making sure that it's reserved backed, so for instance, by high quality liquid assets. How do you redeem? What is the redemption? What should be redemption at par? What are the AML, KYC, and sanction requirements? So under MiCA, there is a travel rule. Under the Genius Act, it doesn't link to the travel rule. If you were to go to Hong Kong, to be fair, it's actually probably the most strict when it comes to AML, KYC. But those are the sort of things that in the UK we need to think about. Where are we going to land? Are we going to align ourselves more with the US? Are we going to align ourselves more with the EU? There is the new working group, the Transatlantic Committee between the UK and the US, which makes it look like potentially it might move more towards a US regime. But one of the challenges, and this got mentioned by Sophie, none of them really focus on unhosted wallets. And that is a challenge, particularly from a KYC, AML and privacy perspective. So I think there does need to be more work across the different policymakers. And on the harmonization, yes, it would be ideal if there was more harmonization. I'm a pragmatist at heart. I don't think that, you can already see with MiCA and with the Genius Act that they're not harmonized, although there is some overlap. I don't think we'll get full harmonization, but it would be very useful for firms to be able to not have competing regulations and competing compliance requirements, and for you in the room as well to be able to deal with regulations which aren't so dissimilar.
Yeah, I mean, I can just add briefly onto that, just purely coming from a financial crime perspective. Harmonisation of financial crime laws, we don't have that in traditional finance anyway, so we're not going to have it in crypto. Of course, the FATF tries to get us there, but we can't sort of expect full harmonisation. It's just sort of the reality of it. I think one thing I would say is when we talk about specific financial crime controls with respect to crypto, so we've already spoken about the use of blockchain analytics. How do you interpret what's on the, what's in the data set, what you're seeing? How do you do the investigations there? That's where we still haven't got, I guess, regulatory guidelines or clarity around how exactly you do that. Do you look down 10 wallets, or do you stop at 5, or how far you go down? That's definitely an area that's sort of really welcomed, and compliance officers really welcome that from regulators, because we're sort of still in a bit of a phase now where we're trying to work out what's reasonable for ourselves. And of course, Nicole mentioned unhosted wallets, which brings us on to the travel rule, i.e. sending information on the originator and beneficiary with crypto transactions. Really easy to do in traditional finance because you've got a SWIFT network and the messaging system. You do not have an equivalent in crypto at the moment, so you're heavily reliant on a multitude of different vendors in order to, to pay these vendors like quite high cost in order to enable them to send these transactions. So that's a real difficult area for firms, and as part of that, again, it's the unhosted wallet verification, which Nicole mentioned. That's still quite challenging, and it's still not been built out further. And I think this is just an area where we'll see probably a bit more regulatory action and things moving forward, which will be really welcomed.
Thank you. And I'm not going to take a poll, but how many would be surprised to hear that the 13th largest holder of U.S. Treasuries is a crypto company named Tether? So this is one of the reasons that stablecoins also started becoming, in addition to the fact that Meta or Facebook had, I don't know, 1 billion users at the time and were starting to financialize, and that scared regulators. The fact that companies like Tether were becoming so systemically important was one reason the U.S. Fed started getting interested and concerned with stablecoin policy, and ultimately kind of led us to where we are. Talking a little bit more.
Can I just add something on the Tether point? Tether wouldn't be caught by the Genius Act. It's not a fiat-regulated stablecoin. They will have to create another stablecoin if they want it to be caught by the Genius Act and be a regulated stablecoin. I just think it's worth flagging because Tether comes up a lot in conversations about AML, KYC, and stablecoins, and I think it's important to differentiate between those that are caught by a regime and those that still wouldn't be caught by a regime. Right,
and Tether actually has also frozen the most wallets due to DOJ requests as well, even though they're kind of outside of this regulatory framework, which creates another interesting dynamic. The FCA released guidance in January 2025 And one thing they noted is that automated transaction monitoring systems in isolation provide limited success. And then in another guidance on market abuse, it was noted in 2025 that many stores were filed for suspected cases of money laundering, but those stores originated with market abuse detection. So a general question to the panel, kind of, again, getting back down to brass tacks, given money laundering risks in cryptocurrencies, what other data sets outside of just the transactions should we be looking at, do you look at as practitioners to help kind of form a more holistic surveillance and monitoring program? Emma?
Well, I mean, firstly, I'd just say that I think the FCA is right. You know, I don't think automation alone does deliver full insight. You know, the highest value alerts often arise when AML and market abuse surveillance intersect. And so I think a market abuse might reveal insider trading funded by illicit flows or vice versa, but you know, really digital assets sort of amplify this overlap because trading and settlement happen on the same rails. So you can't always meaningfully separate one from the other. So, you know, technology will always be a part of the answer and is going to be very, very important going forward, but human interpretation and I think cross-disciplinary collaboration are really what transforms that detection into prevention.
Yeah, I think the collaboration point is really important because no firm can really do this alone, which is why it's really important to have a number of different firms within the market to be supporting. I mean, it's a challenging area, but what I would say, and I say this respectfully, I did an event a couple of weeks ago where AML KYC kept coming up and liquidity kept coming up as questions on stablecoins in particular. And there are challenges that exist, and the regulation does need to make sure that it gets it as right as possible. I say as right as possible because no regulation is perfect. That's the reality, and new challenges will come up. But a lot of these challenges also exist in the current market. When you're thinking about data points, that you can have more data points because of the technology and you can have more data. But sometimes we talk about these assets as if they're totally new when actually a number of them existed for ages, and the risks are totally new. They're not. Firms have very, very clear and strict risk protocols, particularly like when I was at Barclays, extremely strict, and for the reason that they're there to manage risk. So the risks are exasperated, but often they're not entirely new. So I think it's also taking the lessons from the past and taking it forward, and not thinking of this as an entirely new problem.
Mm-hmm. Yeah, I completely agree. It's definitely not a new problem, and the reference of TM systems in isolation provide limited success. Absolutely, because you're just looking at one data point. You need to be pulling data points from across the sort of client landscape. So KYC, screening, IP and location monitoring is something that we implement in digital assets and is incredibly useful to understand, you know, where your client's located. Of course, blockchain analytics, and it's forming that holistic view of the client activity. So, but to be honest with you, you know, I was in a conference recently, and we was in a leaders meeting with some of the biggest banks and the financial crime leads there, and they, you know, the most mature banks in the world, and they said, we're still looking in silos. We still can't pull that data together. Because, of course, these are globally dispersed banks with huge teams all over. How do you get your screening team to talk to your transaction monitoring team, etc.? So it's just, I think it's just a well-known problem across the industry, but we're hopefully getting there, but I think it's still a bit of a way yet.
Wonderful. I think we're close to time, and I similarly have a number of questions remaining, but I will pause there, and I think we have time for maybe a few questions. Great. Well, then I will take an opportunity to ask one final question, and maybe we can do a quick lightning round. So data sharing, of course, we talked about it, but what's your North Star for kind of a compliance program in the future? Do you envision kind of a regime that looks like more SARs and more stores just kind of digitally filed, or one that involves more data sharing, more behavioral analytics that are driven by AI. I'll start with you, Sophie, on kind of what the North Star is 3-5 years from now.
Yeah, so I mean, it's just what I sort of said, bringing all those data points together and having that overarching view of who your client is and what the financial crime risk exposure is, and also on a perpetual basis. So we hear a lot about perpetual KYC, perpetual TM, but actually that risk rating and the risk view continuously being updated and informed. Hopefully AI will help, but I feel like, again, we're still a little bit further away from that. But yeah, that one view, everything connected together using all the data points would, for me, be where we improve the effectiveness.
I mean, I absolutely agree. So I'm going to take a slightly different angle and just go in 3 to 5 years' time. I think the UK has a real opportunity. We often complain that we've been very slow in this space, and I say that respectfully because we have been slow. But actually, what it means is we're able to look at two different regimes, both with MiCA and with the Genius Act. And obviously, you've got Hong Kong, Singapore, UAE. There's lots of different regimes that are being formed. And then we can say, where do we think it's right and where do we think it's wrong, so that we can create a framework that actually makes businesses want to operate in the digital asset space and make firms want to come to the UK, because that will help with economic growth. That will also help with us exporting, and it'll help with our currency. When you're thinking about, if you've got lots of stable coins coming into the jurisdiction, you want to have stable coins going out of the jurisdiction as well. So I'd like a regime that actually works across the board, and conversations with different policymakers so that where it can be aligned, it is aligned.
Yeah, and I would agree with all of that. And I think going back to Sophie's North Star, completely agree. And yeah, that is, I think, definitely where we want to be. I think to get there, though, there's a few things we need. So we need legal clarity, we need standardization, and we need a cultural shift from reactive enforcement to collaborative prevention. I think then we can get there.
Great, thank you. And please welcome me in thanking our panelists.
Thank you very much, Spiro, Sophie, and Nicole. We now have a 25-minute or so break for coffee and networking. Please can I ask that you come back to the room in time for the kick-off of the third session at 11:30. Those of you joining remotely, please take the opportunity to go away and stretch your legs, have a cup of tea. And just to remind you all that the event app on Eventi, hopefully you got the link to that sent to you, can be used for networking and also to review the agenda for the remainder of the day. Enjoy coffee. Thank you. Well, I think we're just about quoted. Welcome back, everybody. Hope you had a good time for coffee. Just a brief reminder, and typically I've forgotten to bring it up with me to the lectern, but the questionnaire and feedback form that's on the desks, City and Financial would love for you to complete those before you leave today. It will greatly help to shape future conferences and ensure that they're completely on point. I'm delighted now to welcome Chris Ninan and Christine Young, partners at Herbert Smith Freehills Kramer, who will be presenting on developments in personal responsibility and the impact of the proposed changes to the SMCR. Chris and Christine, the floor is yours.
Thank you all. My name is Chris Ninan. I'm a partner in the Financial Services Regulatory Group at Herbert Smith Freehills Kramer.
And I'm Christine Young. I'm a partner in the Employment Group. So we're sort of tag teaming today between the employment and regulatory.
Absolutely. And we're here to talk about the developments in personal responsibility and the impact of the changes in SMCR. Obviously, the interesting bit is what those developments mean, but let's talk about what they are very quickly. So on the left of the slide, you'll see the changes that are in progress, and there's a few that are of particular interest. So amending the 12-week rule to make it 12 weeks to submit an SMF application instead of 12 weeks to get a decision. And the SMF 7s now apply to controllers and representatives who have significant influence over a firm and its day-to-day management or conduct. That's just for PRA firms. Changes to SMF 18 guidance, which is expected to reduce the number of SMF 18s at firms. The FCA has also said that it will reject applications or push back when people are inappropriately when they inappropriately seek to be SMF 18s. And then on the right of the slide, you've got the things that are due to change that are part of the Treasury consultation. The one that everyone's very excited about is the moving of the certification regime from legislation to the rule books. And that's likely to mean more simplification, and some suggest potentially the removal of the formal certification regime. But it is all change, both that's ongoing and both that is expected. But the plan is to make everything simpler and more flexible, less pre-approval, simplified statement of responsibilities, and so on.
So just turning to what the changes are. So back in July, we had the publication from the FCA of CP 2518. So that was tackling non-financial misconduct in financial services with a policy statement on changes to COCON. So we've been eagerly awaiting this since the previous consultation back in 2023. And this latest proposal takes account of the feedback they received the last time. The FCA is also consulting as part of this on the introduction of guidance for COCON and VIT, and it's fair to say, having spoken to the clients we have, they are keen to have the introduction of the guidance that is being mentioned by the FCA, given this is a difficult area to navigate. The consultation in relation to that has now ended. That was on the 10th of September, as we're waiting to hear the FCA's response to that consultation. But the proposed timings are that the changes to the rules would take effect from the 1st of September next year. We expect the final rules by year end. So what are these proposals? So the FCA has used the proposals to level the playing field, in its words, in relation to banks and non-banks by aligning the type of conduct that would fall within COCON. So in other words, taking into account the fact that all activities of banks are relevant for the purposes of COCON as opposed to financial activities of non-banks. What they've said is non-financial misconduct in relation to colleagues, other people in a group of companies, and as well as people who provide services would be caught for the purposes of COCON. Importantly, they've included a definition of what is non-financial misconduct for the purposes of COCON. And what it includes is harassment, but not limited to protected characteristics, so not limited to sex, race, religion, disability, age. And bullying and violence. So harassment, bullying and violence are meant to be part of that definition. The definition is very similar to the definition of harassment under the Equality Act, but again, without that protected characteristic overlay. So it talks about unwanted conduct in relation to an individual that has the purpose or effect of violating someone's dignity or creating an intimidating, hostile, degrading, or humiliating or offensive environment. And then the second element was violence to a person. So that doesn't actually mention bullying. The bullying is referenced in the commentary on the proposal, and bullying isn't a defined term under English law, so, but we understand it's supposed to cover that as a theme. What it doesn't include is discrimination or victimization. That is explicitly referred to for the purposes of making an assessment of fitness and propriety, but not for the purposes of determining a COCON breach. It also needs to be sufficiently serious. Well, that makes sense, but what is serious? The original proposals from 2023 did include some guidance on that. It talked about inconsistency with a good working environment, and it gave examples of if someone was intimidating someone else or was seriously offensive, malicious, or insulting conduct. So quite a high threshold there. Now that guidance and those examples have been dropped, so they are not in the current proposal. So it's silent on what amounts to serious. It does require, it is a subjective and an objective test, so it requires the individual who's the subject of the harassment or the violence to feel that they have been harassed or subject of that violence, and a reasonable person would think that has happened. So someone who's overly sensitive, that wouldn't necessarily fall within the objective test. So the other key point is that COCON doesn't apply to matters in someone's private or personal life, in contrast to the assessment of fitness and propriety, which would be relevant. Private life would be relevant consideration if the relevant behaviour would go to fitness and propriety. There's original proposal had a lot of examples of what amounts to private life, because it's actually can be. Sometimes it's very obvious, sometimes it's not so obvious, particularly where there's a continuing course of conduct. So, for example, the work Christmas party is in scope. The after party was out of scope, now could be in scope if the senior manager is the one who encouraged it. So if the manager is telling everyone we now got to go off to an after party, then it might be considered for the purposes of COCON as still caught if some misconduct happens in the context of that. It's fair to say the area is not a bright line and is quite difficult to navigate in practice often. In terms of personal responsibility, managers may be caught by these arrangements if they fail to operate the firm's policies, systems and controls to detect or prevent the misconduct, or they've not intervened to stop the behaviour, or they've failed to take it seriously or deal properly with a complaint, or failed to provide a safe work environment. So there is certainly a question there about what steps a manager is expected to take. In terms of the firm, there's an interesting link or similarity with the duty to prevent sexual harassment, which is an employment law obligation on firms since October last year. And that's a duty to take reasonable steps to prevent sexual harassment in the organisation. Now, that's obviously limited to sexual harassment, not just any harassment. But you can see the potential for sort of a mirroring of what is the firm expected to do, and is the individual manager aligned with that? It's clear to say COCON is different from the employment law position. So just because someone may have breached this non-financial misconduct under COCON doesn't mean that has the same outcome from an employment law perspective. It's entirely possible someone could be disciplined from an employment law perspective and it doesn't amount to a COCON breach. And the FCA accepts that this is a different standard. So you will still have two processes, two separate standards being for the individual. The fitness and propriety assessment is also wider. It will cover potentially things in your private life, and will cover discrimination and victimization to the extent it's considered relevant for that assessment of fitness and propriety. What that doesn't mean is that firms need to start monitoring employees' private lives. I'm sure they would take issue with an Article 8 right to a private life. But having said that, if the firm becomes aware of something that could be relevant, then they would need to consider whether it was appropriate to look into it and do a reasonable investigation. The FCA's guidance talks about concluded decisions. So, for example, if there was an employment tribunal judgment that made reference to an individual and their conduct, that would obviously be relevant even if that happened outside of their private life from a fitness and propriety perspective. So in terms of personal responsibility, those caught by this new definition, it's going to be a subset of things that the individual would already probably have been disciplined for anyway. So in terms of actions, there are already some consequences. It's just that from a COCON perspective, you may well have a COCON breach as well. And managers will need to act reasonably to avoid a breach, which really is looking at your policies, complying with them, making sure that complaints are dealt with properly, and intervening if something happens. So that's my takeaway of the proposals.
Thank you. So we've got through what's changing with SMCR generally, what's changing with SMCR from an NFM perspective. We're now going to talk through some of the enforcement cases involving individuals, and after actually several years of there not being very many, particularly related to COCON, there's been a few this year. In a banner month, July seemed to have the main spate of both firm and individual enforcement cases for those who care about these things at the FCA this year. Before we go into those, I thought it'd be useful just to set the scene and explain how many cases we're talking about and what's happened when it comes to enforcement more generally. So clearly the bit in red's the most important. But there's 130 open investigations as of, I think, spring this year, which is the last figures the FCA has produced. 105 of those are into firms, 25 of those are into individuals. 23 of the individual cases are COCON cases, which means there are 2 other ones involving individuals, but not COCON. The first case we're going to talk about is Neil Woodford. So you will all remember what's happened with him. There's a decision notice in place for Mr. Woodford. He's referred that to the upper tribunal. That got issued in that month of July alongside a decision notice for Woodford Investment Management. The FCA is seeking to impose a penalty of 5.88 million, a prohibition order for a breach of APA statements of principle 2 and 6, so the sort of due skill, care and diligence type arguments. I think we probably all know the Woodford story, so I won't go into it in a huge amount of detail, but it involves the WAIF Fund, the Woodford Equity Investment Fund, which had over £10 billion of investments in 2017. Woodford was the investment manager via Woodford Investment Management. He made investment decisions for the fund and invested in illiquid stocks that couldn't be liquidated in the time frame required to meet redemptions according to the regulatory rules and the risk rating of the funds, which was medium risk. This is the FCA's case. The FCA's case is all about liquidity risk, so that those are liquid funds and the ability to liquidate them in order to meet redemptions. The value of that fund went to about 3.6 billion by 2019 and was then put into liquidation. And the FCA says by the end of the process, only 8% of the investments in those funds were able to be liquidated within 7 days. And that is not the medium risk appetite that was advertised to investors. Woodford was the owner of Woodford Investment Management, as you may expect. He was the investment manager of the fund. He was the head of investment. He was the lead fund manager, the designated risk owner. He was at CF1 and CF30. So the FCA says what happened at the WAIF was his responsibility. Clearly, because it's been referred to the tribunal, Mr. Woodford disagrees. So he sees his role as managing liquidity within a framework that was set for him by Risk and Compliance and Link, which was the ACD of the fund, rather than to challenge those particular requirements. He said it wasn't for me to ask questions about this. Where there was an issue, it was for Risk and Compliance to draw it to his attention. That said, if those frameworks rubbed up against his investment strategy and stopped him from doing something, he would tend to get involved at that stage. The FCA disagrees with this. The FCA says a responsible professional should not disregard risk because he doesn't consider it to be part of his role. And Women Woodford put all of the blame really on Link's decision to liquidate the fund in October 2019, which is interesting because Link, as you will know, was required to provide a large amount of redress by the FCA for liquidating the fund too late. So the FCA's case there was the ACD should have done it sooner. We had some involvement in this, so I won't talk about it in too much detail, but just to say there was clearly a fundamental disagreement between the regulator and the individual and the investment manager on who was responsible for managing liquidity. And if you look at Annex 5 of the notice, which contains Woodford's reps, it is interesting. He blames everything on everyone else, so Link, the ACD, the FCA for knowing what was going on the whole time and not stopping it. And he also claimed to argue that the rules around liquidity and so on weren't applicable to him as the investment manager. They applied to the ACD, they didn't apply to the investment manager. And the FCA's case on that is they also applied to him as an approved person, but also because of a contractual arrangement in the IMA between WIM and Link. So it's clearly a case where a dominant personality, I mean, his name is all over it, has pushed their view over others. And you can see cases of the ACD and others raising concerns, but being pushed back. Interestingly, from an individual's perspective and thinking about how to act for your own clients, or if you're one of those people, one of the big issues the FCA had in terms of its prohibition, or one of the main reasons, was that Woodford hasn't expressed any contrition. You can see why he wouldn't if he's challenging the whole basis of the decision notice. But the FCA's case is clearly, if we don't prohibit him, he'll just go and do this all over again because he takes the view that he's done nothing wrong. So we'll see what happens at the upper tribunal. WIM also faced a decision notice, as I said, and a £40 million fine for a breach of Principle 2. So the next case is Jean-Noël Alba. So that's the H2O matter. There was a final notice of that last year in August. An H2O breached Principles 2, 3, 11, and some COL rules relating to systems and controls. It was the authorised fund manager of a number of funds which made over £1.5 billion worth of investments into entities controlled by a single individual. That single individual, Mr. Windhorst, was linked to the CEO of H2O. Lots of investor redemptions, a drop in value of the funds, suspension of some of the funds. So H2O had a public censure and agreed to pay around £250 million back to unit holders. Alba was the co-founder of H2O, was the CEO, later deputy CEO. He held roles under the approved persons regime and then SMCR that related to being a partner and having compliance oversight. So he was involved with all of the breaches. He was also involved in the P11 breach, which the FCA found particularly egregious. So he amended, and this certainly happens in a number of cases, he amended committee minutes and other documents that were provided to the FCA. He gave due diligence materials to the FCA that gave the impression that they were contemporaneous when they were made after the event. So breaches of integrity, dealing with the FCA in an open and cooperative way, so now Individual Conduct Rule 3. So that was a prohibition and a fine of just over £1 million after discount. I said we all know about Woodford. I think we probably mostly know about Jess Staley and what happened to him. So the upper tribunal judgment was handed down in June. It dismissed the reference and upheld the decision to prohibit him from performing any senior management function. So the FCA's finding was that he acted recklessly and with a lack of integrity when it came to approving a letter from Barclays to the FCA explaining his relationship with Jeffrey Epstein. The letter said they didn't have a close relationship. In fact, there were comments about them being the deepest and most cherished friend, and they'd ceased contact before he'd joined Barclays when he was in touch with Mr. Epstein in the period going up to it. So the upper tribunal agreed with the FCA. The statements were relevant to fitness and propriety. They were inaccurate. Mr. Staley knew or was reckless as to whether they were inaccurate. And so they agreed he breached Individual Conduct Rule 1 about integrity, his cooperation obligation under Individual Conduct Rule 3, and the reporting obligation under Senior Manager Conduct Rule 4. So a fine of £1.1 million, reduced slightly because of shares that were now not going to vest from Barclays. The next case is quite a simple one. An upper tribunal, a decision notices from 2022, which went to the upper tribunal, and the upper tribunal imposed fines of, listed up there, 223,000, 100,000, and 57,600. So three chaps who traded in Italian government bond futures. They used spoof trades on 233 occasions on Eurex It was a familiar trick. You place big orders on one side that are visible, that you don't intend to trade because they're off the touch, they're cancelled quickly, and you place smaller orders, the ones you actually want to hit, on the other side, which are frequently iceberg orders. So it sounds quite a lot like Carlos Abatista, which you might remember from 2020. So a breach of Section 1185 of FSMA and then Article 12 and 15 of MAR, it sort of crossed the period of MAR implementation. The trader said rather than doing something problematic, it was all part of an information discovery strategy, also quite similar from Abatista. So they were looking to see with their large orders what was available on one side of the market. They're very happy for those orders to be hit. And if they were hit, it would give them some information about the depth of the market. The FCA disagreed. They never were hit. The strategy didn't match what they did because they were withdrawn within seconds, and everything on the opposite side, the small orders, were hit. The FCA said the unusual shape and size of the large orders were manipulative. They placed more of these than anyone else in the market, despite the bank they're a part of being a very small participant in Italian government bond futures. As I said, almost none of the large orders were executed, but most of the small orders were, and they seem to be acting together and in concert. So this is pretty common. It's a pretty common strategy. We've seen it a few times. You've probably seen it in matters that haven't got to the FCA. But interestingly, one of the arguments, as I said, was that they were using a legitimate strategy that was not manipulative. And the FCA's response to that was what I said, but also that there was no documented rationale at the time that suggested they were doing this. This was all after the event. And clearly it may be the case that you can do something that is quite an interesting strategy that is not technically manipulative if you actually intended to do it at the time. I'll run through the Metro Bank individuals case, and then we'll talk about some lessons learned. So this is interesting. I think it's Craig Donaldson, the former CEO, and David Arden, the former CFO of Metro Bank. And you'll recall that Metro Bank breached Listing Rule 1.3.3 in the way that it disclosed its risk assets. The individuals were held to be knowingly concerned in the breach, so they have to have been involved in the contravention, knowledge of the facts on which the contravention depended, and it was immaterial whether they had knowledge of the law unless they were receiving independent legal advice, that everything that they were doing was fine, and that was based on a complete and correct factual matrix. And in this case, the individuals were very clear that the reporting that they were doing was in breach of the listing rules. They had some arguments about it, that they weren't allowed to report the correct numbers, that they were relying on legal advice from a firm, but those excuses were not held to be correct. In particular, that the legal advice was based on limited information. The bit that's interesting from that, I think, is that at the upper tribunal, the individuals claimed that they cooperated and should receive a discount for this. Their cooperation was attending interviews and answering questions from the FCA, which I think all of us think they're meant to do, but the FCA, the upper tribunal gave them a 25% reduction in penalty. I'll leave Hambro because it's not terribly exciting, and I've got 2 minutes left. So what do we learn from all of these? So one is, don't name a fund after yourself and lose billions of pounds for retail investors. Don't befriend a criminal and lie about it. Don't inside a trade. Don't let your firm do weird things without reflecting on it and getting legal advice at the time. But I think we've all of us in private practice and in firms have acted on matters where senior managers are involved, and the right thing to do is to manage your risk properly. So get the right supportive advice, get the right MI, think about your reasonable steps, document them, and ensure they're completed in practice. And the cases that we've done where some individuals have been enforced against and some haven't, it is that kind of contemporaneous thinking that has protected those individuals from facing legal jeopardy. And I thought I'd also add, we've all been involved in a number of cases where you're slightly surprised that the senior managers don't face enforcement action, and I thought I'd explain a few of those. So senior managers are meant to be a single point of responsibility. That's the purpose of the regime. But in practice, over the period of time of the breach, you can get several senior managers occupying one role, you can get matrix management, you can get a number of different people being involved in the potential breach. And the FCA finds that very difficult because it can't enforce against one without doing it against all of them, and against all of them is too difficult. So I'm not saying set yourself up in a way to confuse the FCA, but that seems to be a way to actually confuse them and stop them taking enforcement action. We've got 1 minute left, I think. So if anyone's got any questions about changes to the SMCR and the impact of that on personal responsibility, do let us know. Stunned into silence, or been very comprehensive. I'll take the latter. Thank you very much.
Thanks very much, both. We now come to another panel discussion on the role of AI in the identification, securing and managing of evidence, with the $64,000 question, is it really the panacea it claims to be? Moderating the session is Priya Giuliani, a partner in the global consultancy firm FCA, and I'll invite the panel to kick off.
Well, good morning, everyone. Just good morning. The panel title was already read out. In short, we're going to be looking and examining whether AI is helpful or not within investigations. Just to set the scene a little bit, everyone seems to be talking about AI in every aspect of life. And the UK's AI Opportunity Plan, which was published earlier this year, and the EC's Apply AI strategy, which was just launched a couple of weeks ago, has some grand plans for AI adoption in the UK and the European Union, and not just in terms of adoption of AI, but in terms of pioneering AI solutions too. So not just being led by the US and China when it comes to artificial intelligence. So there is quite a lot of interest on the topic. We've heard today and previously that the FCA has made no secret that it is using technology to be a smarter regulator. And we also heard this morning about the drastic reduction in time. I think Therese mentioned the use of data analytics in response to one of the questions. So if regulators and other law enforcement bodies turn to AI, what does industry need to do to keep up with that? And will the adoption of AI be a choice in the future? In today's panel, we're going to examine the benefits that AI can bring to investigations, whether you may be conducting an internal investigation or on the receiving end of a regulatory enforcement action. Most of us have used AI in some form by now, so we're aware of some of the concerns. But as you start adopting AI for your investigations, what precautions should you take? And we'll also examine the relationship between humans and machines as well. So quickly, by way of my introduction, I am a partner in HKA's investigation and compliance team. I regularly act as a skilled person and help financial services clients navigate complex regulatory issues, particularly concerning conduct and financial crime. My interest in AI probably comes from my very aged background, and I have a degree in computer science, and lots has changed since then, but that's my little fascination with AI. I'm going to go down the panel now so that they can introduce themselves and perhaps tell you why they're interested in this topic too. Catherine.
Thanks, Priya. I'm Catherine Belsham-Ravel, and I'm Head of Litigation and Contentious Regulatory at Lloyds Banking Group. My role primarily involves advising on complex disputes, regulatory and conduct investigations. I've been at Lloyds for 9 years. Prior to that, I was at Morgan Stanley. Prior to that, I was in enforcement at the FCA. And prior to that, I was a disputes lawyer in private practice. So I've been sort of around the industry for a while. And I've been a general litigator, a shipping litigator, a criminal litigator, a specialist in arbitration and regulatory disputes. So as someone with a rather agile background and history, but the common denominator being a requirement to review and assimilate vast amounts of documentation, I'm really excited about seeing how AI can work for us in the future across all sorts of contentious and non-contentious matters. I would also add, I'm one of those sad middle-aged people who ask ChatGPT all sorts of questions, to the endless exasperation of my teenage children, who are just endlessly exasperated because they're so much more sophisticated in using AI thanks to TikTok lessons. I don't know, I'd understand. But I think it's really fascinating. From a work perspective, it's increasingly part of our toolkit, a key practical resource in how we manage and analyse evidence. As you'll know, it's not super new, AI itself. We've been using technology-assisted review for a while, but these new tools that we're seeing take this a step further. And in contentious proceedings, we're starting to see the real value in using generative AI-powered tools to support evidence management, especially in large-scale, data-heavy cases. These help us surface relevant information much more efficiently, identify patterns, and also find documents that can rebut arguments. And there's a massive thing about reducing the time and cost available as well for the traditional review processes. Obviously, this comes with risks that we're sort of getting to grips with as well, and not just the really obvious ones about AI hallucinating cases for unsuspecting lawyers. But I'm particularly interested in seeing how the legal and regulatory frameworks evolve to support the responsible use of these tools whilst maintaining fairness, transparency and accountability.
Thank you, Catherine. Richard.
Hi everyone, my name's Richard. I'm a forensic accountant at the law firm Edmonds Marshall McMahon, where we specialise in private prosecution, civil fraud and white-collar defence and investigations. Before that, I was a forensic accountant at KPMG and FRA, where most of my work was on regulatory and internal investigations into financial and non-financial misconduct. At EMM, we use AI in our e-disclosure platforms and during our document review.
Steve.
Well, afternoon, I suppose, everyone. I'm Steve Holt. I'm a partner at Grant Thornton, where I lead our global investigations practice. I'm afraid I'm a tech skeptic, largely, but you can't avoid the fact that you have to use AI. So we use AI both in conducting investigations, but I also have this really weird role in which I support my audit practice and review others' investigations. So I can see where things go wrong, I can see where things go right, I can see mistakes that people make. And obviously we try and learn from that as a firm, but it gives me, I think, a slightly different viewpoint on how AI is used. In terms of tools, we use all of the stuff you might have heard, generative AI kind of things. I'm doing my best to not sound like Boris Johnson when I mention all of these. But we use Legora. I know that Harvey's a popular one in the marketplace that many firms have onboarded. But document review tools like Relativity, Air, Brainspace, all of this kind of stuff. So we have a suite of tools that we use, sometimes to good effect. I should say, and I'm sure we'll explore that a bit more during the course of this.
Thank you, everyone. So yes, we've got a range of different perspectives here on the panel today, but also I want to prime you because we've got a few minutes at the end for any questions that you may have, so please keep thinking about them, or even if you want to share any experiences of using AI in your investigations. So, as I said at the beginning, AI is a topic of great interest, and some people describe the use of AI in investigations as a game changer. So Richard, where do you think, from your experience and your wider reading, that AI has made the biggest impact so far?
Well, it certainly can add efficiency to investigations in terms of information gathering and document review. There's AI-powered web scraping tools that can simplify and summarize data from dynamic and unstructured websites, making them ideal for background research into individuals or companies that are subject to your investigation. But I think the biggest impact is in document and data review. So AI can now automate the analysis of documents and data sets and provides insight to the review team. Traditionally, doc review would be using a platform for keyword searches, which would then be batched up and given to a review team that would be locked away in a windowless room for weeks on end, looking at documents, commenting on their relevancy. Then there was the development of technology-assisted review and computer-assisted learning, which made things much more efficient. It would take a seed set of human decisions on the relevancy of a document and then populate your list of documents for review with the most likely to be relevant at the top, so giving the review team the opportunity to review the more juicy content at the start. And I was a fan of that. I think it worked really well. It cut review time down. It made the process a lot more efficient. AI has gone further now, and it can detect pattern phrases to identify documents with similar meaning. So if you were to use the word fraud, it could return documents that contain bribe, scam, theft, launder, offshore, that type of thing. With prompts now, it's not just looking for a document that is purely responsive to a word that you have used, but actually you can sort of articulate in plain English what it is you're looking for. I want to find evidence that so-and-so was speaking to so-and-so, and they knew that that person was going to be in Luxembourg meeting his banker between these dates. You know, you can describe a situation and it will retrieve things that it thinks are going to be relevant to your case. In terms of the review of structured data sets, so a forensic accountant would typically run search terms or design red flag tests over accounting system extracts or bank statements, you know, give me repeat round sum amounts to an entity that has more than one bank account that has been posted on a weekend, you know, these sorts of things to give you a list of transactions that might be relevant to your investigation. AI can now analyze that data for you, identify abnormal patterns or spending behaviors without those sort of predefined tests. So you would give it examples of transactions that are relevant to your review, and it would give you a list of transactions that demonstrate similar characteristics. So there's big time efficiencies in it, and it's a good starting point for your review.
Thank you, Richard. Catherine, within in-house legal, do you think that AI can be a game changer?
Yeah, I mean, a lot of the stuff we've been seeing is very similar to what Richard's mentioned, because I think a lot of it is all about sort of saving time and costs in these big document reviews that we have to do. And I think we're doing a lot of work at the moment looking at the various different systems, things like relativity error and stuff like that, and actually comparing the times that these things will take to do this review. And it is remarkable how much quicker it is. And actually, it's a bit galling when you look at it and you go, actually, it's really good as well. And I think that can be a bit difficult because you're going, well, oh, okay, so they can do this. And I think the stuff that I find really interesting is when you sort of say, well, can you find perhaps communications between these people? You know, and you don't even have to give the name. You can say someone who holds a position as a director in this company and this person, which might be something to do with bid rigging, and actually comes up with a pretty decent selection of documents. And you're going, okay, that is, and it is actually really, it's amazing, and it cuts at the amount of time, obviously, that's needed to review. But I think the key point there is that you can't rely on that, and therefore you've got this situation where you've got this incredible shortcutting of your review, but at the same time you've got to go, well, how do we check that? Because the worst thing to do is sort of go, well, these are all the communications between these certain people, and this builds a pattern that shows that these people were definitely involved in bid rigging, and then perhaps the AI has missed something because your prompt wasn't exactly right. So it's finding that balance as to how much sort of due diligence of the product that you have to do. But I mean, if you're doing that completely, then you're sort of sort of losing the benefit of doing the AI searches as well. So I think it is quite a difficult balance. But certainly for us, with the way the FCA is approaching it, and we've seen that they do expect us to do things a bit quicker. I mean, they're always expecting us to do things quickly, but they do expect us to sort of find documents and search things perhaps quicker now because they are aware that we have access to tools. So, I mean, it's, you know, for Steve, we're stuck with it, right? Because, you know, people are expecting this to happen. So if you're not using it, they're like, why have you got a team of trainees and junior lawyers reading documents? You don't have to do that. So I think you're kind of forced into it, but it's just about finding the balance and making sure you've got someone looking at it to make it make sense. One thing we have done that's quite nice that we've got a sort of knowledge centre that in-house we're not quite as good at as law firms of setting up things like knowledge centres and having knowledge lawyers. And actually having internal AI has made that a lot easier because we now have a way of we've got some really clever associates who are writing AI agents to actually search the knowledge centre, and you know, it has saved us quite a lot of time in that way. So.
Thank you for that. Steve, you mentioned in your introduction that you've used a lot of these tools in the work that you do for your clients. Can you share an example of where AI has drastically improved the speed and the accuracy, perhaps, of the sort of investigation?
Sure. So, I mean, I have to be very careful how I describe this as any case where people might actually know who it is that's in the bottom of it, so I'll be quite careful. I wouldn't necessarily say accuracy. I'd say certainly speed. So we find AI is brilliant for triage. So where you have a bit of an idea of what might have happened, to be able to run some prompts, quickly get a feel for what might be there, and then try and fan out from what happened. And relatively recently, we were working with how do I describe this? A regulated entity in the food industry, I'll put it that way, who was a bit nervous because they were, for those that are squeamish, I won't go into the details, but they were losing a lot of waste that they didn't think they should be losing. And as they started to look into where all this waste was going, they found out that there were some really unusual patterns of behavior for people that shouldn't really be talking to each other in a business. So we managed to ingest some data, which is always the fun part, get some core data, some communications data, some calendar data. We could piece together some unusual behavioral traits from using AI over that data. That then gave us a whole kind of theory as to, oh, hang on, it's not actually we're losing waste, it's waste is being repurposed to launder something else. And we actually found that there was a huge money laundering scheme that had been running under the guise of having lost food waste, I'll put it that way. So it's really great in terms of you've got an idea of something that might be there, but when it then starts to come unpicked is when you try and think, well, why am I doing an investigation? I'm not doing an investigation necessarily to find all the facts. I'm doing an investigation to convince somebody that they should trust me. Whether that's your regulator, whether that's your auditor, whoever that is, you need to know exactly their limit of tolerance for what you're doing. And if you just solely rely on AI, you might come out and say, there's this huge money laundering scheme, great, I found it. But the next question is, well, what else is wrong? How far does everything else go? And AI won't tell you that. That then comes back to your people that are going to sit there. So it's embedded in our process. I don't necessarily like it because it loses that instinct part of where you think, I just don't believe that. That just doesn't make sense. And it will take everything very, very literally. If it's written down, it'll take it in a literal way it's ready. Even if you train it to say, if he says this, he means something different, it doesn't always work that way. I think the best description that I've had of AI, and maybe this because of my skeptical view, was a professor at Cambridge who basically said it's like having an overconfident MBA student. They're always right, even when they're wrong.
We will look at some of the safeguards against some of the issues that we're already discussing in just a second. But before we move on to that, these tools for investigations, are they readily accessible to people?
Yes and no, hopefully. Appreciate not answering a question is always the best way to answer it. Some stuff's really prohibitive in cost. So obviously you have your things like ChatGPT, generative AI tools that you can get off the shelf relatively easily. You can train them on your databases, your data sets, make sure that they're internally focused only. You obviously don't want all of your private information being pumped out into the ether. There are other things that are relatively cost efficient, so tools like BrainSpace, which I mentioned, isn't overly expensive. If you look at an enterprise-wide license, you're not going to be necessarily burning the bank down, but it's all about using it proportionately. So a lot of the tools, and Relativity Air is a fantastic tool, but it's so expensive as a hard cost to run a prompt over a huge set of data. So it can be prohibitively expensive, but if you can find a way to reduce down your data size, it could be much more manageable.
Thank you for that. So we've heard some positives about the use of AI. In particular, what's come up again and again is about the speed and the time that it cuts down if you're reviewing large data sets. Richard mentioned the traditional way of looking at things is predefined theories that you're looking at, and AI can actually look at sort of broader patterns that you may not have thought about. But we started hearing about some of the challenges and some of the safeguards that we need to think about if we're going to be deploying AI solutions in investigations. We've heard of things like AI bias, hallucination, issues around transparency. So if we do deploy AI, much more than we are at the moment, we do need to exercise caution. And Catherine, we were talking about this earlier. Are you able to share some of the practical implications that firms need to consider when they're thinking about deploying AI?
Yeah, so I mean, I think one of the, particularly if you're working in the field of litigation and in regulatory investigations, it's things like legal admissibility and chain of custody. So evidence sourced or processed using AI must still meet traditional legal standards. So when AI tools transform or reclassify data, that can be a problem. Some AI models operate as black boxes, rendering it difficult to trace or justify decisions reached, which makes the job of courts and regulators more challenging. So you've got this difficulty that, you come up with something that may well be the answer, and one goes, well, how did you get there? And I think if you can't explain how you arrived at that position, and you've got difficulty with admissibility, and also explaining to regulators perhaps how you've come to that conclusion. So you do have to be really careful of that. I think we've spoken about bias and transparency, and AI systems can inadvertently perpetuate amplified biases, especially if the systems are trained or skewed on unrepresentative data, and that's a well-known issue that can lead to discriminatory outcomes. And that obviously can undermine the confidence in the process that you're using. And I think that's a difficult one because, it depends how transparent your process is, so you can actually work out where that bias is coming from or work out how you get a human in the loop to mitigate against that. But that's something you really need to be careful of as well. The other thing that, obviously for lawyers, is always interesting is data privacy, because AI processing is fundamentally data processing and therefore has to comply with the core principles of the UK GDPR. And so an issue for us as legal and compliance teams, so we have to ensure that any AI tool has a lawful basis for processing personal data, particularly where you're profiling or there's automated decision-making about individuals. And the principle of data minimization requires that only data strictly necessary for the AI's purpose is used, while proportionality demands that the benefits of AI deployment are balanced against potential privacy risks. So there's quite a lot of things to consider in that space. I think you've also got this thing about data transfer risks, because most AI systems rely on cloud-based infrastructure, and that's always a problem. We particularly, we really have this when we're dealing with sensitive customer data, that anything in the cloud is problematic. But you've got things like generative AI, and they often involve cross-border transfer of data, which includes personal data. So we just have to make sure that all of that is managed properly, and that there's transborder data flows trigger additional compliance obligations under the GDPR as well. So we have to do all these risk assessments to make sure that the destination jurisdiction is acceptable. So it can be a really amazingly useful tool, but there are an awful lot of safeguards, and we've certainly found in using it we're a pretty risk-averse organisation, which is good, but then in order to bring in something like relativity error, which we have started having a look at, even though it's very, very expensive, is that you do have to be really careful and check all of these things to make sure that you're not sort of stumbling into something that is not, isn't quite what you'd expect. So I think there's a lot of other checks that you need to make sure you're complying with as part of that as well. And then obviously need for the human in the loop, which we've talked about a lot, is that you've got this, managing the fact that these models will often prioritise linguistic coherence over factual accuracy. I think it's the overconfident MBA student. I think when I was thinking about it, I was thinking it's like a really annoying trainee. It's a similar kind of thing, isn't it? And they come up and they refuse to say that. And it does, even ChatGPT, which I use for many things, does refuse to admit that it's wrong, and it is really annoying. So I think it's, it's making sure that people don't take it at face value, because it is so convincing.
Thank you for that. I think your point in particular about the data privacy and your temptation as an investigator wanting to just put everything into a massive AI engine.
You've got
and
to
just
track it where it's coming from.
Absolutely. Absolutely. Richard, when deploying AI for evidence review and forensic investigations in particular, are the safeguards different?
I don't think so. To echo what Catherine's already said, if you're using a web scraping tool, you really need to understand its sources. Like, can it get behind paywalls to access premium content? Because some of them that can't may see a headline and then piece together fragments from open sources and create you an accurate summary of what that article might say. So you just need to be able to verify back to the sources, understand sort of its limitation of scope. It's really important that you train staff on how to develop prompts. They should be well-defined, clear, provide some context, because if they're too vague or too narrow, then it can result in AI-generated results that are inaccurate, and it's that old expression, rubbish in, rubbish out. Definitely ensure human oversight. As Catherine said, don't blindly accept the output. You need to remain accountable and verify the answers. Can you arrive at the AI-generated answer? If not, well, why is that? And I think that's been said before, the output can be wrong, but in a very convincing way.
The use of prompts is an interesting one. For all of those that are regular ChatGPT users, you know that the number of times you might have to ask it a question to get the answer that you actually think it should be. It's like quite repetitive, and then you just realize how much detail that you have to go into to do that. And especially if there's then a cost per prompt, you better be sure that you know how to use those and how to structure those properly. Steve, you suggested at the beginning that there are some, I guess, probably more downside to upside maybe in terms of AI at the moment. And you did say that you had some AI horror stories. I was wondering whether you might want to share an example so that we can learn some lessons from other people's misfortune.
I'll try my best. I mean, I wouldn't necessarily say it's more downsides than upsides. I think it's like anything, cautious optimism. Like, these things are fantastic, but they're fantastic in the hands of somebody who's skilled at doing something. If you just blindly take the output of something or say, well, this will solve my problem, it absolutely won't. It will make your problem bigger. And I guess there are two primary examples that jump to mind. One, was looking for a client that had relatively small data set, so not even a terabyte of data, email correspondence. They'd heard about relativity error, were really keen that we use it. I said, I need you to find out this. They gave us a relatively simple task, simple question before we run the prompt, because the size of the data, we said, you do realize that each time we press enter and run a prompt, you'll incur £100,000 of cost. Now, I like to work on trial and error basis. ChatGPT is great because you ask a question, think, that's not really what I meant this, I meant this, I meant this. You kind of get down to the one shot only in some circumstances. Nobody wants to pay £1 million for somebody to get the right prompt. So how do you get from the part where you get your wonderful output from a single prompt when you've got a huge data set? The answer is you have to cull that data set to make it manageable. By culling the data set, you have to make assumptions. You have to do some work to cull the data set. And fortunately, the client kind of understood. They wanted to run things in parallel because they wanted to see the output. But after £300,000 and 3 searches and no nearer the truth, they kind of thought, maybe we should go back to a slightly more traditional method and then bring the AI in at the right time. A slightly worse example, and this comes from me sitting on the kind of opposite side of the fence as I'll say a pseudo-regulator, but helping my audit practice understand whether a firm had done a good investigation or not. We had a client that had found a pretty substantial problem. The management board of this client had essentially falsified their revenues for a number of years. Fortunately, we stopped it. It was our first year working for this client. We suggested they get somebody involved to do a big investigation. Huge, wonderful law firm came in with some very talented practitioners, wholeheartedly adopted AI as part of their process, but didn't really understand why in certain places. They spent £17 million and had to redo investigation 3 times for us still to say, this doesn't really cut it. You haven't really understood what happened. You haven't really got to the bottom of all of the issues. You haven't really explained to me why I should be confident that you know what has happened. And as a result of that client's had some pretty serious financial issues because they don't have audited accounts, which means they can't access capital markets, which means they're really in a world of pain. And to highlight some of the challenges we faced in this is we ended up getting a very angry management board come and speak to us. As you might imagine, they spent a fortune and we still couldn't clear off their accounts. The AI tools that have been used missed vast swathes of enormously relevant documents. So we were able to put together this 50-page slide deck. The board of this company, they were all based overseas and come in to see what we'd done. Huge law firm and our team. Slide 1 was an email from person A to person B saying, are we still going to commit this fraud that we've done for the last 15 years? Law firm response, not relevant. We had 49 other examples of that because the team had just blindly relied on what they'd been given. So without that human oversight, without that thought pattern, that process, you can quite easily get to an enormous false positive. Now, obviously, it's one thing for that company, which is a privately held company, and all this kind of stuff. But could you imagine a financial institution saying, we've got to the bottom of it, but we've missed this enormous, massive, huge fraud here that's systemic and maybe actually bring us down? The repercussions are enormous if you get it wrong. But it is great AI.
Can I add something actually something that was come up through some wider reading I was doing, is that they're having real problems in courts at the moment, sort of lower courts with litigants in person who are relying on ChatGPT. And that's something that is actually creating huge problems because I think the judges and the barristers don't know if this stuff is accurate and the litigant in person's turning up with all this stuff. And it's actually creating vast amounts of work in the lower courts if you've got litigants in person using ChatGPT as their legal advisor. So it is kind of, handled with care, all this stuff, because it can just create huge amounts of work.
And I think we've talked about human in the loop a couple of times. I think that from our experiences so far, AI as we said when we were looking at the first theme, can be hugely beneficial in terms of speed and getting your arms around vast amount of data and information. But at this stage, at the moment, I don't think anyone is confident enough to let that run by itself without having humans in the loop verifying pretty much everything that it's telling you. But it does get you to avenues of investigations a lot quicker than might have been through the traditional routes. I think it was in the press last week or the week before, a very large consulting company got themselves into trouble in Australia because they had shared a report and they hadn't checked the sources again of the information. So the safeguards are very much very, very important at the moment. But I think that as AI starts to evolve and it can do more and more and it gets better at doing some of the things that we've described as horror stories at the moment, then this is sort of like a moving target. I would also say that we're hearing that certain technology platforms may be more expensive than others. We also have experience of using some that are way more at the cheaper end of things as well. So I think there is possibility for people to use AI solutions at cheaper end of the spectrum as well. So finally, on to our third topic, which really where we're looking at the relationship between machines and humans. Richard, do you see the role of forensic accountants changing as a result of AI? I guess you talked a little bit about at the moment and how useful it is or not in terms of financial analysis, but the way that progress is going, I guess question 3 really is about your crystal ball and seeing how far AI might be able to challenge the role of the traditional forensic accountant.
I don't think so. I think the forensic accountant still needs to understand fraud types and how they're relevant to the individual, the company under the investigation. Still need to understand the risks faced by the company, its control environment and any deficiencies, and use your experience and judgment to determine the best course of action during the investigation. You still need to understand the typical processes from procurement to payment, how the company goes to market, how staff are remunerated and incentivized, and how all of that is relevant to your data landscape, and then how you're going to interrogate that data. So I think the forensic accountant still needs to hold all of that knowledge, and if you outsource that to AI, that's an evaporation of a core skill that you're going to need. So you need, I guess, to retain all of that, but then develop this new skill so that you can get the best out of this new tool that is available to you.
Thank you, Richard. And Steve, in terms of your investigations teams, on the engagements that you've run so far, have you noticed that there's a different type of skill set that's required or will be developing?
I mean, I guess it's a bit of an evolution. I share the same view as Richard, really. I mean, you still need smart people to make smart decisions based on output. It's just how you get to that output is slightly different. So we're seeing certainly more tech-savvy people coming through, as you might anticipate. We're probably relying less and less on roomfuls of associates that don't get to see daylight for weeks on end, going through documents. That's the thing of the past. I think there's probably a focus more, bizarrely, on a technical side. So not on an AI prompting side, but on understanding, well, what does this really mean? So a great example of things we see that's misunderstood in the accounting world a lot of times, provisions. What does this provision really mean? How is it accrued in the accounts? Who has made what decision based on what? That's not the kind of thing you necessarily conceive in black and white. That's a feeling thing that you know and understand from technical learning over a period and going through, sadly, hundreds of problems where people make mistakes. So I think you'll always need people. What it is changing a bit is less of a need for people to do research. So there are basic diligence tasks that can be performed using AI tools, as Rich mentioned, scraping databases and whatnot, and pulling together a relatively good profile. You know, there's a lot of enhanced due diligence that people come to us for where we say, you really don't need us. You can get most of this stuff off the internet, and ChatGPT will be pretty decent, actually, as giving you a starting point. But there was a study that came out over the weekend about how generative AI can outperform lawyers in terms of basic research.
We're going to go there in a minute.
By which I mean it will give you the basic facts. It won't necessarily synthesize them in a way that's that useful. So you're always going to need the human element. I don't think we're going to kind of all be out of a job within the next, touch wood, 6-7 years. After that, who knows?
What are your thoughts on the fact that a lot of us learn our trade by doing some of those tasks, if you like, and that's some of the skill set that helps us to see whether something is right or not when we're talking about human in the loop. What about for future generations who would never have to sort of go through the grind?
It's a real challenge. I mean, we're actively trying to shadow some of the AI stuff. So where we use certain tools, we'll have somebody either following the thought process of it to understand, right, this is how you get from there to there, or in parallel, we'll invest the time to make somebody go and actually just do the task. But I think you're absolutely right. You learn from doing. Humans tend to learn from doing. And without that, there's a real risk that if you don't have that appropriate, it's like the trainee model at law firms, I suppose, isn't it? If you don't have the exposure to the partners, to the senior associates, you can't pass down that feeling, that gut instinct that something's not quite right.
Yeah, I think that's going to be a broader issue for society as we adopt AI in all forms of life as well. Catherine, how do you think the adoption of AI may impact skill sets for lawyers?
I think it's pretty similar, actually, to what Steve said. I mean, people have to be much more tech savvy. I think when I was a trainee, you kind of did all these disclosure exercises in dark rooms and all this sort of stuff, and you kind of explained to the partner how it happens, and you had sort of review protocols, and they weren't really that interested in it. They're like, well, it's just disclosure happened as it did. But I think now it's a really key part of explaining how this stuff happens, is that you've actually got to be able to explain what system you used, all the prompts and all that sort of stuff in a way that it's got to be explainable, but it's actually got to be explainable, it's got to be understandable, and actually people have got to really understand how these systems work, and I don't think it was ever quite like that in the past, and you've got to be able to communicate with the tech teams about how these things work, and about how the document review is going to work, and how all these things that lots of senior lawyers have kind of ignored and gone, oh, that's just the junior lawyers are dealing with that. I think lots of us now have to pick that up in order that we can explain what's been happening, and I think that's quite an interesting development. I think the thing about legal research is interesting because it's a really weird one, because I keep trying to have a look to see how it works, and it's just not very good. And I think it's because, possibly for English lawyers particularly, it can't get away from a US bias, even if you're kind of you go, look, I'm in England, can you stop giving me cases about the US? And it always slips back to it. And I think it's a real problem for research when you're asking it difficult things, because it can't help giving you what it thinks you want to hear. And I think I really struggle with some of the research on that. So I think for us, for a while, we've got quite a bit of time to be able to do legal research. I mean, the thing I find is if you kind of vaguely know what the answer is, it can really help you, because you know where to look. You just put into Copilot or ChatGPT, can you find me this case about this that the FCA did at that point? And it will find it, because you know what you're looking for. But if you say, can you find me all cases where the FCA found that there was a Principle 11 breach relating to these sorts of firms, it will get it wrong a lot of the time. So as long as you're it can help you find things you know are there. And that's kind of, for a junior associate or someone doing research, it probably doesn't help them that much as a place to start. But I think, certainly for lawyers, I think the other thing that we still retain is a lot of the litigation strategy and the risk analysis. It's that kind of feeling of what's right. So they can analyse case law, judge behaviour, litigation outcomes to inform a strategy, and they can also help you find rebuttal documents. But I think there is, in lots of things like forensic accountancy and all this sort of advisory, when you're looking for things like frauds, there is this sense where that just doesn't make sense, and I'm not sure it can do that. And that is the thing I think that we might lose if people don't spend a lot of time looking at documents going. So I think that's something that at the moment we can still keep away from AI. And obviously, I'm not sure that they're going to be in court anytime soon. So I don't think advocacy and sort of courtroom skills and judging is going to be AI at any point in the near future. But you never know, I might be wrong. But it'd be interesting to see. I mean, we sort of did, internally, we had an away day where we sort of envisioned nightmare visions of the future, and all of us came up with an AI judge in a kind of Judge Dredd sort of way. And it's kind of, I think that's something that, you could see with the court backlog, there's a desire to do that. But that is a real... that's something that we really don't want to go to, I don't think, until AI is better. Also, things like ethical and professional duties, we still need to keep all of those, but in the context of using AI as well. So I think we've still got a skill set, it's just adapting to take account of this new tool.
Right, that's what I'm hearing down the panel then, that a lot of the skill sets that we all have are still going to be very much in need. In particular, AI will struggle with things like curiosity and critical thinking for the time being. Right, I'm going to just pause there to see if we've got questions in the room. Let's get the mic down.
think one of the key phrases is explainability, isn't it? You know, I think that, you know, what's coming from the panel. I'm just reminded of that witticism that said, I'm sorry that I wrote you a long letter, I didn't have time to write you a short one. Because in order for you to explain things in a pithy way, particularly to a regulator or law enforcement authority, and Steve, you made the really important point that the object of these internal investigations and engagements with regulatory and law enforcement bodies is to convince them that you have done a good job, is that you explain the use of these tools. And over the years, you know, I've been advising financial services firms on the implementation of technological solutions, particularly on the compliance side, but also on the investigation side, where you have to put yourself in the regulator or law enforcement body's shoes and say, well, how have you got to this? How have you got to this position right at the end? It's more of an observation rather than a question. But
thank you for sharing that. Any comments?
No, I think that's absolutely right.
I think it's, sorry, just to jump in, I think it's quite tricky because you've got a regulator that's saying use more of this stuff, but I don't really know how it works. So can you just do lots of it and we'll be all right with it until we're not? And there's that awkward balancing point of all of this stuff, and that you know, to explain something, you almost have to, I always approach it like trying to teach my grandma how to use a VCR. If I can't explain it in such basic terms that it makes sense and lands, then I don't understand it well enough to try and go to a regulator and say, well, I mean, I think it does this. I'm not really sure. I haven't gone through all of the details to be able to say convincingly that it works. And as soon as you say that, your credibility in the room starts to wane, because why should I trust you? You don't even know it yourself. Kicks in, and the value of all of that time and effort and energy you've put in to produce this amazing report or these findings kind of disappears quite quickly.
I agree with you. I think it's somewhat more difficult in the compliance side of things to use these tools because you do have to explain the use. Although maybe in the investigations side of things, you could use it more as an intelligence source, if you like, or speeding things up because you're still using humans for the large majority of things. Any other questions or comments?
Hi, Caroline Hunter-Yates at Simmons & Simmons. I was just wondering if anyone's got any knowledge of any regulators making a lot of use of AI. And the reason I ask is my memory, going back to when Technology Assisted Review was kicking off, it was when the SEC K-Cura white paper came out that we all thought, okay, well now you've got the SEC endorsing this approach, that suddenly it's clearly acceptable. And I'm just wondering if anyone's seeing the beginnings of what could turn into that for AI.
I think from the FCA, they've come out with a few statements, haven't they? But they're very much like, well, it's just going to be the same, but you're just going to use it responsibly in line with what the government says about. But all your existing things will be there. I think there's some things in the court system about when you can use very, very simple things like co-pilot chat. So so nothing really in the kind of that we've seen that sort of wholly endorses using relativity air for everything. I mean, that would be very expensive if that was the way to do it. But they're sort of feeling around the edges, I think, and saying, well, a co-pilot might work a bit for this, as long as you don't do anything else, and that's okay for members of the judiciary or barristers to do that. But I haven't seen anything else. I don't know about.
Yeah, I mean, nothing wholesale. There's probably more in the US, I think, where I don't want to say they're more advanced in terms of some of their enforcement activity, but certainly using various tools as an intelligence gathering model. Essentially, you can bring a whole bunch of stuff together and suddenly have a dashboard and say, hang on, all of this stuff doesn't look right, I'm going to write some letters over here. I'm not sure I'm aware of it so much in the UK.
So look, let me just bring the panel to a close. Before I do, one final very quick question to each member is AI the panacea for investigations? Steve?
It would be a massive surprise if I said anything other than no. But it's a wonderful tool. So it's certainly very useful, but it's used with care and caution.
Richard?
Not yet, but if an investigator that understands its limitations and strengths, combine that with their professional judgment and experience, then I think it could be.
What Richard said, I think. I think it's a balance, right? I mean, yeah, it can be hideous, but it can also be, it could be really helpful. But I think it is always this balance. But I think treating it as the answer is not right at the moment.
No, and I would just sum up the conversation of this panel is that it can be particularly good in certain circumstances, but you've got to be mindful of those safeguards as well. And you need to know how to create prompts so you can get the right results and it doesn't cost you a fortune. But above all, human verification at this point seems to remain critical. Thank you all very much.
Thank you so much for that very interesting discussion. Now for something slightly different. I'm delighted to welcome to the stage Martin Hopper, now an independent consultant but long-time financial services regulatory specialist at Linklaters, Herbert Smith and the FCA. Martin will be conducting a fireside chat with Christopher Rich, GC of the Financial Market Standards Board, on the latest developments in market abuse excuse me, and other wholesale market risks. Martin, I'll hand over to you.
Thank you very much indeed. Good afternoon, everybody. I'm very pleased to be here. It's actually my first speaking engagement since taking a career break, which has consisted mostly of travelling around the world and clubbing. So I'm very well positioned to take a more objective view on some of the issues we're going to be talking about. And I'm really, really pleased to be talking to my former colleague, Chris Rich, who is now the Director of Standards and General Counsel at the Financial Market Standards Board, if I've got your title correct. Welcome. And we're going to take a bit of a different turn and talk. The focus here is going to be on wholesale financial markets and what we're seeing in terms of developments in those markets and what the implications of that might be for where the future conduct issues are likely to come from over coming years. And how that might change the outlook in terms of both standard setting and enforcement of those standards. And Chris is in a brilliant position to talk to us about that because, and he'll tell us a bit about this in a moment, he has been spearheading a very interesting exercise conducted by the FMSB recently, which has been talking to a large number of market participants about exactly those issues. And that's partly because the board is now 10 years old. Happy birthday. And it's also partly because there's a lot going on. The board, as you may all know, was formed as part of the recommendations coming out of the Fair and Effective Markets Review, which itself was spawned from the aftermath of the global financial crisis and the succession of scandals in wholesale markets, particularly in fixed income and commodity-based markets, which you'll all be very familiar with. But compared to the time at which the board was formed, we now seem to be in a very different time. We have a big international and UK government agenda to deregulate in order to promote growth. So we seem to have come back full circle with calls for lighter touch regulation, including in the wholesale markets, in order to support the competitiveness of the UK economy. And we're going to get into a bit of the issues about how that stacks up against the developments that we've been seeing. But first of all, Chris, tell us a bit more about what you've been up to at the FMSB and what some of the key sort of themes that you've been hearing from market participants actually are, because there's some really interesting stuff in there.
Yeah, and I guess this is partly to sort of set the general background as to where, changes in the market abuse landscape and enforcement going forward. But so over the summer, I interviewed about 65 people from across wholesale markets in senior roles in banks, in non-bank liquidity providers, in private credit firms, heads of regulators around the world, traditional asset managers, etc., to get sort of as broad a perspective as we could on how wholesale markets have sort of developed over the last 10 years and where both practitioners and policymakers think they're going to go over the next 10. And clearly those developments will inform enforcement action. So in terms of what's driven change, I guess the drivers of change, I think, are relatively obvious. Societal change, technology has been a key driver, geopolitics is obviously an increasingly important element, factor in wholesale markets, and then finally regulation post-crisis has been critical in some of the structural changes that we've seen in markets over the last decade. And so when then looking at what these sort of drivers have given rise to, we grouped it into four key themes. So the first is in terms of changes to market participation. So obviously, if you look back a decade, the market was very much a dealer-led, bilateral relationship market. That's significantly evolved, and we've seen huge growth in non-bank financial intermediation. We've seen significant growth in proprietary trading firms and the role of proprietary trading firms, which we'll come back to in the context of a recent enforcement case. We've seen buy-side consolidation in sort of a winner-takes-most type model, where the rise of passive and ETFs has given rise to very significant buy-side firms in the traditional asset management space. We've seen the rise of multi-strategy, multi-manager hedge funds, as well as pension fund consolidation. So we've sort of seen this shift of power from the sell side to the buy side to some extent over the last decade. And then we've also seen the growth of private credit within that, and the significant expansion in private credit markets, increasingly doing things that the bank syndicated loan market used to do. So that's sort of the first big theme, which I think plays into something that we'll come back to, Martin. The second was around trade execution, how trade execution has evolved. And again, this impacts enforcement actions and the way that regulators will conduct those. So we've seen massive growth in electronic trading over the last decade. Obviously, equities and FX began before that, but in terms of fixed income, that's electronified significantly. I think we're about 50% of fixed income markets now electronified. Our report suggested that we might get to sort of a plateau of about 80% at some point over the next few years. We've also sort of seen the early stages, and this touches on what was discussed in the last panel, but the early stages of market-facing applications of AI. Clearly, machine learning has been used in trading applications for a number of decades, but increasingly sophisticated techniques being considered, which, in terms of issues like explainability that we can come back to, poses some interesting questions. We're seeing the role of compute power becoming increasingly significant. One participant, or newer market participant, said to me, you double your compute power and you double your P&L. And if you look at the investment in hardware that some firms are making, it's very difficult for others in the market to keep up with that expenditure. So it'll be interesting to see how the market develops and whether in sort of data-rich liquid asset classes we have an increasing concentration of players because of the necessary sort of hardware that you have to compete. We've seen activity go into venues, particularly in fixed income, 3 venues in particular where much of the activity is concentrated. And now we're talking about sort of the shift to 24/7 trading, which clearly will give rise to bouts of illiquidity in otherwise liquid markets. And there's the link between illiquidity and abusive type behaviors or opportunities to manipulate markets. The third major theme from the paper looks at what we describe as new asset class frontiers, but firstly, the expansion of traditional FIC. We've obviously seen massive growth of sovereign debt markets over the last decade, driven by COVID and stimulus and sort of government's inability to control deficits. That growth means that there is greater focus, for example, in the UK on the gilt market and the fairness and effectiveness of the gilt market, and that's the same in many jurisdictions that are facing similar issues to the UK. We've also seen the rise of both backed and unbacked crypto, and stablecoins were a major focus of the discussions that we had. Clearly, there's an increasing interconnectedness between stablecoin markets and the US Treasury market in particular, and the potential ramifications of an issue in stablecoin markets that could have on sort of traditional sovereign debt markets. Within that, we're also seeing the growth of betting markets, and this has been a discussion that we've had quite a lot over the last few weeks, and how betting markets are increasingly, again, interconnected with traditional markets. We've seen ICE buy Polymarket recently. We've seen CME, I think, enter into a partnership as well with another firm in that space. And there are increasing concerns about sort of the tail wagging the dog in terms of betting markets influencing regulated traditional FIC markets. And then the final sort of theme is around the shifting geography of markets and the role of sort of a multi-hub world, in part reg-driven, as we see greater regulatory competitiveness between and across jurisdictions. So they were sort of the key themes, Martin. Happy to sort of dive into.
Yeah, let's unpick some of them. I mean, there's a huge amount going on, and we can't obviously get into the detail of all of those in the time we've got between now and lunch. But I want to pick up, first of all, on the whole sort of electronic trading, algo trading, and now, as you say, the introduction of AI into, or increased use of AI into the picture. That's really interesting to me because when you look at some of the historic enforcement cases, particularly in relation to market manipulation and market conduct, and we were talking about one of them earlier on, the Ura Shetham Lopez case, which is in many ways a very, very long and turgid judgment about something that's not very interesting because it's a traditional case of spoofing, effectively, and it follows, as Chris was saying earlier, a pretty standard format. But one of the vaguely interesting things about that judgment is buried in there as a confirmation of a principle in relation to those types of cases, which was first articulated in the High Court in the Burford Capital and LSE case, which is despite the fact that everybody says market abuse is an effects-based regime, actually, in some cases, it's not. Particularly in the case of spoofing, for example, the Ura decision reconfirms from the upper tribunal that actually intent is what it's all about. You've got to look at the intent of the trade in order to distinguish between what's legitimate and what's illegitimate. And I guess one of the questions that immediately comes out from what you're saying about the way markets are headed is how do you judge the intent of an algo or a piece of AI? And is that something which the market has got its head around yet, that the regulators have got their head around yet? What are those cases going to look like?
Yes, I think it's a very interesting question. And clearly for traditional deterministic algos, it's less of an issue because you can look at the code. But as we move to a world where models do become increasingly complex and inevitably become less explainable and more opaque, and actually going back to a point that's made on the previous panel, lack of explainability of AI is a feature of it. It's not a bug. And if we insist on a degree of explainability, then it will stifle innovation in that space. I think that is a widely held view among experts in that space. So I think it means that we're likely to adopt an approach that focuses more on outcomes rather than the process.
So potentially it will become an effects-based regime?
Possibly.
But how does that work? Because trading moves prices, right, sometimes. And without the intent test, does spoofing become not an issue anymore, or just something that algos are allowed to do, or that AI-informed algos are allowed to do?
Well, I think it becomes an issue that's increasingly challenging for regulators to sort of build a convincing case around, unless there are limitations put on or expectations in terms of the degree of explainability that's required when you are using something that has market-facing applications. Yeah. But the counterpoint to that the market will make is that if the actual outcome of say something that's producing pricing on venue can only move within the parameters set by RTS 6 type controls, how important is it to be able to explain something that can only have a very minimal pricing variable? And again, in doing so, does that sort of, if you do that in one jurisdiction, do you put yourself at a competitive disadvantage versus others?
It's quite interesting because you and I, when we were preparing for the session, were talking about this. There's an interesting case going on in India, of all places, at the moment. Quite interesting that this is going on in a developing market rather than the US or Europe. But Jane Street has got itself into a tangle with the SEBI over a potential market manipulation case, and there's an interim. In fact, they've been banned from the market in India by the SEBI in an interim order which sets out the SEBI's case of an alleged market manipulation, which is widely reported to be driven by algorithmic trading strategies, although to read the SEBI's order, I don't think they refer to that once. They refer to it actually as a sort of concerted and premeditated market manipulation, but it seems to have been done wholly through electronic trading, according to the reporting. So it's a case that's obviously still going through the process and which Jane Street contests very vigorously. But what strikes you from what's going on there in terms of what it might tell us about where these sorts of issues might be headed?
Well, I suppose the first thing is just to note that one of the trends we were talking about before was the shift from the role of banks as key liquidity providers to increasingly the role of these non-bank players. And obviously Jane Street in the ETF and underlying kind of bond market are a particularly prominent player, but there are a number of others. But sort of I suppose firstly it's a mark of the shifting scrutiny, the shifting regulatory scrutiny from bank to non-bank players. And I think this was in part triggered actually by Jane Street sued a couple of traders who left to Millennium in terms of taking their IP relating to this Indian options market strategy. And that revealed that the strategy was highly, highly profitable in Indian option markets. And also, as part of this, that retail participation has exploded in Indian derivative markets. And so, these very sophisticated wholesale players facing off against retail participants who, on average, according to the SEBI report, or in the vast majority of cases, are losing money, obviously it attracts sort of increased political and regulatory scrutiny. So I think there are a number of factors at play here in terms of, the prominence of the non-banks, the prominence of retail trading and retail losing out when facing off against sophisticated wholesale players. And then, as you say, the deployment of perhaps actually not in this case. I think Jane Street have argued that this is actually a fairly basic index arbitrage strategy, trying to realign or driving the realignment of the underlying bank stocks against the Nifty index. But perhaps is the beginning of looking at, regulators trying to look at the trading logic.
Yeah. Okay, I'm conscious of time, so let's move on to talk a bit more about the shadows and shadow banking, because that's a big feature in what you've been talking about, and also seems to be a big focus at the moment from regulators and others. In fact, we had last week, I think it was, we had two things happen on the same day. The IMF warned about the sheer size of bank exposures to non-bank entities and to leverage through shadow banking, which is in excess of $4 trillion, I think the figure that was quoted. The IMF's clearly concerned about that. And on the very same day, you had the heads of a number of global investment banks warning that we were potentially looking at what increasingly looks like a bubble in the equity markets driven by the valuation of big tech stocks. So there's quite a lot of worry, it seems, about the potential systemic risks that are coming out of not just those two things, but also some of the other stuff you mentioned in terms of the sheer size of passive investment strategies as a function of the market, where really, you don't have kind of humans in the loop, in the sense that the trading decisions are dictated by the way in which an index moves, or things of that nature. So quite a lot of increasing tokenization, emergence of stable coins, the huge treasury positions that are now maintained by issuers of stable coins, and how that impact that might have on the debt markets. A lot of kind of big tectonic plates moving here in a way that you could see in a market correction could have all sorts of quite drastic and unpredictable consequences. What I kind of think of as, if I can call it, Archegos-type risks. And what's interesting about the Archegos situation is that, this is going to be slightly controversial, I'm afraid, but on one view, the regulators basically just sat and watched that happen, right? And then launched a bunch of enforcement actions, mainly against Credit Suisse, after the event. Credit Suisse was my client at the time, so I declare an interest. But do we think, the question I'm getting to is this: what should regulators be doing in the light of that? What do you think they are doing? And what's the role of market standards in that context? Because I'm assuming the regulators don't want to just sit and watch that type of thing happen again. Where does the work of the regulators and indeed the work of the financial market standards will fit into all of that picture with those changing systemic issues?
Well, I guess, as you say, I think the rise of non-bank financial intermediation in particular, I think between 2008 and 2023, all of the increase in UK corporate lending was non-bank intermediated.
Mm-hmm.
As we've seen, we've seen in the press increasing concerns raised by both heads of central banks and also CEOs of some of the major American banks last week, in terms of sort of the interconnectedness between the banking space and the non-banks. And clearly, banks are sort of exposed in various points in sort of the private credit chain. In particular, there's increasing number of joint ventures between some of the big private credit players and the banks. They're obviously significant lenders to some of those private credit players. We've also seen significant growth in prime financing and increasing leverage taken on by the multi-strategy hedge funds, which again brings some of these leveraged exposures back into the banking sector via the loans that are being made there. So I think much of the concern is about the interconnectedness between this growth of lending outside of the more heavily regulated or bank-regulated sector, and how it might find its way back into the banks in the event of the next sort of major stress event. And I think then that combined with the extremely high levels of sovereign debt and sort of a political inability in virtually every Western democracy to tackle that, and I think there's a view that it's only going to go up. I think there is a nervousness around the potential fragility of the system.
Yeah. So that segues us nicely into a bit of politics, which we're going to finish on, which is this. So given the focus of the UK government and indeed other Western governments on trying to spur growth, and given the role that they appear to ascribe to, I'm going to say deregulation is the wrong word, but lightening regulatory burdens in order to help spur that growth. Where do you see market conduct standards, and in particular the balance between regulatory rules and market-based standards going in the future? And is lighter touch regulation the right way to be going at this particular juncture, particularly given some of the risks that we've just been talking about?
So I think most people would agree that we've sort of reached the high cyclical watermark of regulation, and clearly in most major jurisdictions there is a push to either simplify or to rule books or to deregulate. And I think that's barring another crash, that's only likely to accelerate over the next couple of years when you think about different centres competing for investment and for business. And clearly one way in doing that is creating a system that seems to be sort of to be open and perhaps slightly more light touch. Now, certainly, as you mentioned at the outset, our organisation was created pursuant to public sector review. The idea here isn't to promote self-regulation; it's to promote standards alongside and to complement rule books and to fill the void between rules and actual market practice. And I think there are certain advantages to doing that in a fast-changing environment, in a fast-changing technological environment in particular, and bringing standards that are more adaptive and quicker to the market to do so, directly harnessing market practitioner expertise. To think about where risk might come from in a more forward-looking manner that, if you're sitting on a desk, perhaps you have a better view of than someone who's removed from it at a regulator. But then doing so in a manner that's very coordinated and joined up with the regulatory community. So we have memorandums of understanding in place with a number of with the UK and a number of international regulators. But going back to your sort of point around, is this the moment to push for deregulation? I'm not going to sort of give a particular view on it, but in prepping for this session, I did read something that a professor at the University of Chicago speaking at a Fed event in 2009 had said. He said, "Faith in draconian regulation is strongest at the bottom of the cycle where there's little need for it. By contrast, the misconception that markets will take care of themselves is most widespread at the top of the cycle, at the point of maximum danger to the system." And we then start, trimming. We start by trimming regulatory fat, and we finish by trimming regulatory muscle, or by not understanding why sort of the fence was erected in the first place, and creating potential future risk.
Fantastic. On that note, I will open the floor to any questions that anybody else has for Chris or indeed me. No? Okay, well, hopefully we've all suitably scared you into worrying about whether we're facing the next financial crash, but it's time for lunch, so I think if we could show our appreciation to Chris.
Hi all. Can everyone could just make their way to their seats, please. Just a huge welcome to this afternoon's session at the City and Financial Investigations and Enforcement Summit. A huge welcome to those in the auditorium, a huge welcome to those who remain with us and are joining virtually. My name is James Chadwick. I head the Investigations and Contentious Regulatory team at TLT. We are incredibly proud sponsors of today. I was incredibly relieved as well to hear from the earlier AI session that I still have a job. Steve, thank you very much for your pessimism. I'll be sending that cash in the post. I hope you're all feeling really refreshed and revitalised for what promises to be an absolute roller coaster of an afternoon. It's concisely packed with not one, not two, but three panel sessions covering incredibly topical retail market session, non-financial misconduct, whistleblowing and NDAs, and then rising to a crescendo in our final session of building culture to promote and incentivise responsible behaviour. Just please do note there are feedback cards on your tables. Do feed those out, and please do so online. And without further ado, I'm absolutely delighted to welcome on stage Caroline Hunter-Yates, partner at Simmons & Simmons, to our first session of the afternoon on retail markets focus, developments in the buy now, pay later market, consumer duty and redress. Thanks, Caroline.
Thank you. And I'm hoping to have some panelists as well. Otherwise, this is going to be one of the weirdest panel discussions I've had in a long time. Right. Brilliant. Well, lovely to see you all. I have to admit, when they first suggested this this session, and I saw BNP buy now, pay later in the title, I was thinking, do I really have to talk about it? So if we have time, we have a bit of time at the end, but we're going to also scoot a bit of Motor Finance Commission in there as well, just given how topical it is. So I'm Caroline Hunter-Yates. I'm one of the Simmons & Simmons investigative partners. I have got a fantastic panel today, and I will just ask them to introduce themselves, just so you can kind of get a sense of the range of views that you're going to hear from. We would love to make this interactive. I'm sort of toying with, as we've got it into chunks, do we make it interactive as we go through? So if people do want to sort of put a hand in the air and ask a question, please do so. I'm always keen just to get the conversation going. So Jason, do you want to kick off?
Yeah, thank you very much. My name is Jason Wassell. I'm the Chief Executive of the Consumer Credit Trade Association. So we're a trade association that's been around for 130 years. We represent very small lenders, alternative lenders, and that means that we're focuses in particularly on things like regulatory certainty, regulatory burden, and all the issues of today are very, very kind of key to our members. So happy to leave it at that just now.
Okay, thank you. Keith Richards, not the the aging rock star, so apologies for anyone who was expecting a lesson on drugs and rock and roll. But I'm Chief Executive of the Consumer Duty Alliance, which is a relatively new independent professional body that was developed to support the market in the delivery of consumer duty outcomes, which we believe is in the words of the regulator, a seismic shift from prescriptive-based rules to outcomes, and hopefully we'll get into that. My past roles were leading as Chief Executive of the Personal Finance Society, and prior to that, Director, MD of one of the sector's largest IFA businesses, and prior to that, Head of Retail for the Royal London Group.
And good afternoon. My name is David Ostitz. I'm the Director of Government Relations and Policy at PIMFA. We are the trade association for the Wealth Management, Financial Advice and Financial Planning Association. Members, we represent around 1.6 trillion in private savings and capital, around 40 to 60,000 people work in our sector, and we focus heavily on the policy and regulatory environment.
Thank you. Right, I did want to just start by touching on Motor Finance Commission. Now, you may not all have read the delight that is the consultation. I wasn't going to take you through the proposals. I think it'd be fair to say, from what we're hearing in the market, that should we say not everyone likes them. It's probably the way of politely putting them. Jason, I was just wondering if you had any views just to share on kind of your perspectives of how the FCA has done it.
Just to say, our membership is in motor finance, but it'll tend not to be the banks. It'll tend not to be what are called the captive lenders, those lenders that are associated with the car makers. So we're the kind of independent lenders, and so not DCA. We weren't involved in discretionary commissions, or primarily weren't involved in discretionary commissions. Neither were we tied to a particular lender or a particular dealership as well. Some of our members might have had high commissions, but really we were kind of left out of it. The Court of Appeal brought us into this particular nightmare, we'll call it a nightmare. The Court of Appeal brought us in, the Supreme Court helped us a little bit, but I think it's true to say that there are a number of concerns out there in the industry about things like timeline, like how far this goes back, the authority that the FCA might have to take it that far back, and how things have changed over that period as well. There is a big question there about whether the FCA has interpreted what the Supreme Court said, because it was very specific and very focused on individual cases. And they've tried to kind of, they've been asked to, it's the challenge for them is to kind of industrialize that, to make it, to upscale that, and that's been really difficult. For us, for our members, from a practical point of view, as I said, we've got many of our members where there are no cases, there's no redress going to be paid out, but commission was paid, and that means that they're in scope, and that means that I have members that have nobody that they're going to give redress to, but they will have to write out to every single customer from the last 18 years to tell them about this particular scheme. And at the moment, they're going to have to do that by recorded delivery. Not once, but possibly twice or more times than that. So from a practicality point of view, it's a nightmare. And I think I'll end with the FCA's role in all this, because I think if you've seen this, you'll see that the FCA is very keen to say it's nothing to do with them, nothing to do with us. We're just bystanders in this particular issue. And I think there's a famous kind of phrase or a kind of something that's used in banking about if you owe the bank $1 million, et cetera, et cetera. And here, if there are 100,000 claims, I think a particular firm has a problem. That firm is in problem. When you get 14 million complaints, 14 million claims, then I think the regulator has some questions to answer as well. So I'll finish there. Thank you.
I suppose just from an enforcement perspective, obviously we haven't even got the redress scheme finalised and up and running yet. We'll probably all remember that out of PPI, we got, I think it was 3 or 4 enforcements on actually the complaint handling side of it. And I suppose I was querying, are we likely to see the same thing again? One thing that's interesting about the proposals is the role of of a senior manager to oversee the whole thing. And one could say that this ought to ensure that it's being done the right way and it's being overseen correctly. I did equally wonder whether this is to, again, just try and make sure there is somebody who's going to be in the firing line. And actually whether what we might see is both some firms under investigation ultimately down the line and also some individuals. So if you are working at any organisation where you've got an SMF, I do think it's worth really making sure that they're properly briefed on the paperwork that they would want to have in front of them, with an eye on if anyone ever asks me later, what is it I wish I had written down to show my reasonable steps. I was going to leave it there on motor finance unless anyone wanted to share any thoughts from the room. Okay, good, right. Always good to check. Can we move on to the consumer duty? Now, we're obviously now just a little bit over 2 years, 2 years in. I was part of the team at Simmons leading implementation across the market, and we supported, it was about 150 clients across the market with different elements of their implementation, so kind of got to see a huge amount of, shall we say, different ways of interpreting what was actually a very long way of saying do the right thing, to, I suppose, take Theresa's phrase. And we've all been wondering, when is the first enforcement going to hit, and also what area is that going to come in? And I think it was about 14, 15 months ago, Theresa was very clear that as long as the FCA is seeing firms trying very, very hard, it has got absolutely no appetite to try and get a firm into enforcement. And that was definitely well received. What I just wanted to just touch on, though, here is really, well, what are we seeing instead? Because I've definitely seen that more kind of assertive supervisory approach coming through loud and clear on things to do with the consumer duty. It's been very loud and clear on some I've seen are on price and value. And obviously, I always have to remind clients that the FCA is not a price regulator, so it is how you got here, not the number you got there that is key. But I was wondering, Keith, if we just sort of start with anything around 166 reports, any skilled person reports, any themes that you're seeing across your side of the market?
Yeah, absolutely. So it is quite a milestone to get to a major reform and not see any enforcement within the first 2 years. That's often been the vehicle that regulators have used to get everyone's attention and try to drive the right behaviours. But how bizarre is that? Sharing bad practice or poor practice, when did that ever drive the right set of behaviours? So we've now got a regulator that is using its supervisory tools more actively, and we're seeing that across a range of how they're doing that. Certainly for those that are engaging with the regulator on a regular basis, certainly from our point of view, we've never seen such a proactive and positive level of engagement from the regulatory teams, in particular supervision. They do use Section 166s for those that are not aware, so they're a kind of enforcement, a form of enforcement, but they are encouraging the firm to take on a skilled person to focus in particular areas. Last year we saw a reduction by just under half of the use of Section 166s, and instead we saw quite a significant upturn in the level of communications called Dear CEO letters, really trying to bring the attention of key issues or areas of focus to the CEO and the executive team of organisations. This year we have seen an upturn in 166s, and the regulator sees that, so not that many 166s actually result in enforcement action at the end of it. They're a form of enforcement, but they are a good way of intervening proactively and quickly. So we've certainly seen that happen across the market, and the regulator will continue to do that. I mean, they will say that in using their supervisory tools, it will be things like the regular monthly FCA roundup. They've been far more proactive this time than they have in any time I've known in the past to give more examples of good practice. And for those of you who haven't noticed, they don't use the term bad practice anymore either. They give examples of good practice and then where firms could do better. So we're seeing a far more encouraging language and level of engagement. Clearly we've got a regulator that's committed to supporting government in delivery of growth agendas, so that's clearly having a positive impact. But I think, more noticeably, we're seeing that more positive approach where if you engage the market in a more constructive way, the regulator is being very complimentary about the amount of good practice that they're seeing across the market, the amount of change that organisations have already implemented in line with the duty. And for any of you that, I'm sure you're all perfectly aware, but 3 cross-cutting rules and 4 areas of good outcomes. For me, I started my career before regulation was introduced, so giving my age away, nearly as old as that old rocker. And candidly, we believed those outcomes were at the core of our business philosophy. So doing the right thing improved our brand awareness, improved our penetration, improved our client trust. So look at those 4 key areas of outcomes, and often if you're falling short, it's not deliberate, but I think what I've found with the regulator is that they're not critical of people who they find were deliberately doing the wrong thing. They just find plenty of the wrong things sometimes being done. And it's because of that lack of consciousness on outcomes as opposed to complying with rules. So you can comply with rules, but it doesn't mean to say you're delivering the best outcomes. And that, for me, is the most positive change that's happened, because, my goodness, if I was back in some of the organisations that I ran, I'd be absolutely downsizing the amount of processes that we do because they don't deliver better client outcomes in the sense of improving understanding, etc. So this is a seismic shift, no enforcement. Can't promise that's not going to happen in the long term, because clearly the regulator last year did actually strike off 1,500 regulated firms, and I suspect we'll see that happen at some point in the near future.
David, can I look down the table a bit further and get your thoughts?
Yeah, I just had the 166s. There's some interesting sorts of feedback we get from our members or the industry where we hear a lot about firms having to go through 166 in sort of all but name. So where a firm might feel required or obligated to go through 166. Now that's just interesting to raise because, especially from the government's growth agenda side, there's a real focus on the cost of compliance, and there is a focus on the transparency and some of the things that Keith mentioned there around DSO letters and change thematics are really, really welcomed. But there is a potential undercurrent of compliance cost and sort of pseudo-supervision which goes on, which isn't transparent or isn't captured in the numbers. I think Keith mentioned it, but I think last year there was about 40 known Section 166, I think, around 40 million. But in reality, it's probably a lot more. I think that's just an interesting point to make that we hear.
Jason, any?
Yeah, I mean, I would agree there. I think there's a lot more kind of informal discussion that's been going on, and some of that has got to be positive. But of course, there is a reason why there's a lot more kind of invitation to kind of agree with the FCA that something doesn't meet the standards of the consumer duty. There's a lot more of those conversations happening. Wouldn't you think, well, isn't this a question that you should ask yourself about whether this reaches the standard of the consumer duty? So I think there's a lot more, I think as David said, I think there's a lot more kind of informal conversation going on. And I think there's a little bit of risk there as well in that that's not very transparent and it all happens behind closed doors.
One of the things we've heard a lot about when the consumer duty is coming in is exactly this move to outcomes focused and actually how difficult it makes to implement, because actually when things are rules, you know where you are, and I can absolutely see when we come to getting into investigations actually how interesting it's going to be to work out where actually is the line, where is compliant. When the consumer duties were coming in, I actually went back to some of the things that were made public in 2005, 6, 7 around when treating customers fairly were coming in, because that was obviously, again, outcomes focused. And at the time, again, we were hearing an awful lot about, well, this is a cultural thing, however are we going to know whether it's there or not? And obviously you zoom through to now, and we have an awful lot of Principle 6, or have had an awful lot of Principle 6 investigations, and everyone knows what it is, and somehow it isn't that challenging at all. And of course, that was just the single line rather than the 200-300 pages of guidance that goes alongside it. And I do wonder, slightly to your point around actually rowing back on the processes, is whether to some extent the FCA hasn't helped itself by giving us all quite so much supporting material. So I suppose sort of that was a bit of a preamble as almost like a way into where do you think when the FCA does get round finally to an enforcement investigation, where do you think we should be most worried about where that might turn up, what it might cover? I don't know if anyone wants to come up with an idea.
Yeah, I think for me, outcomes-based regulation means that every firm and everyone within the firm is empowered to actually make changes that deliver against the outcome. The regulator keeps using the word no one size fits all. And in fact, I can't believe that for the first time in my career, I heard a regulator saying, let's not let perfect become the enemy of the good. Wow. Something that we used to say to the regulator. And basically, I think it's giving the market the confidence to throw away. As a director of various corporates, I vehemently disagreed with some of the processes we were putting in. But as soon as our compliance director said, well, that's what the FSA, now the FCA want, we just did it. Knowing that it added no value to our customers or our clients, knowing that it would send a lot of our administration staff into a spin because it was just pointless. That's what happens with rules-based, and I think outcomes-based allows you to empower someone to say, how do you improve the communication? Well, first of all, let's stop sending the customer 65 pages worth because no one reads them. We all know that. Okay, what could we do better? And you've now got the experts in the organisation actually saying, I've come up with a one-pager, and there are some addendums if for anyone who's got insomnia, but I really think we could have a massive impact with improving client understanding. Let's do it. Now, the regulator has already said, as long as we can find that you're acting in the principles of outcomes-based, and that objective was to simplify that to improve client understanding, we won't beat you up. As long as we can see that firms are moving in the right direction of delivering against outcomes, we won't beat you up. So I think to answer your point, there are some risk warnings out there that the regulator keeps putting up. The first one was a couple of years ago when they gave their first examples of good practice and where firms could do better, and that was culture and governance. And the interesting thing, I used to have a voice in my corporate world until in the end we had to demonstrate just how committed we were to compliance, and then I had no voice because I was conflicted, because I had business objectives. And basically, it was all down to our compliance department's interpretation of rules, and that's what we followed. So all of a sudden, as a business leader, I had no voice. What today has happened is firms that, given us good examples, is where the board have owned all of the outcomes and that disseminates throughout their whole reporting line, is an example of really good practice, because the key message is it's now no longer something that you outsource to compliance or risk. They have a key role to play, but actually ownership of outcomes-based sits within every member, from product design through to frontline delivery staff. Now, in some organizations where firms could do better, they give an example where the board are not discussing consumer duty outcomes. Instead, they're delegating it to a compliance and risk team. And that's where firms could do better. So I think when they go into firms, if they can see that from the leadership throughout, that it's not embedded, that the core principles are not being acted upon, that's where you're likely to see the first bit of enforcement action coming. Firms that are trying, I mean, clearly, people like David Jewell have made statements recently saying that unless there's an immediate foreseeable harm to customers or consumers, then of course immediate remedial action is required. But outside of that, as long as firms have a forward-looking strategy and plan to address any gaps or shortcomings, that's absolutely in line with the expectations of the FCA. So that's all on record for anyone who wants to start pulling all these bits as good evidence, should actually the opposite start to happen in your firm. But if you're not paying attention and you can't evidence, then almost certainly enforcement action is likely to follow.
Can I just ask you another one, actually, which is about vulnerable customers, because that's been a massive theme throughout the whole of the consumer duty, and it's been very difficult, I think, for everybody on the implementation side, again, because you don't actually necessarily know. And so when I was going through it, trying to work out what the FCA wanted firms to do, I didn't think necessarily some of the language the FCA had used had set everyone else up the right way to think about it. I'm just interested in your perspectives, and therefore whether actually what we might start to see is some people, didn't set themselves up well, and therefore this is an area where we're at risk of investigation down the line.
Yeah, it's interesting because when they first came out with vulnerability and expectations of the market, that was ahead of consumer duty. And we tried to counsel the FCA that you're using the wrong language about vulnerable customers because it's not going to land in the way that you want it to. It's about the vulnerable circumstances that people often face. So whether it's life events, that it's not just about people with identifiable disabilities. It's people that go through different experiences in their life. So most vulnerability that the regulator was trying to highlight are often temporary as opposed to permanent. And here we are today, it all got hardwired into consumer duty. And I think, PIMFA and ourselves, so we're helping small firms in the advice sector. PIMFA have been doing some work in helping the investment sector, because typically, if you're dealing with a smaller number of reasonably wealthy people that are well educated, of course, no surprise, a lot of people in these sectors don't think they've got many vulnerable customers. So the regulator clearly was concerned about those things. Mm-hmm. We've moved the dial on because actually, if you drop the word vulnerable customer entirely and just talk about customer circumstance, that captures everything. So we can talk about their objectives, their needs, and in fact their wants, but often it's the circumstances that might influence whether or not actually they should buy a product or not, or whether it's suitable for them or not. And that captures then temporary vulnerability or characteristics of vulnerability. So in other words, someone that didn't want to declare it, but when you ask about are there any other personal circumstances that we may need to consider to make sure we're providing the right level of support, well, actually, I'm just about to go through divorce and it's very messy, and right, well, that could well change things. Or we've just suffered a bereavement in our family, or a multiple of other things that people face in life that give them a temporary characteristic of vulnerability that could alter or influence the support that you as a responsible organisation want to treat them. And that's the bit that we're really trying to get across. But unfortunately, it's been stigmatised with people with an identifiable disability. And candidly, you know, the regulator, I smiled because I think back in, I was around before, just as they were getting implemented, and there was a promise by an MP that said the regulator would never exceed about 300 staff, because obviously the markets reacted, predominantly the banking and insurance sectors. Today, they've got 4,500 staff, so we breached that promise quite some time ago. But candidly, they've got such a broad remit. And the problem is, of course, the example they gave on vulnerability this year at their annual review, or the second review, was really aligned to a bank. You know, they even brought someone in that had a learning disability that found it very difficult dealing with the bank. So for people in the wealth space, stockbroking, other parts of the market, it doesn't land. The examples are not working. So I think it's really important now that we've encouraged them to work with a number of bodies across the sector who might be able to help with the interpretation relevant to the segments that they're supporting and their membership, and putting it in a terminology that makes sense. For me, I just tell everyone to drop the word vulnerability and talk about customer or client circumstance.
And then, David, just one final thing on consumer duty before we move on. One of the things that I think Keith was sort of touching on there is actually how all the different segments of the market, we are trying to sort of, shoehorn the same rules around it. And I think particularly in the wealth space, where you've got those challenges where I probably don't have people who would identify as vulnerable, and you've also got the challenges with the distribution chain and information sort of flowing up and down. Do you have any sense of where people are nervous about where, the FCA might be getting sort of more spiky with its supervision and therefore possibly tipping into investigations?
Yeah, it's a good question. From a vulnerability from our perspective, and you're right to mention it, from the advice and wealth perspective, obviously our clients, our members touch the clients much more, so we probably understand vulnerability to a different level than certain institutions who probably don't have that degree of engagement. And I think we've done one of the big benefits of consumer duty, certainly from my personal opinion, but from firms as well, is the continued work on vulnerable customers, because that is a win-win for everybody. And as Keith rightly said, it's not consumer duty as well, it's been around a lot longer than that. To your point, what I'd say is, consumer duty, when it came in, there was a danger that it could get into a bit of a cat and mouse game where the FCA say, here's the principles. I go and exercise those principles in my firm, and then the FCA comes back and goes, actually, that's not what we thought. And then it would just, me as a firm individual say, well, just tell me what to do, then give me the guidance, right, which is the exact opposite of it. And interesting vulnerable customers there, because when the first survey that the FCA did and the data came out, in our sector, they identified a very small number of vulnerable customers. And that was a fair challenge to us to go back and look at that with our members. But then that's a positive. But I just say the other flip side to that is, you could say when the FCA took retained interest on platforms, cash, another example of, well, we thought we were doing this under our rules, so you tell us. So for me, it's less with vulnerable customers. The FCA's got away now from thinking a firm must have between 10 and 50% vulnerable customers. They've got away from some of the numbers, and they're happy now to talk about, actually, what's more important is where do you direct people to when they're identified as vulnerable? And actually, how do you get people to identify as vulnerable? Because that's really hard. And let's get away from some of the numbers there. And I think that's where it's interest of the FCA, because they've got to be both that data-led regulator and use the data to point out the harms and where the potential issues are, but then they've also got to be alive to the fact that that data is just the first part of then getting into what the actual issues might be as well. And I think as long as that is happening in parallel, then I think it's positive overall.
I think one of the things we were talking about here is, you're kind of saying probably, there was a conversation about the numbers. I mean, certain sectors I represent, the FCA will be quite clear, 100% of your customer base is vulnerable. And then vulnerability becomes a label that doesn't mean anything anymore, because you do need to get into the detail of what does that actually mean. Like, okay, let's get behind the label. And usually what it is, if you continue with the phrase vulnerability, it's multiple vulnerabilities usually. And it's about trying to work out what those circumstances are and how they help. But the vulnerability label by itself, when you get to 100% of your customers are vulnerable, it's kind of, okay, what do we start with now? How do we start? And it is about taking a different view on it. I think one of the things that, just to go back into the consumer duty a little bit though, just to say that smaller lenders, smaller firms, not as keen on this idea. that we just get on with it and we have like big principles like be good. If you're a small lender, a small firm, one senior manager, a couple of members of staff, you don't have a massive team to work out what that means and to build that down, to break that down. You want more from the regulator. You want more direction. And that's a difference that I know that we have to many other parts of the industry, is we want more direction. And the move towards principles and outcomes comes with risks as well.
Can I just respond? Because Jason and I did have a laugh saying it's good to have opposing views, right? And so for me, I've been massively frustrated over the best part of 37 years of having to jump through hoops of prescriptive rules that just made no sense. Now, there are some things you need to know what the speed limit is, so we can't get away entirely from rules. But, you know, we have to be allowed and empowered to drive safely within the environment that we're in. And I think the great thing for me, and all the messages from the regulator, is if you really need me to tell you how to treat your clients right, then actually you've got to question whether or not you've got a viable business. Because I would say to you, if you set out to do the right thing, you'll attract more customers, gain greater traction about brand awareness. But of course, it is a bit of a journey because there is no one size fits all. But that's where you don't mark your own homework. You should invest on bringing people in that have a more holistic view of the market to help you benchmark where you could spot gaps and you could make improvement. And I've got to tell you, from a business owner, every time I did a review, self-initiated, my teams always found scope to improve what we were doing. And yet, actually, it was often when we were doing things well, because I realised as a young manager once I was so content that things all of a sudden started going wrong, and I realised that contentment was complacency. I'd stopped spotting that we might need to just move things along. So I think I understand why Jason's sector wants more certainty, rails to run on, but you know, in 37 years, actually, we got fed up of people giving us rails that sent us in the wrong direction and didn't allow us to deliver the outcomes. I put in rules that actually hindered outcomes to the customer because that's what we were told we had to do. Now I wouldn't do that. So I think there are big differences, but it's a brave world for people to actually undo complex processes that add no value to the 4 key outcomes than actually stick with them just in case you get it wrong. But that's, you know, let me just finally say, sorry, Jason, let me finally say, because this is worth you thinking about, and I, you know, these are the lived experiences on running big businesses, big compliance teams. We over-engineered our own processes based on our interpretation of the rules. We over-engineered it. We put the processes in place, not the regulator. And when you get into the regulator and you can honestly say that to them, I now know we over-engineered and blamed you for it. They normally smile straight away when you say that because that's exactly what they've seen. They wouldn't have put those processes in.
Okay, when we drive, you're right, but we've got this thing called the highway code. And the highway code tells us, it doesn't just say drive carefully, because that's the outcome. Drive carefully, don't cause crashes. We actually have this thing called the highway code, and it provides us with a lot of information about what we should do, when we should pass, when we shouldn't pass, when we should stop at junctions, when we shouldn't. And that's what we're looking for, is a bit more of this. I missed the thing this morning, but I go to FCA events every week. It's what I get paid to do. I've heard this be good stuff enough that it sounds neat, it sounds human, it sounds simple, but it oversimplifies some of the most complex decisions that people need to take. In my world, that's about affordability, about vulnerability, about credit decisions, about redress, and it's about all of those. And I might believe I'm getting it right, but who's going to get the enforcement? You said, who is it? I bet the next person that gets enforcement of the consumer duty thinks that they were being good. I bet that's what they say is, I think we were being good. Because it is that. In 2 years' time, the FCA will come back and say, your interpretation of the consumer duty was wrong. Now let's go back and do redress over all those customers, because that's the experience we have, unfortunately. So yes, we're scarred by our experience. your different experience, you talked about it, big companies, big risk teams. I deal with a very different sector, and therefore my view is very different about where we're going. I'll leave it at that.
Yeah, I'm going to split you two up. Just one final thing on consumer duty before we move on. For those who might end up investigating it one day, we obviously were all very conscious, the FCA was very conscious that it can't have retrospective effect. But what is surprising sometimes is when you go back to what was being said around TCF when that came in, there's a number of bits of language that are pretty much identical. And so I think there will be elements where if the FCA wants to predate 1st August 2023 for certain conduct, that may actually have a basis to do it. So just sort of keep that one in mind as and when it comes across your desk. Right, the last topic I wanted just to talk about is FOS and mass redress reform, very topical at the moment. I mean, we heard from Therese this morning, you know, the big focus from the FCA at the moment on securing redress. She did refer to the 3 big final notices from last year that had got huge amounts of money out to consumers, and you know that obviously has an impact also on the fines. Now, many of us will have read the HMT and FCA FOS consultations in a lot of detail. Hopefully the FCA will be reading the answers in a lot of detail. Jason, you were on the FOS industry steering group.
Yes.
Can you just bring it to life a little bit?
Yeah, I think so. I mean, as you kind of expect, there is a number of ways in which industry kind of interacts with the FOS. And one of the ways in which we do that is through the industry steering group, which brings together trade bodies, kind of various other organizations to speak to FOS. And so that tends to look at the strategy of FOS, their business plan, their finances, and I think they find that very useful because we can identify areas of potential concern for the future and where the trends might be. But also, I think what's been really interesting over the last couple of years is an increasing focus on the idea around reform of the FOS as well. There's been increasing interest in whether the structure that we have is really fit for purpose. And I think we've seen some of those changes already. There has been the introduction of case fees for claims management companies. There has been a discussion about how we change interest rates on redress so that we bring it more in line with what's actually happening in the market. So there are a number of kind of conversations going on, a number of decisions that have already been made, but a bigger debate that's happening just now about whether we've got the model right for the future. And I can get into more of that, but I'm sure panelists have got views as well.
Mm-hmm. David, did you want to share any thoughts?
Yes, on the FOS, I mean, the first thing I'd say is it's really important that we have the FOS as a service for consumers. When you think consumers versus financial services firms, it's absolutely right that consumers have an impartial arbitration service they can go to put themselves in a better position when things go wrong. You know, it's a free service to consumers. It's obviously not free for us because myself and our members pay for it, but all the evidence still points to the fact that if consumers feel confident in their saving and investing, they will do it. And with the government's growth agenda and the push on retail savings and investing, for everyone who's following that, which we are closely, it's even more important that FOS and the FSCS are there. That said, there's been issues with the FOS. I think Jason's mentioned it for a few years, certainly from our sector. The disconnect between the FOS and the FCA, you know, clarification of certain things, good and bad practice, is very confusing for firms. But beyond that as well, obviously, and the Treasury said this themselves as well now, where the FOS acts as a quasi-regulator, setting its own precedent, and that's something that we're all aware of. But beyond that as well, you know, the FOS's ability to set, you know, apply today's rules to retrospective action as well. So the changes that they're put forward by HMT we are very supportive of those. It's probably the most sizable change to the FOS probably since they came into being, are changes to compensation limits. What I would say is the requirement there they have to look at existing regulations to see what is fair and reasonable is a very good change. The ability for the FOS, all the firms to refer to the FCA on decisions as well, again, very much welcomed. The redress work from the FCA is slightly different, but again, not to go into detail, but all welcomed. Lead case review, the ability to put cases into a pool. But just closing out the FOS very quickly. So the challenges for our sector still with these reforms, as great they are, is even though the FOS will be required to take into due consideration the rules, if something's fair and reasonable, in the event of, say, an advisor situation, you still very much be in a situation where you sit down with the advisor, you go through their risk profile, suitability, you determine they're medium risk, and then later on the FOS will go, actually, that wasn't medium risk. So for us, I think there's more legislative change that we probably push for. I think we need to make sure that the FARs not only have to look at rules, but have to take into account and the evidence that's given to them as well from firms. I think that's a really important change that needs to be made.
I mean, one of the things I thought was very interesting from the consultations was emphasising that the idea is it's fair and reasonable to both parties, which did feel like one of the most seismic changes in not very many words at all. I don't know, Jason, if you had any sort of perspective on that, because it was almost being phrased as if this is what we always meant, it's just no one's quite appreciated it.
I think there's always been a kind of view that the FOS has positioned itself as the champion of consumers. And I think that that's probably, if you challenge that and look into it, I think they would talk about the fact that the role they play in terms of information asymmetry, for example, that yes, they might provide more information to consumers, but that's because of the fact that they've got less information or understanding, and they need to do that. But I certainly think that there has been a view over recent years that we've gone too far in that direction, and certainly over the last two and a bit chief ombudsman, we've kind of moved on that. I think that there's been more of a focus on equality and trying to be fair to both sides. I think that's it.
One of the other things I was just sort of reflecting on is obviously for many years many of us have been a bit rude about FOS. And
nobody ruder than me.
No. And obviously what the proposals are suggesting is that an awful lot of that power and authority will move to the FCA. Yeah. Should we all be worried about an over-powerful FCA without appropriate checks and balances?
Well, we should always be worried about that. We should always be worried about that. As once again, I'm scarred by my experiences, but I think with what we've been asking for is with the right kind of governance to go alongside that, and that would be a step forward. It would deal with that idea of disjoint. And we've one of the things that I think trade bodies around the table have been talking about is the need to be able to raise what we've called wider implications as well, to kind of bring that in. That there's a need for a way in which we have these discussions about individual cases and about what that means, but also about the wider implications of particular aspects as they develop, particular groups of cases as well. So I think with all of these, there's a new set of channels or lines, but one of the things we've got to be clear about is like, what is the governance around that? Are there time limits? Who's involved in those discussions? Who has the right to be involved in those discussions? And I think for us, I think yeah, absolutely, there's a concern that we replace one problem with another problem. But there are ways in which we can do this, as long as we think about what the structures are, timelines, guidance, governance, etc. Yeah.
One of the things I was sort of playing through my own mind is obviously Motor Finance Commission, and if the new rules had been in place, during that period, would we have ended up in a different place, and how would we have got there? And I still haven't quite got myself comfortable. It would have made everything much better. But Keith or David, I sort of slightly cut you off with my own comment there. Were you about to speak?
Yeah, no. I think what's interesting is we engaged the FOS several years ago because financial advisors across the market felt that they had it in for them. So to David's point, it was often a complaint that the FOS didn't follow the same set of rules that the market had to follow. What we found was quite interesting. So this is the financial advice profession. So what was interesting is, first of all, we found out that the FOS that had it in for them, only 1% of the total complaints that FOS received related to regulated advice, and only 35% of those were upheld, which kind of inferred that the FOS actually were on the side of the advisor rather than the consumer. We then found that there are subjective decisions that an ombudsman will make, because even though the file looks perfect, actually an individual arbitrator has to decide whether the client was taken advantage of. In other words, that vulnerability, client circumstances, inexperience, didn't really understand, trusted implicitly, yes, should have paid more attention, but actually, as a responsible professional firm, you should have actually spotted that and been far more diligent in the way that you documented. So it changed my view on And this year at the review, the then Chief Ombudsman actually made a pretty profound statement. So the FCA gave her a pretty key role in the second anniversary update. And she said, look, we've often been criticised for being out of kilter with regulatory rules, but the good news is we're absolutely not out of kilter with outcomes-based regulation because we've always assessed cases based on an outcome. And so the file might look good, but actually, was the outcome the right outcome? Was someone taken advantage of? And again, I go back to lived experience. We stopped financial advisors doing what we called execution-only business back in 2004. Why? Because when we did historical reviews, we found out that the client didn't realise that they'd signed a disclaimer and had done execution-only business. And we realised that the advisor simply was circumventing our own rules because we would have stopped that particular case or questioned it. So we outlawed it. We said there was no more. Either people pay for your advice or you know, why on earth would they, unless you're an order taker. So I think we've got an interesting challenge. We welcome some of the changes through the proposals, but I don't think you can ever get away from a human being deciding that factor of whether or not this consumer in these circumstances was taken advantage from. And I think with things like motor finance, like PPI that was already mentioned, as all industries have been victims of thematic reviews, when you do something in volume and it seems formulaic, everyone gets the same thing. Regulators are duty-bound to then look at that. Myself, I bought a motorbike a couple of years ago. This is interesting. There was a £3,000 deal on all the equipment only if I took out finance. I didn't want finance. I just wanted to buy no. So I had to take out £1,000 on finance so I could get the £3,000 of additional equipment. But because it was a really nice salesman, he did the wrong thing, I guess, by the company and told me that I could repay it after a month if that's what I wanted to do. And it's interesting behaviourally because the conflict of interest is evidently there because of the amount of money that they were gaining. So I couldn't get the discount unless I took out the finance. And obviously there will be inertia where a number of people will take that finance out and then they will keep paying it. The other thing was he asked me if I'd be okay to answer a series of questions, which was a requirement of the FCA. So I looked at him a bit blank and said, what's an FCA? He said, oh, sorry, it's a financial conduct authority because we organise loans and that we're regulated by the Financial Conduct Authority, so they require me to do this and get you to sign it. Anyway, he proceeded to then tell me about all the ancillary products and services that I could buy off of them. And at the end of it, I said, look, Liam, you do know the FCA don't require you to do that. And he looked at me, shocked, and said, you don't work for them, do you? And I said, I don't, but seriously, you're a really nice guy. And if you'd have just said to me, Keith, we've got a range of additional products and services that I think, as a customer, you may be interested in, would you mind if I explain them? I'd have said yes. So why on earth didn't you do that rather than blame the regulator? And anyway, I'm pleased to tell you on my first service, the manager came and thanked me and they've changed their process because they were blaming the regulator for a business opportunity on things that I could value from. But I said to them, look, frankly, the way your salesman explained it to me put me back up. And I thought, poor little sausage, he's got to do this thing because this FCA thing is making him do it, poor chap. So I think, you know, we're in a world where ombudsmen see some very poor outcomes, not the majority of good outcomes. And I think that they can end up, a bit like supervisors, with a disproportionate perspective or view of the market. And I think the level of engagement that we're hearing the regulators saying today, we've had a series of events around the country, and actually the most common phrase is people are saying, wow, I've really changed my view of the FCA. And I've got to say the supervisory team are going away saying, wow, it's really changing our view of the market. So, you know, mix with the good people, collaborate more, and I guess we all start to change our perspective. But FOS really don't have it in for anyone, and they do represent both sides. But I think, just think about endowment mis-selling, pensions mis-selling, PPI mis-selling. You know, it was formulaic, and there's no question about it, it drove behaviours. And in my particular case, I could only get a discount if I took out finance, not paying cash.
So you're the second person that's told me that. story, which I think just proves that one should never trust a car dealer.
I had an FCA official tell me that story, that he'd actually said to them, I work for the FCA, and they said, oh yeah, we'll just need to get this paperwork done, just have to get it out of the way. And he said, I do work for the FCA, and he said, yeah, but we just need to get this paperwork done, and we'll get you the keys for the car. And he came in and told me that story the next day. So, yeah.
Do we have any questions in the room? I don't know if anyone can do any online, possibly not. Any thoughts on areas of retail investigations?
More of an observation on consumer duty and rules versus outcomes. Do you not think there's a bit of a danger that we're all in a bit of a honeymoon period with consumer duty at the moment? I mean, at its core, as a lawyer, I really struggle with consumer duty. I mean, it's in rules, okay? So the rules outcomes thing doesn't really work for me, but that's just a lawyer point. But also, when you actually look at the rules are not really outcomes-based, right? What the cross-cutting rules effectively say is, thou shalt take reasonable care to avoid consumer harm. And the question of what amounts to reasonable care is where the debate is happening, right? I think it's only a matter of time before something big goes wrong in the market and the regulator is telling your constituencies, this is what that means in retrospect. And then I think the perceived advantages of consumer duty may start at that point potentially to look a bit less attractive. But I want to come back to the point about the difference between big firms and small firms in that environment, because it seems to me that, particularly in circumstances where the government's trying to increase growth and competition in the financial services area, isn't there a barrier to entry for those firms who don't have a close working relationship with their supervisory teams and therefore don't have the advantage of all of the wonderful feedback that's coming from supervisors because they don't have a supervisor? And therefore they're just left with the rule book and the published guidance, which, as one of the panel pointed out earlier, is not that different from what was in place for TCF, and yet we had motor finance under TCF. So does that not create an unlevel playing field for challengers versus incumbents, and isn't that a big competition problem?
If you were to start as a lender and come in and say to me, explain to me affordability, Jason, I would point you to the one side of A4 or something, or the one principle that says lend responsibly and sustainably. I would say that. And I said, but if you really want me to tell you what it is, I'll sit down and I'll give you the 10 pages of what the rules are. Because I've listened to 100 lenders come back from meetings with the FOS and the FCA and tell them what affordability really is. So you're absolutely right that if you look at that, you would have, if you looked at what the rule said, you'd have no idea what it actually means and what the expectations are. It's only through that experience that you have those expectations. But that all happens behind closed doors, and particularly with bigger firms. And with bigger firms that have teams that can then contest. Whereas if you're a small lender and you go in, how are you going to fight that? If they say this, you're going to follow it. You follow it. You don't go back with a, let me come back to you in 2 weeks' time with a 1,000-page document that kind of contests that. I'll just accept it. I'll just accept what you said. So there is absolutely, asymmetry is my word for the day, I think, but there is absolutely an asymmetry there between larger and smaller lenders. And larger lenders and larger firms tend to love these outcomes-based and let 1,000 flowers bloom. Is there a way? Well, yeah, let's wait until something happens to you and we'll see how that turns out.
I would just say, look, we've had 37 years of largely prescriptive-based rules. We've had and it hasn't really worked that well. You know, if you go through the principle of rectifying deficiencies in the market, you do it at the lowest common denominator because you're trying to rectify everything. By definition, good firms have to jump through the same hoops. So I think in answer to your question, there is no foolproof solution to this. I think whichever way you go and switch, for me, the seismic shift is that it does allow a lot of firms to make their own decisions based around how they see delivering the outcomes in a better way than having to jump through the same hoops as someone else. And that does take a little bit of brave movement, and inevitably someone could well get it wrong, and we're going to see that happen. But that's been happening for a long time. I remember talking to a large firm who spent 30 million on remedial action. I think the fine was a couple of million. It was for money handling issues. You know, they were incensed because not one consumer had lost a penny. And yet they had to take immediate remedial actions. I won't name them, but for those that are in the retail markets would probably know who I'm talking about. But 30 million it cost them. Now, the policyholder's paying for that somewhere. And so I think, you know, we've got to move away from those kind of environments. So, yeah, this is a brave new world. And will it be perfect? I'm pretty sure it won't. Will it work for everyone? No, but I can tell you now there's an awful lot of firms, in particular in the sectors that we deal with, that are really now starting to see the opportunity of embracing outcomes. And people are at different levels of how they're seeing that implementation. Interestingly enough, smaller firms, certainly in the sectors that I work with, absolutely are embracing outcomes-based because they didn't have lots of resource to do all the planning meetings and the projects. And so they absolutely are now getting their head around, as long as they can evidence that they're acting in the spirit of those outcomes, that's what the regulator's expecting. So I think it's a different thing. I don't know many small firms that have had massive enforcement action. I know plenty of big firms that have. So I think, you know, there are different dynamics, and I've seen big firms, even with consumer duty, again, completely over-engineer delivering outcomes. I mean, the size of the reports I've seen were just eye-watering. And you know, you discuss that quietly with the FCA and they go, wow. But, you know, I do challenge them and say, but that is partly your fault. So to the point of, you do need to give a bit more clarity on, you don't have to do all of this. So I think we're going to have to work with it as it goes, but in the spirit of, this is doing it together rather than the regulator telling us what to do and us having to comply.
Thank you. Well, thank you all so much. You've been a great audience, and thank you to our panel. It's been a great discussion. Thank you.
Well, shortly we'll be starting our second session of the afternoon, covering all things non-financial misconduct, treatment of whistleblowers and the use of NDAs. Just going to wait for one moment because I believe that Fleur may be dialing in from a beach in Greece to join us. Just bear with us for one moment.
Good setting to talk about this topic, isn't
Fleur,
it?
I think Fleur may be on actually. Can you hear us, Fleur?
I can hear you.
Wonderful, thank you. So we're going to be breaking down this topic into three. We'll just cover off non-financial misconduct first of all, move on to treatment of whistleblowers, and then just talk about the use of NDAs. Look, I'm sure you've all been to conferences in the recent past. Every single one that I've certainly been to has covered off the topic of non-financial misconduct. It's obviously been on the radar of the FCA for a number of years. There's been a huge amount of concern in the market and a request for a significant amount of guidance, and I'm sure therefore you have been desperately awaiting this session this afternoon so that we can unpick that for you. Just using Keith's phraseology, actually, we're certainly not in a place where we're jumping through the hoops of regulatory rules within this space. So building on previous consultation in 2023 and the pausing of action in the D&I space, CP 2518 confirmed changes to the COCON rules. The team from Herbert Smith Freehill obviously gave a really useful overview, I think, earlier on today. And so the position is obviously that there could be additional handbook guidance on the application of COCON and FIT, which the FCA may finalise in due course if there is clear support for that within the market. Quite what that means, question mark. But importantly, what the policy statement did say, and I'm just going to read directly from it because I think the quotation is important, is one of the clearest warning signs of a failing culture is non-financial misconduct. Behaviours such as bullying and sexual harassment, going unchallenged. Failure to tackle toxic behaviours drives away good people, prevents staff from speaking up, and undermines performance. It damages growth and enables financial misconduct. So I'm really proud to be joined today by two incredible speakers. My amazing colleague Chantal Peters, Financial Services Disputes and Investigations Partner at TLT. Chantal has extensive experience advising financial institutions in relation to particularly non-financial misconduct and conduct matters more generally. She's been a consistent thought leader and commentator on all things conduct, non-financial misconduct and whistleblowing, and also, again, really honoured to be joined by Fleur. She just thought that this topic was so important that she'd take a break from her holiday in Greece to be joining us. So without further ado, just moving on to non-financial misconduct as a topic, and maybe just start off with you, Chantal. Are we any further in understanding when non-financial misconduct becomes a regulatory issue?
I think we have to say yes, because we've now got some guidance, and that's what was missing. And I think from my perspective, certainly, and going to the earlier point about doing the right thing, I think firms have been wanting to do the right thing, which is why we're in this position now, and for years they've been crying out for that guidance. And so it's helpful that we do have something. Query whether we actually know what the tipping point is. I think some of the elements that have made their way into the guidance are things that firms were probably already considering, but the piece that's missing is sort of the benchmarking piece, where the tipping point is. And it's, you know, it's a really difficult topic because there's so much that lies on context and, you know, fact specific. But I do think that there are some grey areas that remain, and I do have sympathy with firms in that regard. Where we're at, and as James mentioned, there was an earlier download around the changes, so won't go into that in much detail, but just to draw out some of the areas where it might get quite tricky for firms. So we've got the extension of COCON to non-banks in the context of non-financial misconduct, but then we have an exclusion that relates to a non-bank's unregulated business. So you can quite easily see how you may have two colleagues within the same firm working in different parts of the business and having different outcomes if we're looking at non-financial misconduct. There's an attempt to align to employment law definitions. Again, it was mentioned earlier that it's a bit broader now from the FCA's perspective, not linked to protected characteristics. So we've still got those two employment and regulatory regimes working in tandem that are not completely aligned. We now have clarification that when we're looking at non-financial misconduct, that can trigger Conduct Rule 1 or Conduct Rule 2. And we've almost got like a layered approach being adopted. So if we're looking at Conduct Rule 1, it has to be both serious and lack integrity. We've got a list of things that may indicate that something is serious, quite similar to what we saw the SRA introduce a few years ago. So patterns, duration, impact, imbalance of power, vulnerabilities, but no guidance on does one of those things mean it's serious, or we're looking at a combination, how many, how do we get that tipping point? We've got some guidance on what lacking integrity means for Conduct Rule 1, and that's a subjective test. So if the staff member in question thought the conduct was good and there was a good and proper reason behind the conduct, and the conduct was proportionate to the intended aim and didn't have a negative impact. So a reasonableness test there that firms need to navigate potential defences. So that's just one for Conduct Rule 1. If there's no lack of integrity, it could still get caught by Conduct Rule 2 if it's serious misconduct. And then we've got an additional layer, which is Conduct Rule 2 in the context of a manager, and guidance around failing to take reasonable steps to protect staff against non-financial misconduct. Again, with a defence of acting reasonably. So we're widening the net. We've got to think about managers when we see an incident of non-financial misconduct. And I do think that's a positive addition. And if any of you attended the Culture Summit earlier on in the year, we talked about this middle management situation we see where, you know, quite often firms don't look further up the chain, and I do think the guidance that has been given around Conduct Rule 2 in the context of a manager is still very much focused on that middle management bracket, and so query whether it will actually end up further up the chain. So that's conduct rules. We've then got more significant guidance around fit and what non-financial misconduct means from an F&P perspective. Now, conduct in private life is only relevant for F&P. It's not relevant for conduct rules. We've had that clarification. That all relates to the limitations of FSMA. But I think fit is where we get the lines become very blurred, actually, and I think we'll touch upon some examples a bit later on to bring that to life. But basically, conduct will be relevant if it demonstrates a risk that the individual may breach regulatory requirements, or if the conduct in question may be repeated in work. But we get a blurry line that then says, but even if the risk of repeating that conduct in work is low, it still may be relevant. And as I say, we'll bring that to life later. We've got separate considerations for seriousness. So a list that's relevant to conduct rules, a separate list that's relevant to F&P. We've got a table that talks about the distinction between personal life and private life, with the FCA themselves acknowledging in certain scenarios that you know, they can't give an answer because it relates to circumstances. And we have got confirmation that social media can be relevant, albeit people should be allowed to express potentially controversial views, even if that may offend other members of the workforce. That doesn't necessarily call into question F&P. So I think when I bring all that together, yes, we've got a bit more, but we've still got the risk for inconsistent outcomes. We've still got inconsistent definitions across various elements. There are various layered tests, possible defences, subjective tests, and we've got now evidential barriers because if there's something in someone's private life and a firm is made aware of it, they're expected to take reasonable steps to look into that, but question how much evidence they can get if it's taken place outside of the workplace. So I have to say I have sympathy for firms, because I still think there's a lot they're going to have to navigate on their own, which they have been doing for years. And I think that practically it may cause some frustrations and difficulty for firms.
We're certainly on the journey, I think, but I mean, Fleur, sort of perfect opportunity to come to you from an in-house perspective. What challenges do you think the proposed guidance poses for firms when they're trying to navigate these incredibly multifaceted and complex subjects? I'm also interested to hear actually from you, given the fact that, you know, from that sort of international perspective, given the fact that you work within a global player. Thanks, Fleur.
Yeah, thank you very much, and thank you, Chantal. It's an excellent summary of the changes. I don't think we should at all underestimate challenges for firms. I think they are very, very difficult challenges to get our arms around from all sorts of perspectives, and not least, as you say, in relation to multi-jurisdictional firms. I think that, you know, in the absence of many precedent cases, I think we're very reliant at the moment on subjective judgments, on, you know, interpretation, in-house interpretations of what the rules mean. The FCA have given us some examples, but I don't think, my personal view is I don't think they've given us sufficient to be able to make some of the judgments that they're expecting firms to make. Particularly, you know, where you have conduct that would ordinarily have been dealt with through an HR process or disciplinary process, you know, where that tips into regulatory misconduct and then ought to be considered as part of F&P. I think, you know, that is those subjective judgments that I think firms are going to find very difficult to make. Chantal's kind of pointed to some of the challenges, but initially then scoping and defining what the firm considers to be regulatory non-financial misconduct, but then investigating. There's definitely a tension between, you know, what the firm can look at to the extent that it complies with the individual's privacy rights. I think when you are talking about social media or talking about activities outside work, there are obvious practical challenges in navigating for a firm in trying to gather evidence or conduct an internal investigation of what's happened and how it ought to be how it ought to be determined on a regulatory or disciplinary basis.
Thanks, Fleur. And you just mentioned the examples that have been drawn out. I mean, it might be worthwhile just trying to bring some of those examples to life just for the benefit of the audience, Chantal. I don't know whether it's just reflecting on what Fleur's just spoken about.
Yeah.
Could you just bring that discussion to life?
Yeah, and I mean, I'm not going to make anyone put their hand up for things that they may not want to disclose, but minor driving offences, I'm pretty sure probably a lot of people in this room at some point in their life have had a minor driving offence. I actually haven't. I'm one of those really boring drivers, but minor driving offences. So that's actually quoted by the FCA as not normally being relevant to F&P, which I think we all would say, yeah, I get that. Not really struggling to see the connection to regulatory requirements. But actually they say if someone has repeated minor driving offences, this may show an unwillingness to comply with the regulatory system. And I think this is, it begs the question, where do you draw the line? And if we've got anyone in the room who comes to these conferences regularly, I think there was one about 3 or 4 years ago that was talking about non-financial misconduct, and the example that was used was, so you work away a lot and you stay in hotels and you take the toiletries, the little mini toiletries. Is that a conduct rule F&P issue? Is taking the slippers or the dressing gown from the hotel?
It was presented as a sliding scale.
A sliding scale, yeah.
Toiletries through to a dressing gown.
Yeah, and my question is, are we now in that space again when we're talking about minor driving offences? Where do we draw the line? What minor offences are brought into this assessment, and how do firms practically police those sorts of matters? Because they are minor, and how many do you need to make it tip into this is an F&P issue? So I think that's a prime example of where it becomes very difficult. And then secondly, inconsistency within the guidance itself. So the FCA talks about violence and sexual misconduct in private life and says that may show a risk, or if that shows a risk of possibly repeating in work, that does become an F&P issue. We're still seeing a link to work there because the regulator's saying if there's a risk it will be repeated. So it's kind of aligned to Frensham, where you've got to show some connection to the regulated role. But then further down in the guidance it becomes more blurry, because the FCA say, well, even if there's no risk of something in the private life being repeated in work, even if that risk is low, if the conduct demonstrates willingness to disregard legal obligations, an abuse of trust, or exploiting vulnerabilities, then that can become an F&P issue. And so then, to me, that begs the question, well, surely sexual misconduct is always going to be an F&P question. So why do you have the earlier comment around only if it looks like it's going to be repeated in work? So I think even within the guidance is still inconsistency. It's still going to be difficult for firms to reach a landing spot on that, and then potentially the risk for inconsistency across industry when those decisions are being made. I don't know if Fleur's got any other comments on those specific examples. And
I think those are good examples, and I think particularly the issue around kind of likeliness of conduct being repeated. I mean, that is almost impossible for a firm to determine, whether or not somebody might do something again in the future in the same vein. I think it just really illustrates, the complexities and difficulties of trying to codify what is really kind of messy human behaviour. But the FCA are saying that this is something that firms must do. So I think I think that the guidance could be stronger and more user friendly for firms. At the moment, it is quite difficult to put things into the right categories for firms, given all of these open questions, and as you said, Chantal, some of the inconsistencies that are contained in the guidance.
also unhelpful.
I think it's also the secondary challenge for the firm is, when you're making these decisions, trying to explain them to the individuals who are impacted, given that we have different regimes, different definitions. You could have not a lack of integrity for conduct rule, but a lack of integrity when it comes to F&P. What does that mean from a disciplinary perspective? And how do staff, senior managers, understand in their day-to-day what they are doing is right or where it could trigger those matters? How do you train them? It's a bit easier for us legal compliance risk people because we're in the weeds of this guidance. We'll be using it every day when we're analysing behaviour. But for individuals that don't go through it with a fine-tooth comb and understand the nuances, some decisions probably quite confusing from their perspective.
I think that's certainly correct. And also, I think we like to find in a number of these scenarios that, it might amount to a situation where two people are together in a situation where one person is saying one thing, one person is saying another thing, and then how is the firm to resolve that between those two? I think it's very, very difficult without additional kind of support on either side. But those are the sorts of decisions that we're going to have to wrestle with.
100%. And Fleur, sorry, just one, before we do move on to whistleblowing, just on non-financial misconduct, do you have any sort of further comments around cultural and organisational barriers? I appreciate not from a Barclays perspective, but more generally in terms of that sort of in-house view.
Yeah, absolutely. I mean, we are likely to come across, I think, as a kind of multi-jurisdictional firm, cultural norms that apply in different parts of the world, different parts of the business. But I think that is one of the major challenges, is trying to reconcile these into a single firm-wide approach to issues of culture and conduct. It's hugely challenging, but I think it's a question of training, increased training. I think firms will, I expect they already have done this, but to ensure that policies are very, very clear, very aligned across the different business areas, that there is senior management engagement, because obviously the tone needs to come from the top. It needs to be something that's reinforced from the top of the house. But you're absolutely right. The cultural barriers are an important and key consideration, and an additional layer of complexity and challenge in this arena.
Thanks, Fleur. And just moving on to our second topic, so on whistleblowing more generally, just Chantal, back to you again. What are the latest developments in the whistleblowing space?
Yeah, I think that the first comment I'd make is it's still very much a live issue, the treatment of whistleblowers. And I had to remind myself of some of the data out there, and it is quite alarming, some of the data and the stats that we see. So Sexism in the City, which was released 2023-24, reported overwhelmingly negative view of the effectiveness of FS whistleblowing procedures. Individuals thinking that HR was focused on protecting the firm. Protect, the UK's whistleblowing charity, report a third of whistleblowers who contact them feel they have the complaints ignored. 70% experience some sort of retaliation, and 20% ultimately get dismissed. Can't buy silence. They reported 70% of individuals in financial services that experienced sexual harassment or bullying didn't report, and that's 17% higher than in any other industry. So I think it's very much a live topic. It's useful we're talking about it. When we look at the proposed guidance from the FCA, what we get is an example of a breach of Conduct Rule 1 is subjecting a fellow member of the workforce to detriment for being open or cooperative with the regulator or for using whistleblowing channels. And so question whether guidance has gone far enough. Could there be an actual conduct rule that was focused around protecting whistleblowers in its own right? And particularly given the comments we see around the perception that the protection is around the firm as opposed to the individual. Now, this lighter touch approach from the FCA may be due to pending legislative changes So we know there are going to be some amendments with the Employment Rights Bill that will add sexual harassment as a qualifying disclosure. So that could explain the lighter touch by the FCA in their guidance. But I think one of the interesting things that I see is that what we hear from those sorts of stats and the industry and victims of harassment or sexual abuse is that they actually want to blow the whistle, so it's not like they're not wanting to. It's that they don't believe that they are being heard, and they don't trust the internal mechanisms. And now that's quite... what I find quite surprising is obviously we know the FCA have had their own whistleblowing channel now for a number of years, and I think feedback in sexism in the city was it's not well known, not well publicised, and clearly if individuals feel like they can't trust the internal channels, it's great that there's an external channel there. And what we do see through the FCA data is that most individuals who use that channel do give their identity, so they obviously feel that they can trust the regulator. So I do question whether there's more that can be done around publicising that route, how it works, a bit more that the FCA could probably do in that regard to bridge the gap. And the final trend I'd mention is just around momentum around paying whistleblowers. It's a topic that we've seen at this conference a number of years, but we're seeing a bit more movement in that space. So the director of the SFO, Nick Fgrave, he's a huge advocate for this. He's included it in the 25-26 business plan. He's interested in introducing similar rewards as to what we see in the US, so 10 to 30% of the value of the penalty levied if there is a prosecution. And we have seen the FCA make a reference to them being in discussion with government and other agencies around potential to pay rewards. So this is something that could, it could very much become something in the UK. Do question whether that's what we need, because as I say, it does look like people do want to blow the whistle. It's just having more faith in the process that sits behind it.
Yeah, and it certainly will be interesting to see if we follow the US in that regard. But Fleur, again, over to you, if possible, just to see how we're seeing those changes in guidance sort of play out in practice, and what does that mean for firms?
Yes, so I've seen that the FCA has seen an uptick in whistleblower reports to it, which is, I think, an encouraging statistic. So I think that they've seen over the last year a 25% increase since I think in Q2 2025, and a 25% increase to the same period last year. And the FCA has come out with some additional guidance around how it treats whistleblowers to its line, which I think is also quite helpful. So I remember, I think it was a conference maybe 2 or 3 years ago, noting that I think there are thousands unresolved whistleblowers to the FCA. And they seem to have tightened up quite a lot their approach to whistleblowing in terms of keeping whistleblowers informed, resolving whistleblowers, keeping them up to date on actions that have been taken. So I think it was one of the big complaints to the ESPO with regards to the FCA's whistleblowing processes was that people were making reports, but then they were left sort of hanging without any resolution, and not having been told whether any significant action had taken place as a consequence. So if that is happening in practice, that whistleblowers are being kept up to date better and more action is being taken on the back of whistleblowers, I think that can only be a good thing. Firms, I mean, I don't think it's any secret, it's in the public domain, but Barclays had its own issues as regards whistleblowing some years ago, and has certainly beefed up its whistleblowing processes. I'm sure other firms have done the same. The wind is certainly blowing in that direction. Protection of whistleblowers and encouragement of whistleblowers to come forward via kind of multi-channels is something that if firms are not doing, they ought to be doing. To make the process as comfortable as it can be. I mean, it's not a comfortable process, but as comfortable as it can be. And then, in just as regards the kind of final point that you touched on around paying whistleblowers, I have to say on a personal level, I do have some reservations. I think that when you're talking about people who might blow the whistle to the SFO versus people who might blow the whistle to the FCA, you do have a different relationship as a kind of regulated and a regulated community with the FCA than people who might blow the whistle to the SFO would have. And I do wonder how that would be impacted by the prospects of being paid for what you're already supposed to be doing, which is notifying the FCA of things that they would want to know. So I do think that's got some interesting question marks over it, and I will be interested to see how that progresses.
Yeah, and I think a lot of the research around how that's working in the US is divided and query the extent to which it has improved the quality of the types of whistleblowing that going through the reward channel in the US as opposed to the speed and efficiency. So yeah, very divided.
That's certainly correct, and obviously quantity doesn't necessarily equal quality when it comes to whistleblowing. But you're right, I mean, if there's an incentive to make whistleblowers don't really have much substance, then you might see the quantity increase, but not necessarily the quality.
100%, and obviously a huge issue for in-house to be able to police those kind of issues when there's potentially multiple whistleblowings coming in, all of whom want an incentive pay. Just moving on to our final topic, we're just conscious that we do want to leave some time today, given how important this topic is, no doubt for everybody at the conference, for some questions. So we just move on just quickly to NDAs. I'm going to turn to Chantal. Clearly there are going to be limitations in what Fleur can or can't say in relation to this topic. So NDAs were obviously raised, I think as Chantal has already mentioned, as a major concern within the sexism in the city. Inquiry is being used as a method of silencing legitimate complaints. The Employment Rights Bill has also been mentioned, which helpfully obviously includes some real advancements within that area, focused on addressing sexual harassment in the workplace and controlling the use of NDAs. But big question, I think, for you, Chantal, is further regulatory intervention required?
Well, the FCA has seemed to have halted the work in this space. It was a line of questioning in the non-financial misconduct survey back in 24, but we've not seen anything come through into the guidance around this topic. And so as it stands, we've got the CISC 18 can't prevent whistleblowing within a settlement agreement, and we've got the employment law position that's pending. And so I think maybe again a light touch by the regulator because of that, the Employment Rights Bill due to land. Interestingly, in the non-financial misconduct survey, the FCA just refers firms to the SRA warning notice on NDAs. And the SRA, we know, took quite a hard line by saying any inappropriate use of NDAs would be considered to be a breach of the SRA principles. And so, seemingly not really done much in this space, the FCA. I think the concerns being raised by Sex and the City and other forums are valid. So an individual will have to breach an NDA in order to then find out whether the law will protect it. That's quite a daunting thing to do, to go up against your employer, former employer. So you've got to breach the position to then defend yourself. There's the cost of doing that up front, and then just the perceived inequality, individual versus their employer in a tribunal setting. So I do think it's where we're at is that individuals feel like they're very much on their own, and they could do with an ally in this space when it comes to NDAs. When you look at the position in the US again, very much robust action. We've seen the SEC take enforcement action and fine JP Morgan 18 million for individual clients having to sign settlement agreements which prevented them blowing the whistle to regulatory authorities. And so, yeah, I do think there's more that can be done so that individuals feel like they're not on their own in that situation. And I think that the regulator could take a bit of a harder line when it comes to NDAs, because I do think that the silence in these sorts of cases is a real issue, and it's that piece that breaks the speak up culture that we all talk about so much, the regulator talks about so much. So my personal view, yeah, they could probably do more.
Thank you very much. And I'm just going to pause one moment, actually, just to see if there were any further questions from the floor. I do have some further questions, but I'm just going to hold off on those until such time as we maybe get through that. So does anyone have any specific questions for either Fleur or Chantal on any of the topics that we've covered off?
Quite a lot.
I'm sure if the FCA was in this room, you'd certainly have a lot of questions around non-financial misconduct. No? Just two quick questions then, actually. I mean, firstly, obviously, to you, Fleur, if you can say this now because the FCA is not in the room, but if you were the regulator, what would you do now? What would you do to take matters forward?
I think that the FCA could unify its guidance and unify it into a single source book. Because at the moment you've got, as Chantal has outlined really clearly, you've got parts of non-financial misconduct that are applicable to COCOM, parts are applicable to FIT, you've got parts in the enforcement guide, parts in the whistleblowing instrument, then various speeches, DCO letters, and I think that is, obviously it's an important agenda for the FCA, it's an important endeavour, and I think that assisting firms better with a clearer and more unified codified approach would be beneficial to further that agenda. I also thought it was interesting what Chantal was saying about US in relation to NDAs. I think that there is more in the FCA. I'm surprised actually that because the FCA and the UK has been frankly a world leader in non-financial misconduct. It has the most progressive regime I think in the world. I'm surprised that the FCA hasn't followed suit with US style rules and guidance around NDAs, but I wouldn't be surprised if that were to follow. And then, included within that sphere, more guidance to assist the industry in more examples that the industry can use to benchmark. Because at the moment, as I said earlier, there isn't a suite of precedent cases for the industry to use to gauge where things ought to be sitting.
And same question to you, Chantal.
I think it would be a similar answer to as Fleur's just given. Clearly, when they say we'll decide whether we keep the guidance or not, depending on feedback, I think we all know that firms want the guidance. I think that's a given. But I think there's obviously clear inconsistencies that we've identified today that need to be bottomed out. And I do think, from our perspective, and you would echo these comments, James, when we speak to clients, that benchmarking piece that Fleur has mentioned is the piece that they always struggle with and they want a bit more. And I sit here and I do recognise it's difficult for the regulator because, the more you give, people will try and follow it to the exact letter. And we know that there's context and, fact specific, but I do think there's a bit more that needs to be given around the tipping point so that we get a bit more consistency across the market. And I think that's really important because at the end of the day, we're talking about individuals' livelihoods, careers, reputations. It's a really important issue. And to just talk about the FCA's growth ambitions, we want to encourage people to work in FS. We want people to take on the senior manager roles. We don't want to discourage individuals, and so I do think it's really important that there's clarity for that reason as well.
Fantastic, thank you.
And just one more thing to touch on. I think a lot of firms will see the kind of parallel running of HR processes and disciplinary process alongside, a non-financial misconduct regulatory cases as quite problematic. And I think the FCA would help firms by setting out a framework as to how that ought to work. I think that would be a benefit to the industry.
Fleur, having heard the FCA speak on this topic on multiple occasions, I think that their response to that would be actually we don't want to give that level of guidance because we want firms to self-police. So it seems like a slightly vicious circle. But just moving over to the floor, does anybody else have any questions that they would like to raise with the panel? No? Could you all just join me in thanking Chantal and Fleur for what's been a fantastic session? I think what's fair to say is that non-financial misconduct is not simply a regulatory issue. It's not just a test for the FCA. It's clearly it's incumbent on firms and their senior managers to be able to set the tone and drive their own culture. Firms clearly are playing a critical role in non-financial misconduct and tackling that topic, and also the treatment of whistleblowers. Almost as if we planned it, that seems like the perfect segue into our next session on building a culture which promotes and incentivises responsible behaviour to prevent an investigation on or mitigate its impact. Can I just welcome on stage Kerry Bircham of Burgess Salmon just to moderate that session? Thanks, Kerry.
Congratulations, everyone. You've made it to the final slot. I think we may face some challenge and that you might be feeling a little bit sleepy, but hopefully there's greater opportunity in the subject matter. Welcome to the stage, Emma, Gemma, and Mary. We decided to skip the intros because a quick pre-panel chat revealed that we had hours of content to fit into just 40 minutes. And you can also look us up on your clever app and on LinkedIn. We'll take a trip around the good, the bad, the ugly. We'll have a look at some practical tips on how to embed good culture throughout an organization. And then we'll finish by having a look at the space in which the regulator's eye has really been drawn into something going wrong. So without further ado, let's start with a look at good culture and responsible behavior and see if we can pin down more clearly what we mean by these things. Mary, would you like to kick off?
Yeah, I mean, I think, look, good culture is doing well by doing good, right? At the end of the day, you want a culture where people behave the way they're supposed to, where everyone can act authentically, where people treat each other well, and where you can unlock benefits. You know, when you lead a business, and I've been a CEO and I now am a board member, you're trying to get the best out of your people. And there's actually quite a lot of evidence that says, and studies that show, that people who feel threatened or stressed, you pay a tax for that, right? Because people are spending a lot of time in self-protective mode rather than being innovative, being thoughtful. So it actually develops growth. The other thing I think as board member in particular is kind of two things. One is, you know, as a board member, you really are responsible for setting that tone for the top, right? Saying what your expectations are. So, you know, a good example would be this NDA conversation we've been having, right? We want to have a good culture and we're not going to sign routine NDAs. Like, boards should simply be saying that. I mean, that's the reality because they're the ones who insist on it. So you know, the reality is it kind of starts with you. And board members are the only people who can hold senior executives to account, right? And to make sure that the right tone is set and that you have information so that you can see what's happening. And finally, I think from, you know, board perspective, you know, they say that culture really comes down to, you know, the lowest common denominator of behavior that you're willing to tolerate. And again, I think it's for boards to step up when they see things like non-financial misconduct and to hold the executives to account and to make sure that happens. And, you know, the examples that were given in the last talk, I mean, it's clear that that isn't happening routinely.
Okay, so that's what good looks like. Emma.
Oh, dear.
Emma, I know you've got some really interesting examples to share about what bad looks like.
Do.
Over to you.
It's a pleasure to be here. So I work as an independent advisor. Prior to that, I worked for various companies, and for full disclosure, I used to work for HSBC. What I'm doing now builds on the good practices, I will say, from the work I did working in the business, particularly at HSBC. But over the last few years, I've had some really interesting challenges. So one of which I was an expert witness on a court case here in the UK, and it was around an online broker making available contracts for different CFDs. Probably anybody in the financial services industry probably aware, high-risk product, highly leveraged. And the case revolved around the opt-up process from retail to elective professional. And Mary, I love your optimism about tone from the top. this particular broker was breaking the regulations, and it was the sales team and the compliance teams who were implicated in the activity. So suffice to say, it did go to court. So that's one example where we are seeing bad practices in the UK, and this was quite recently as well, which means for me, it's not good enough you can't be complacent. And you've got to have those checks and balances from the board level down to make sure that what you think is happening is actually happening. I'll just pause there because I know we've got a lot to get through.
Anything from Mary or Gemma on this?
The only thing I'd add to that is, and I think it's really interesting when you come to like non-financial misconduct, like a lot of boards really want to see that there are no issues, right? I can't tell you how many times I've sat there and people are like, no issues, right? No issues, no whistleblowing, no issues. Well, you know what? It's endemic in society, right? So therefore you have to have issues, and you need to recognize there's a certain level of issues, and then, you know, and when they get to a certain level, then things need to happen about them. And I think until we all kind of acknowledge that green is not always good, that you know, we're going to be stuck in this cycle.
And I think you need to think about, so absolutely, tone from the top. If you don't have that, there's no starting point here. So very much you do need that. But even when you do have that, we see so many examples of things still going wrong, because it's not just the people at the top. It's not even just managers. So if you think about an organisation as big as HSBC, every single person, and there's over 200,000 people in HSBC, they are all culture carriers. Every single one of us is a culture carrier. Some of us are also culture makers, but everybody has that role to play. And if we're not thinking about this very personally, and I think we'll come on to, you know, what you can do systemically and the processes you can put in place, but actually, if you're not taking it personally, and if you're not thinking everybody here is equally responsible, then you're not going to get what you want, because the board or the CEO or the OpCo or whoever it is not in the room 24/7 with 200,000 people. So absolutely it starts there, but it does not end there. It's very much all people all of the time, and it is so personal that, you know, if I would absolutely stand by, if you've got more than, say, 50 people in your organisation, you've got more than one culture going on in your organisation, because it is just defined by the people that you work with, whether that's the team, whether that's the department, whether that's the person sitting next to you. So very personal, and that experience that people can have working at the same organisation can be totally different depending on the area you work in. I don't think the previous speaker threw in what happens when you're in different countries and how does that affect things. So massively important to take it personally, as well as, you know, what the systems are telling you.
So Gemma, staying with you and driving further into your experience of making this live and breathe in a big organisation like HSBC, could you give some practical pointers to how the tone comes down from the top?
I mean, this is definitely a 3-day workshop in the space of 5 minutes. But okay, there's a lot of jigsaw pieces, and we'll come on to some of those. But I think before we talk about those, what I would say the differentiator that I have seen is focus, commitment, and follow through. Because if you don't have that, then the jigsaw pieces are just tick boxes. So if I think about, I don't know, think about, do you want to be collaborative as an organisation? Okay, that's great. That's a word on the page that we all want and we can all sign up to. But what else are we doing? What have we done to facilitate collaboration? Do we have collaborative spaces? Are they online? Are they offline? Do we have people that are experts in being able to facilitate people coming together? Because anybody who's been in a workshop will know that that's a real skill from the person that's running that. Do you have those people in your organisation? Are you hiring people that have a track record of really good collaborative projects that they have delivered? All of these things together, are we rewarding collaboration? Have we got team incentives versus individual incentives? All of these things stacked up is that clarity of focus on what you need to deliver that cultural aspect has to follow through absolutely everything that you're talking about. So you think about the whole employee life cycle. So here's where all your jigsaw pieces kind of slot in. So who are you hiring? Do you have a cultural set of questions? Do you have a values-led interview process, or are you just looking at technical skills for people? So you're looking at cultural fit. What do those people bring to your organisation? Not just do they fit with the culture you have, but do they bring something else? Talk a lot about diversity of thought. You don't want exact replicas of everybody. So do they fit? Yes. But can they bring something else to the party? Who are you hiring? Who are you promoting? Who are you rewarding? What are those reward processes? And I think we'll talk a little bit about incentives later, but what do those actually look like? Are they there to drive the right behaviours? All the way through to, why are people leaving? Do you understand why people are leaving? Are they leaving in one area or not another area? Do they love one area or not another area? Why is that? And do the subcultures work for you? They're not necessarily a bad thing, but do you understand them? Do you make them work for you? And I would probably end with a non-financial services example of what this looks like. Whether you like the culture or not, it was about 10 years ago now that I read this book called The Zappos Experience, and I don't know if anybody knows who Zappos is. Shoes, thank you, yeah. So they're an online retailer. And I think the book was about 15 years ago, so I'm kind of sounding like I'm going to plug the book here, but the thing that I took from that book was not the culture that they wanted. They wanted a culture that was centered around customers, where they built an emotional relationship with the customer base that they had. That's great. But was their single-minded determination around their culture, to the point where they would do things like they'd bring people in, everybody would have a 4-week induction process. Do we have an induction process? Does everybody have an induction process? What does that look like? They had 4 weeks. It didn't matter what role you were in, whether or not you were in IT or a management position or even a CEO. During that time, you were in the front office. So you were front of house in the service centres. You spent the time there. You understood what was going on and what was needed in the business. And then the thing that they are famous for, this is effectively why the book got written, is at the end of that induction process, and I believe they still do this, they offered all staff, all their new joiners, $2,000 to leave. So, and I'm not suggesting that is a thing that we should all adopt, but for me, it was that single-minded determination about cultural fit. So they basically knew that people needed a job. People need jobs. So that people aren't going to leave if they think they can work there and they've passed their induction. They're not going to leave voluntarily. So what they did was they gave a set amount of money that they thought would give somebody a cushion to leave and get another job if they thought that they were not a good cultural fit for the organisation. So maybe not something that I think that we would adopt, certainly not something that HSBC is advocating, but for me it was just that placing the importance of culture above everything that they were doing, so that they really honed in and kept that focus and really thought about everything that they did. Does it drive the right culture? Does it drive the right behaviours? Does it drive the outcomes? We talked about that in some of the other sessions. What's the outcome that they want? They want good customer service where they've got repeat customers that truly love what they do. That's the outcome they want. They believe that the culture that they have will drive that outcome, and they are single-minded about it. Are we all as single-minded, I would say? Are we all as up for that challenge?
Thank you. Emma, would you like to add some thoughts?
Yeah, so I'm going to bring this into something very tangible, because we talk a lot about behaviour and culture, and I think some people find it a bit too fluffy. So in a previous role, I headed up global client service, and there were 2 things that I did that were specific around culture. I mean, they had other outcomes as well, but first of all, I used to host a lot of town halls for my teams around the world, and part of that content was always stories about good customer outcomes. And if I could get examples from the different teams across the world, even better, because that then resonates and people go, oh, okay. If they weren't getting it before about what good looks like in their particular customer base or for those particular products, you can talk about it and it makes it more tangible for people. This is particularly good for junior people. I mean, for those of us who've been in the industry a while, we should know, but we need to bring everybody up to the same level. So that's the one thing I did. The other thing was I walked the floor. The best way to find out what's really going on, talk to your teams, get out there and talk to them. And I mean, I know at the moment, there's maybe restrictions on travel budgets and so on and so forth, but I was lucky enough to be able to travel and meet a lot of my teams. I also met with clients to get their viewpoint on what their experience was, how they were feeling about what they were receiving in terms of client service and also in terms of the products that they were consuming as well. So.
Was it Jeff Bezos that said anecdotes are the truth, or some variation
like
of that he believes the stories more than the systems?
Yeah. Well, to Mary's point about if you're sitting in like a committee meeting and your dashboard is all green, how do you know that there's not something brewing? And so that's why you have your dashboard, but have it supplemented by anecdote stories. What are your clients telling you?
Yeah, well, I mean, the other point is when there's a bad spot, like, so when I was running KPMG, you could go through and we had 18,000 people and you could work your way through and you would see the teams that were doing badly tended to be doing badly on everything, right? They were bad on their metrics, they had a low level of trust, they had a high level of issues, right? You could almost point out where the next thing was gonna happen. And then when you went around and you asked people, they would pretty much tell you, right? So kind of everybody knows, right? Everybody knows the people who are really smashing it. Everybody knows the people who are struggling. And I think there is something about uncovering that, finding that, figuring out, where you need to let go of people. There's evidence, again, there's a Harvard Business School study that says it's better to have 7 mediocre performers than 1 star who's like a horrible person, right? Who's a tyrant. So there's big evidence on that. And then, and then the flip side is, I agree, a lot of values and things are just stuff on the wall. And particularly for junior people, they can't translate, what does respect mean, right? And I think giving that tangible and helping people live worked examples to understand that this is what we expect, this is what respect means to us, that is a really powerful message.
That thing about sharing stories also comes back to the previous session in terms of all the stuff that goes wrong and whistleblowing, because sharing the good stories is obviously a really good idea. I mean, it is. But sharing the bad stories whilst protecting confidentiality is also a good idea. And that's a real trick to get that right, because it is really important that you protect confidentiality in those situations. But that then has a chilling effect that you just don't talk about it at all. So people don't trust things they can't see. And so that, I think, is the other balance of these stories. How do I tell these things that we are trying to get around this fear and futility? So I'm either too nervous to do it because I think the consequences are going to be terrible for me, or there's no point, nothing's going to happen. Those are the two effective drivers of not speaking up. So how do you tell those stories about, actually, we've had this many whistleblowing cases, this many led to dismissals, you don't have to say what they were and give any confidential information away, but talking about some of this stuff in a way that you're comfortable to do, it stops that vacuum of
the more
information.
I do think companies need to be brave here. The more that you share, and the reality is, yes, confidentiality is important up to a point, and then it's not that important, right? I mean, if somebody's been fired and let go, how important is that confidentiality? If the victim doesn't care, I would say share it then, right? Well, why lack bravery in that situation? The trust gap happens, like as you've said, right? When people know that bad things are happening and they don't think that anything's happened about it. And I think this default to we don't talk about it is hurting culture.
Mm-hmm. Thanks, ladies. Let's move on then and have a closer look at incentives. Often been in the regulatory or under regulatory scrutiny for driving the wrong kind of behaviour and delivering perhaps sometimes unintended outcomes. I think, again, you've all got really interesting things to say here. I'm going to start with you, Emma.
Yeah. So this isn't so much about incentives per se, but around inducements. And again, this relates to the court case that I referred to. So the case revolved around inducements from the sales team to the retail client. The inducements were all about, if you opt up, you will receive rebates, you will receive bonuses. All the things that the regulations tell us we shouldn't do was there in black and white in the emails. And so you can definitely, and the client opted up and lost a lot of money. Anyway, which is why it ended up in court. But the issue here is the behavioral piece, because I will almost guarantee you that that salesperson was being remunerated or incentivized by a bonus scheme focused on one or two metrics. Profitability or revenue, however you want to call it, would have been one of those. Obviously, the way in which that revenue was being brought into the firm couldn't possibly have been part of that metric for this person to be assessed against. And so I've seen it from a customer outcome standpoint, and the way in which bad incentives from inside the company do absolutely relate to the outcomes of customers. I think, Gemma, you've got something, yep.
Yeah, well, yeah, I mean, and I think that what you're saying is absolutely key. Think about the outcome that you want. Always think about the outcome, because absolutely, 100% agree with you that an outcome like inducements is almost certainly driven from an input like incentives. And so you can, I know people go, well, you can't draw a concrete line between the two, but I think you can. In most cases, you can kind of see how X plus Y equals Z here. And I think when you think about incentives, that clarity on what behaviours you are wanting to drive, because what outcome you want, is key. So it's the same thing about what I was saying about culture. You've really got to think through all of the steps here. So there are a lot of different incentive schemes, and there are a lot of ways that you can design these. You can have team ones, you can have individual incentives, you can have a mixture of both. You can have ones that are values driven. Those tend to be the peer-to-peer ones. So if anybody's got things like at your best points or anything like that where you can give points to colleagues, they tend to be quite values orientated. You helped me with this, you were really collegiate, etc. So you sort of see the values through those. The ones that are performance driven tend to be the ones that are more standard in terms of your end of year bonus kind of ones. But they don't have to not be values driven or metric driven. So if I think about sales targets, they clearly usually fall into the, oh no, this could go wrong bucket. But if I think about what a good sales target is, I first need to decide what a good sale is. So you have to think about, what am I rewarding? Good sales targets are about rewarding good sales. So if you aren't measuring the difference between what you think a good sale is and what you think a slightly less good sale is, and you're just measuring sales targets, by definition, that's not a good sales target. If you are looking at measuring how many good sales somebody did and rewarding on that, you're more likely to be driving some better behaviours around that. So again, that clarity of thought about what behaviour you're trying to drive, what measures you need to put in place, what you're really looking for, and what outcome you want are key in terms of designing those. And then you monitor them, and you adapt them, and you're flexible. And if it's not working, you try something else. So always be thinking about that agility around whether or not these things are actually working, and are you seeing some red flags? And okay, if we're seeing those, we need to adjust, versus actually, this does look like it's driving the right behaviours. Let's do more of it.
Mary?
I agree with that. I think the only thing I'd say from a board perspective that I'm seeing, what's great, I think, is that companies generally in financial services now know that it's not just about making money, right? That they have to take steps when things happen, and they have to look at other things. What I would say is I see a lot of companies spending a lot of time designing really good systems that get really, really complicated. and that maybe are not driving necessarily the outcomes that people want, right? That, the biggest thing is that you need to curb excessive risk taking, but you need growth, right? And so I think it's being able to balance those two, and then being able to see, particularly as a board member, that management is stepping up when they're seeing stuff that they don't want, or that they're encouraging the behaviors that they want. But you can get into, some of my boards are quite big, and you can end up with quite a complicated system, and I'm not sure it necessarily is any better than a less complicated system.
That ability to talk about things and not be scared to have your voice heard, I think, is key in that, because some of the things we do are really complicated, and the decision isn't always easy or clear a lot of the time. So the ability to get everybody together and to have people in the room that can talk about things, and there are mechanisms that you can put in place to force somebody into that role if you don't already have that culture. So you can, there was a zombie movie, it was called The Seventh Man or something, I can't remember. But like there was one person whose job it was, the 11th Man, don't know. There was a person whose role it was to disagree. That's their role. So they know they're not going to get in trouble for disagreeing. They have that role in the room. So if you don't have a culture that naturally does this, then you do it, you force it on people, basically, until everybody does get comfortable with that. And then they go, okay, actually, we can speak up. So there are absolutely ways to force it a little bit, because sometimes you're going to need to. But that ability to take that diversity of view and talk about it, and people just say what they really think, so that you can come to a well-informed decision. Decisions aren't always right, and we talked a bit about what happens when we get them wrong, but if you thought about it and you can evidence why you've done it that way and it was for this particular outcome, you're in a better position than had you shut all of that down and you're not talking about it, or you've had one person make a decision that nobody else really agrees with. So it is important that you talk about it, but you agree and you move together as a team.
It is, and you've touched on it, the importance of diversity throughout the organisation, not just at the board, so that you've got that diversity of opinion, of experience. Particularly when you think about the types of products and services offered, why wouldn't you have a board or a senior management team that reflects the diversity of the community that you're providing for? And so, the FCA was thinking about looking at diversity, but it's kind of backtracked on that. But there are so many sort of metrics and surveys now taking place that talk about diversity at board level in particular, and you can see there has been some movement, some improvements in say the representation of women in boards, but it's not just women. It's around ethnicity. It's people with disabilities, that you've got that diversity of thought at a board level, and that's, to your point, how you get that good conversation going, because you draw in those different perspectives.
Diversity ends up being a whole other topic, diversity and inclusion, and you need to be really careful, because whilst I do absolutely agree with representation fundamentally, diversity of thought isn't always there, even when you're well represented. And the inclusion part of diversity is massively important. You can be diverse, but if nobody wants to speak up about anything and nobody feels like they're being included in the conversation, you don't get anywhere anyway. So definitely a topic probably for another day, but one, that safe environment where people can speak up, share their opinions, whether or not they are hard opinions or just creative opinions. It's all on a scale of good business, right? If you're not willing to even speak up and say, I've got this really good idea for a business idea, then the opportunities you lose are massive.
Okay, so if we start to address the second limb, as time is moving on, of the panel brief, I knew this would happen. Let's look at the space where something is going wrong, and a couple of important concepts. So That's the ability of entities to recognize that perfect may not be possible and fessing up to the fact that something might need to change. And then the duty to be open and cooperative with the regulator. Who would like to start? Mary?
Well, I mean, I'll kick it off because I'm the whistleblowing champion and the head of like audit and risk on pretty much all my boards. And it comes up all the time, right? It comes up all the time. I think that the thing I always tell people is that you have to do the right thing. You know, that the cover-up is worse than the crime. And I say this as a former prosecutor, right? It is much easier to get people for covering stuff up, and the evidence will be very, very good, by the way, on this, than it is to get them for the original crime. So, you know, on a practical level, you should just do that. But, you know, second, it is about this trust thing, right? As a you know, because I was a CEO and led companies, if you don't do the right thing, your employees are going to lose trust in you. You run the risk of additional whistleblowers. You run the risk of additional things happening, so you have to do it. And as a board member, I think it's your job to hold management to account. First, are we looking to see if bad things are happening, and do we have MI on this? Second, when things happen, you know, are we stepping up and doing things? So I get whistleblowers all the time. You know, you have an absolute duty to keep them confidential. Most businesses now have good whistleblowing policies that you're able to follow to protect the whistleblowers, but, you know, engage in an active investigation and then report things to the regulator and engage in a positive dialogue to be able, and whatever regulator that is, because often you'll have 2 or 3 if it's something big, you know, to work your way through it. And also, finally, to remediate, because there's a reason why it happened. You know, and it's probably that you have some control failings, but also you have some cultural issues because people are taking advantage of those control failings, right? So, so it is about stepping up and doing that.
Emma?
Yeah, no, it's so, because we've been talking about non-financial misconduct, something I did want to reference is the fact that there are firms now, particularly in the UK, who are using e-com surveillance tools. So they've been implemented originally for market abuse, but they're now also being used to detect non-financial misconduct. And I think it's important that people are aware that these technologies have improved significantly. So this is not just about lexicon, but it's about the structure, the tone, the intent of sentences, of the whole actual conversation. And so there's much more nuance being picked up to be able to detect the non-financial misconduct, which means it can then be referred to HR, which means that then reasonable steps can be taken to do the investigation and so forth. So I just wanted to mention that because there are some pretty good ways that you can detect some of this activity without having to walk the floor or spying on your teams per se, because these solutions are already in place, and so they are being now repurposed slightly for some staff where that's already a surveillance mechanism.
So you can definitely see that happening at HSBC in terms of the evolution. We're growing in that space. We don't have the answer, I think, yet, but it's certainly something that we're thinking about, because traditionally surveillance has been very much focused on market abuse. We have done certain things in terms of less about sentiment and tone and looking in terms of emails, but certainly things around the use of email, how long it takes to respond to things, how often do we have to be chased, that kind of slightly more data driven, because you do need to think as an organization, how do you move into a space that's not this big brother surveillance space? What does that do to your culture? What are the unintended consequences of that? Funny story, I got pinged for e-coms not very long ago because I'd sent, so we are not allowed to communicate over WhatsApp. It's an unsurveilled channel, it's an unauthorized channel. It's to do with the recording of what we do as regulators, regulated activity, I'm sure you're all aware. I Teamsed a colleague of mine, and I said on the Teams, could you send me that slide on WhatsApp? So this is a lesson in grammar, because what I meant was, will you send me that slide about WhatsApp? And so immediately picked up this lexicon in the surveillance tool saying she's sending something over WhatsApp. And I got hauled in, well, I didn't get hauled in, I got asked, have you sent something over WhatsApp? And I know, no, I meant about WhatsApp. So it's getting more and more sophisticated. There's a lot of noise in the system, and I tell it as a slightly funny story, but it is really important, and it is important that your colleagues know that these systems are there and they're not being hidden, and we're transparent about the fact that we all surveil. We, as organisations, that's in some form or another happening. But as you grow in that space, it's really important to be transparent about that, but also because it's not about catching people out, it's about developing the right culture around this. So it's not it shouldn't be used as a tool to catch people out. It's there as a control alongside all of the things that you're doing in terms of driving the right behaviours.
One thing I do think that's good is, I think it used to be, and I would say this is true, that there was a real feeling that there was one role for the rank and file and another, for senior executives. And I think, and the FCA, I think, should take a lot of credit for that, sort of moving the ball on this, right? First, starting with the Odie case, and then, now we can thank Coldplay, I think, that, it is sort of expected that when senior people do bad things, that should come to the board and things should happen. And I will tell you, on my boards, everyone's just like, is this a Coldplay moment? Do we need to have a Coldplay discussion? Like, it is actually in the vernacular now, and I think, that's a really positive thing.
And I think your point about the behaviour and the transparency is hugely important. You can see that in the decisions that the FCA and other regulators are making, that it's almost as much, if not more, about what the engagement was like and how that firm dealt with that. And I certainly from HSBC, you can see that even in our internal audit. So in the mechanism and the method for internal audit is they're auditing the subject, and then you also get a rating on what the relationship with the auditors was. Yep. So you get both of those things.
Yeah, the how is important, right?
Absolutely.
Yeah, I don't think you'd have like some of the BP and some of these other things. Like I think now in financial services, the expectation of the regulator is clearly very different.
Yeah. Well, it comes back to Teresa's comments this morning about self-reporting issues, being open and transparent with the regulator, and that, we're now seeing that played out in the final notices where there's comments around that transparency, that cooperation, and also comments around how fines are being reduced on the basis of that cooperation.
Although one thing I will tell you, when you're dealing with multiple regulators now, there's been some recent stuff coming out of the Department of Justice that's the opposite, where people are not getting credit, even though they're cooperating, if it's a case that they really want to make an example of. So again, you need to be really well advised on some of this stuff.
Okay, so someone mentioned final notices. So in the space where remediation hasn't been possible and we really are in the spotlight of the enforcement team, and I suspect we might be hearing ourselves in an echo chamber with the responses, but let's address it. What sort of behaviour are we looking for from individuals in these situations to mitigate to the extent possible once an investigation's on the cards?
So I'm happy to kick it.
You're going to take a start, Emma.
And like this.
Woo. So it is about having a team that is confident and capable to speak up and raise issues. That's the most important part, because how do you discover that something's going wrong, either detriment to a customer or a process that's held together with sticky tape and a spreadsheet and is causing issues? You need people to feel comfortable to raise those issues, to be listened to, and that they feel comfortable that it is being listened to and something might actually happen on the back of it. So that would be my starting point anyway.
Yeah, and I think that transparency and communication is kind of key as well. We all work not all of us work in large organisations, but we all have resource constraints, and there's an awful lot going on. And so absolutely all the stuff we've just been talking about in terms of hiring the right people, creating those environments where people can communicate with each other and speak up is hugely important. It sort of hopefully switches the tap off, or at least turns the tap down a little bit, right? So massively important. But we can't be everywhere all at once and remediate everything either. So being clear about what you can do and what you're prioritising, and of the 20 things that you're prioritising, number 21 might blow up. And we all know that. So you still have to make risk-based decisions and smart judgments about what you think is going to be the biggest risk. So again, putting that way of thinking and that, I know the regulator's keen on calling it risk culture, that is equally as important as just talking about culture. How you actually manage risk, you have to make choices, you have to prioritize. And so taking all of that good stuff as read in terms of bringing that in and having a transparent culture that allows you to see stuff means that you can actually have a good risk culture because you can make those decisions because you're trying to see everything.
I mean, look, I'd say a couple of things. Look, when something bad happens and you're really in it with the regulator, I think, or the DOJ or anybody else, look, you've got to figure out what's going on, right? Number one. Number two, you've got to contain it. You've got to figure out how big the problem is, and then you need to put you need to wrap some stuff around it. You need to position it as well as you can and show some real speed, right? Speed and activity needs to really happen. And then you use it, right, as that platform to drive change, because you have a once in a lifetime, and I work with a lot of firms like with this. You have a once in a lifetime opportunity then to say, okay, we're going to fix things, we're going to make it better, and we're going to use that hopefully to demonstrate why we get exemplary cooperation or a smaller fine, and use it to really be able to get rid of the people who are the bad people, really change things once and for all. And I think the firms that don't do that, that's when you see them in this kind of revolving door where they go in and they go out. And I think, if you're stuck in that, two things I'd say. One, call in the right people so you get some support. And then two, you need to lean on your board and your senior management to really be kind of brave and thoughtful and thorough, right, when they're working on this. I get you have to prioritize, and yeah, you probably can only do 3 things when you want to do 21, but you need to absolutely get those done. Because otherwise you just end up in this revolving door, right? And that is not a good place to be. Because no one survives. And this is what I tell clients all the time, right? I do a lot of this when people are in trouble. I say no one survives, right? In hindsight, somebody reviewing everything you have. No, you are not going to come out of this well. So the reality is you want to contain it, you want to be in charge, and you want to demonstrate that you can make the difference. Because if you let them do it, that's your worst possible outcome.
We have a few minutes left. Does anyone have any questions for our panel? Shout.
You talked about the role of senior management in setting culture. I'm interested in the role of...
Thank you.
Sorry. You talked about the role of senior management in setting culture. I'm interested in the role of middle management because I think they play an important role, and often you see, especially in large organisations, initiatives to improve culture get stuck at that level because they're under pressure from above and below. So do regulators and firms in the industry need to start talking more about tone from the middle?
Without doubt, right? That whole permafrost thing is horrible, right? That is, when you're running, trying to drive some change from the top, I think that's your biggest issue, right? Is that there are, what do they say? It's a third, right? A third of the people want to change, a third of the people are kind of agnostic about it, and a third will actively kind of fight you. And I think senior managers and senior leaders need to be brave, They need to find influencers, find points where they are truly, rewarding good behavior. And when people are really stepping up and stopping things, they need to either shut them down or get rid of them, right? But I agree with you. It is that middle layer, and that requires effort, right? You can't just. It's like I used to always laugh when I was running risk. It was like people would draft a policy and sort of toss it into the into the company and hope that would mean you'd get a good outcome, right? You have to actually drive that. And that a lot of that is statistics too, right? You need to have information so that you can see if stuff is happening. And I think your role in whatever you're doing is to make sure that information is coming up and that things happen on the back of it. Yeah. Otherwise, it's quite woolly.
Completely agree. I mean those guys are your culture makers, absolutely. Day in, day out, they're the ones there, right? And I think they're absolutely key. And to your point about the effort. There is effort here. So we will all train all of our managers. We'll put them all through leadership training or whatever management training. That's the least that we should be doing. That's not the measure of success, putting all of my managers through X amount of training and then going, they went. That doesn't tell me anything about really whether or not they are doing what they need to be doing day in, day out. So in an organisation that is small, you have a little bit more control, obviously, and you have a little bit more ability to see what's going on. In an organisation that is large, you have to rely on other mechanisms for doing things. And I think this is where it becomes personal. So this isn't about me sitting here as a conduct person and going, I have to influence 200,000 people. But the management structure is that you usually manage 10 people. I can influence 10 people, and those 10 people can influence 10 people. And so think about using the organisation to your benefit, and how do you actually influence smaller groups of people, and how do you buddy them up, and how do you do huge amount of time and effort involved in doing these things, but will pay you rewards.
Some of it is competence and confidence too, I think. One of the things you realize is that sometimes people just don't know how to do stuff. I mean, I'll give you a KPMG example because it's not a financial services company. What we realized was when we were trying to push through cultural change and diversity and things like that was people struggled having negative conversations, right? They just were really bad at it because everybody at KPMG wants to be great, right? So it's a very difficult thing. And so we literally had to go around and help people do it. We taught them how to do it. We'd have people sit with them to help them and support them in doing it. We'd have practice sessions so that they could do it. Like it's not easy, right? There's a reason why something really obvious is not happening, and you got to figure out what that reason is. And sometimes it is like, I want to do it, I'm just too afraid to do it, right? And how do you give people the courage and the confidence to be able to step up?
Any more questions? Go ahead.
I'm interested in how all of this relates to individual accountability in financial institutions in particular, particularly when it comes to, to be very simplistic about it, let's just set aside conspiracies and unethical conduct for a second and talk about cock-ups, because there's a lot of cock-ups that happen in complex organisations, which is people trying to do the right thing but getting it wrong, okay? Goes back to some of what was being said about consumer duty earlier. How do you create an effective speak-up culture where people are encouraged to volunteer things that they or their teams may be getting wrong through innocent error of judgment in a regulatory regime that potentially punishes innocent errors of judgment? Because remember, the conduct rules punish not just lack of integrity, but also lack of due skill, care, and diligence. And one of the things I've certainly observed in the financial services sector, particularly in large organizations, and particularly at the middle management level, is that generating an environment in which people feel safe to volunteer their own or their team's innocent errors of judgment or innocent mistakes is extraordinarily difficult in that environment.
Yeah, Martin, it's a great question. I think just hopping on it, right? To me, it's sort of three things, right? One is you've got to say, if you tell me, I'm going to take care of you. Right? I'm going to do my best. If this is an innocent error and you screwed up, that probably means that we screwed up because we didn't give you enough support, training, you're in the wrong job, whatever it is. So I think you've got to start with that, because that's the only way you're going to get enough trust to let people speak up. And then I think you actually have to do it, right? You actually have to support them, and you actually have to go to the regulator and advocate for them, or take the hit yourself and say it was our control system or whatever to try to work through it. I think the second thing is you've got to get a culture where you try to get people to open up as early as possible, right? Little errors are easy to fix. Cover-ups are really hard to fix, right? So you want to know as soon as is humanly possible so that you can help them and have a culture of no blame, we're going to fix this together. And then I think the third point is developing that rapport, particularly if you are individually regulated, not everyone here will be, right? But to develop that rapport, that story of this is how we do things, right? So Hargreaves Lansdowne, good example, right? It's just been taken over by private equity. We've had to have lots of conversations with the regulator to say, this is how we do things. This is how we're going to do things, so that when you make a mistake, it's not as big a deal, right? The worst scenario for any firm or any person is situation normal, everything's fine, and then boom, bad thing, right? Because then it's a lot of explaining. So I think it's those three things to my mind.
And it does come back to your point, Mary, the culture of people feeling comfortable to speak up early and raise that concern and not think, oh my God, I've done something wrong and I'm going to lose my job and I'm going to be blamed for it. You need to be able to get people comfortable to have those conversations. Yeah.
And change people, because there still are a lot of senior people on boards who are like, we've got to come down, like, sort of Damocles or whatever on this person, right? And you need to stop doing that. If it's deliberate, yes, right? You should show no mercy, but the rest of it, yeah.
Yeah, and it isn't always easy. There are blurred lines between each of these things, but I think the language you used is useful here, where innocent mistakes versus competency issues. There is a nuance there, and there is a difference, and there is a sliding scale of things, and where it's obvious, it's really obvious. But there will always be a judgment where you go, actually, should you really have known? Is there something here that is a competency, rather than I accidentally pressed this button and I sent the wrong thing to the wrong person? I mean, that's not really necessarily going to be a competency thing. If you've done it 100 times, maybe it is a competency thing. But we can all make those fat finger kind of mistakes. So yes, there will always be those judgment calls on some of these, but actually let's not try and kind of overcomplicate for those cases, when actually a lot of it is pretty obvious. And absolutely agree with you that if it genuinely is a mistake and people didn't know, or it was just an accident, then having the right systems in place where you can teach people to not be doing that again, and that's just a policy reminder or whatever it is, rather than an actual breach of something. Those are things that are within the gift of an organisation to set up as very clear sort of things that they've got in their framework and options available to them, all the way through from actually you didn't really do anything to that was a reminder to do it this way, training, actually there's a competency issue, actually there's a control issue, actually there's something else going on. I would hope that most organisations have got some form of framework that allows for that flexibility.
I think we're officially out of time. So before I get a throat-slitting motion made at me from our hosts, TLT, I'll hand over to them to wrap up. But we can take further questions outside if you want to come and find us over a drink. Thank you. Thank you to the panelists.
Thank you, Kerry, and the panel. So that brings the conference to a close today. It's been a pleasure hosting you on behalf of TLT. Some reflections from me. I don't think I ever thought I would hear the phrases zombie, Coldplay and Wicked in a financial services enforcement conference, but there we go, we did that today. And I think a reflection from me, and it's developing on a point Martin was making just then, around the comment from Therese earlier today, doing the right thing. I think what we've been hearing today is that, clearly firms are in a space where they're navigating a lot of change. We heard about AI, the role that plays, crypto, how far do you go with your data, etc. Firms are navigating those issues. They are learning as they go along, potentially won't get it perfect straight away, but probably want the empowerment from the regulator to go on that journey, to make mistakes and to learn and get to the right space. And so when the regulator talks about doing the right thing together, I think my encouragement to them would be allow firms to have that empowerment to go through that journey and perhaps learn together for the good outcomes. Leaves me to thank everyone for attending today, delegates, speakers, sponsors, supporters, all the people that have stayed with us virtually along the way. Obviously, a huge thank you to City and Financial for organising this. A lot of effort goes in behind the scenes to get speakers, put the event together. Always so welcoming on the day, so huge thank you. We really enjoy working with you, so thank you from us. You will have access to on-demand version of the sessions today and a follow-up email from City and Financial over the next coming days. I do encourage you to fill out the questionnaires. They do inform future events. If you haven't done, please do. And there's a potential to win a bottle of champagne. So what more would encourage you to do that? We do have afternoon networking and tea upstairs, so hopefully you'll be able to join us and carry on the conversation, and we hope to see as many of you here in a year's time at the next conference. Thank you.